Namaste and good morning, everyone present here. So I welcome you to the Accounting Standards Workshop of Day 1. So this workshop is an excellent opportunity to learn and engage with experienced people. And without further ado, let us commence the session by inviting Chairperson CA Revati S. Raghunathan, Chairperson of SIRC of ICA, and CA SHOBANA GIRIDHARAN, today's speaker, and also CA Akash B Bokaria and CA Sankarakrishnan sir. And also RAGAVENDER Arulmurugan. Sorry. Before we begin the session, I like the members to rise up for the motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
So today's accounting standard workshop is the first day of the second series. So it's a 2-day series, and we have the second day series on 19th this month. That is the third Saturday. I request all of you to attend that one also. So officially beginning, I request CA Revati S. Raghunathan, Chairperson of SIRC, to welcome address the gathering.
A very warm good morning to everyone who's here. Our MC already has the Saturday blues and he said good evening. It's like he's wishing all of us away from here. But it's actually morning, Vishnu. And it's actually very heartening to see that we have more than 90 registrations for this IND AS series, which we are conducting at SARC. And I know the Saturday morning blues people will be trickling in, the weekend mood will set, and people will be trickling in throughout the day. But we wanted to keep up to the time, because otherwise the speakers will not actually be able to share what they want to share with you. And also, if there are any queries which are going to be raised, we may not be able to address those. So that is why we always try and commence all our sessions on time. We are 15 minutes late. So I don't want to give any opening remarks about IND AS, because the speakers are here to talk to you about it, how important the convergence is, how important the presentation of financial statements is. And we have identified people who have this specific experience in and practical experience in these IND AS applications. So I request all of you to take benefit from their experience, and also you can bombard them with as many questions as you want. And before I hand over the proceedings to the speakers, all of them you can see very excited, and they're going to share their experience. I just wanted to tell you all about the conference that we are having on August 22 and 23, the SIRC Regional Conference. It's in Chennai this year after 10 years, and it is in Nehru Stadium. and we are expecting at least 4,000 registrations. We have invited the Chief Minister to inaugurate the conference along with the President and Vice President of ICAI, and IFAC Deputy President is also going to attend the conference, and she's going to share some of her insights on the trajectory of the profession. We have top-notch speakers on income tax like Padamchand Kicha and Chaitanya sir. Both of them will be addressing it together. Advocate Zohab Hussain on ED matters, Advocate Sujit Ghosh on GST. Advocate Arvind Dattar is also going to talk to us on the making of a professional, and then we have PR Ramesh on NAFRA, and we have on ED. Zohab Hussain on ED, well, what to do when the ED comes knocking at the doors of the chartered accountant. We also hope to have some sessions on ESG and maybe a session on the Big Four. We will be having a businessman, one of the Fortune 500 companies. We have invited the promoter of that company, the chairman and MD of that company, to address us. Yeah, and we have a bonus session by our Information and Technology Minister, Tamil Nadu, P. Parnivel Tyagarajan sir, who is, I've got it, who is not going to address us as a minister, but as a speaker. He's a fantastic speaker. His, I would say, his marrying of various topics with the economic impact and what is actually the path the country is taking going forward, and what is it that we as professionals should do is really amazing. And I requested him to not address us as a minister, but more as a subject knowledge expert. Hopefully, he'll talk to us on the disruptions due to digitization. Apart from this, we are having a parallel sports events, which is called as the SIRC Premier League. We have 6 sports: cricket, badminton, shuttle, pickleball, chess, and carom. So whomsoever is interested, you can join us. You can all play for Chennai and SARC. This is being held across all the southern states, and we'll be having the finals, semi-finals and finals at the Nehru Indoor Stadium. And you're all aware that it's a world-class sports auditorium. And apart from that, to enable members who are coming from outside Chennai to actually enjoy the flavors of Tamil Nadu, we are organizing short trips to Pondicherry, Kanchipuram, and Tirutani. Pondicherry along with the Pondicherry branch, Kanchipuram with the Chengalpet branch, where we are having temple visits and of course the shopping which we cannot miss, and Tirutani. We have also requested for darshan at Tirupati. It's only 2.5 hours from here, and we may get 50 to 100 tickets. We will be putting up all this on the conference website. Please do join for all these trips also if you want, but mainly register for the conference. And since we have this popular demand from all other people from all other states to hold the conference at Marina Beach, we said it's not possible to get the police permission, and anyway it's a shambles right now. So since we could not hold it in Marina Beach, we are bringing a Marina Pavilion here in the conference venue, where we are going to have all the goodies and short eats and whatever is happening at the Marina Beach is going to be replicated here at the Marina Pavilion. So it's going to be a fun-filled conference with a lot of knowledge updation, skilling, and sharing of experiences with everyone. And of course, apart from the conference, we have a lot of other interesting CPA seminars also planned. And I forgot, we also have the morning session. On the second day, 9 to 10:30, we are having Dummies Drama presenting their drama Kapidwaja. Dummies Drama is a troupe which is founded by a chartered accountant, and the main actors are also chartered accountants. We had a trial run here in this hall on CA Day, and it was a huge hit. So we are presenting it during the conference also. So please do get up early and come on the second day. It's a very, very good, very well presented, very well thought out, and humorous play with some message to us, which I think all of us who are bound by these code of ethics need to actually watch. So we are also having other programs planned out in SARC. We'll have some short trips, some CP come work-life balance programs. Please do keep watching out. Join us. Only if you join will we be encouraged to think and give a little more of the out-of-the-box presentations. Of course, intense sessions like the IND AS programs which we are organizing. We have a second day's presentation on the 19th on IND AS, so please do come for that also. So I will now not take too much of time. Welcome to everyone, and thanks a ton to all the speakers who accepted immediately, because these are all niche areas, niche subjects which, I, as a regular practicing chartered accountant, will not be able to actually put in practice to the type of clients whom I have. But it is, we should not actually abdicate and say, okay, I have only smaller clients, MSME clients. I don't need to know about IND AS unless and until we know what is expected of us as professionals. We will not be able to deliver the excellence which is required of us at whatever level of clients that we are having. MSMEs, sole proprietors, partnerships, or the listed companies. Wherever we are, if we understand what is basically expected, what the IND AS literature is actually talking about, and the understanding the nuances and the interpretations, we will not be able to actually do a good job wherever we go. So thanks once again to all the speakers who have, generously offered to share their experience, because sharing knowledge and experience doesn't come so easily. We are all very possessive of whatever we know. We don't want to share. Paravala, I will tell you afterwards and we'll move on. But they have actually accepted immediately as soon as we asked them. So request you all to take benefit of the same. Thanks a ton once again to all of you, and thank you everyone for registering.
Thank you, ma'am, for this warm welcome address. On behalf of SARC of ICA, we thank you, sir, for accepting our invite today and being with us. As a token of appreciation, I also invite Chairperson Revati S. Raghunathan, ma'am, to kindly present the memento to our speakers as a token of our appreciation. I request Revati, ma'am, to give the token to CS SHOBANA S. GIRIDHARAN, ma'am. The memento to Akash P Bokaria. I also request Alagu ma'am, CA Alagu ma'am, to give the memento to our speakers. To Raghavendra. To Raghavendra. And I also request CA Purnima ma'am to give the memento to CA SHOBANA GIRIDHARAN, ma'am. I now request Chairperson to give the memento to Sankarakrishnan V. Thank you, ma'am. So I now request CA Deepak Jain, sir, to kindly introduce our speaker and begin the session. Thank you, sir.
Thank you. Yeah, this is better. Very good morning to one and all. Indeed, it's a great pleasure to introduce our speaker, CA SHOBANA Giridharan. I was just going through what and all ma'am has achieved. It is fantastic. I would like to just share a few things out of this, but yes. So CA SHOBANA is a director and has been with Deloitte for more than 13 years of her experience in Deloitte. SHOBANA ma'am has worked extensively in various engagements of multinational companies having shared service centers in India and domestic companies for technology, manufacture, healthcare, and power. She has also specialized in process documentation, compliance review, internal control reviews, and her extensive experience in supporting the accounting and financial reporting process for various large entities. She has extensively worked in advisory engagements, including financial reporting and analysis, transition process review, internal control reviews, and monitoring control frame reviews in shared service centers, process documentation, and shared service organizations. She has been involved in carrying reviews of financial reporting for various geographies at the shared review centers in India, process documentation, internal control reviews, and other key engagements involve efficiency reviews, benchmarking of processes with industries, and identification of the process involvements. She served major clients like L&T, Microsoft Corporation, World Bank, and a number of them. Ma'am is a CA. She's a member of ICAI. She's a member of CISA, and she's a commerce graduate. Over to you, ma'am. A very warm welcome to you, and over to you. Thank you, ma'am.
We structured is we will take you through the accounting standard, which covers the scope, the classification, and whatever is specific to the accounting standard. In this case, we are going to start with property, plant, and equipment. So we will be covering the scope, the identification and classification of PP&E, initial subsequent measurement, the depreciation, which is again critical, and then the disclosure requirements. So we will go through, and any questions you can feel free to ask, or you can park your questions and we can take it at the end of the session, whichever way it works for you. So this is a pretty straightforward standard in comparison to other accounting standards when we say revenue recognition or leases or your financial instruments. So there it involves a lot of technical evaluations and assumptions which are coming up, but PP&D is relatively straightforward standard where we don't have so much of complexities involved. So we'll go through the specific scope which I covered in the previous sections, understand what the accounting standard talks about, and how do we need to apply it in our engagements. So IND AS 16, as we know, should be applied on accounting of property, plant, and equipment, except when there is another standard which requires to apply another specific treatment. So what are the applicability of IND AS 16, and for which it is not applicable? There is a correspondent accounting standard which takes care of what is not to be covered under IND AS 16. So it is applicable. IND AS 16 is not applicable in case of any PP&D classified as held for sale. Why? Because that has been covered separately under IND AS 105, which is non-current assets held for sale and discontinued operations. Again, your IND AS 16 is not applicable in biological assets related to agricultural activity other than bearer plants. This standard, it applies to bearer plants, but it does not apply to whatever is being produced on bearer plants. So when we say it is not applicable, we gave clearly IND AS 16 is not applicable for this. So what is the corresponding applicable standard which is there? It is coming as IND AS 41, agriculture. The third one which is not applicable is recognition and measurement of exploration and evaluation assets. So that gets covered as part of IND AS 106. So here we are opening up with IND AS 16, which is not applicable to few set of elements, and where it is getting covered. So having said that, then what this standard covers, or what is getting covered as part of IND AS 16? We will come to the definition, and then we will get into deep dive into the scope of what gets covered in this standard. So the relevant definitions under PP&D is, all of us know, carrying amount. So what is a carrying amount? The amount at which the asset is recognized. So when I say an asset is recognized, it is after considering your accumulated depreciation and accumulated impairment loss. So that is what is your carrying amount, which is there in the financials. Next is the cost. What do we mean by cost? Cost is the cash or cash equivalent which is actually paid to acquire that particular asset, or it can be the fair value of the consideration which is given to acquire that particular asset at the time of acquisition or construction. So it can be a cash or it can be a fair value at the time of acquiring the particular asset. And basis the cost or fair value, the asset is being initially recognized. And if it is, say, a share-based payment also happening, that also gets covered as part of IND AS 1 or 2. But it is the asset which is being acquired is valued at cost or fair value. Then we come to depreciable amount. Depreciable amount is nothing but what your cost and other amount substituted for cost minus your residual value. So when you say depreciation, it is on a straight line basis or it can be on a WDV basis. Year on year, you have to charge because the asset, when it gets used, the value of the asset gets depreciated over the useful life. Then property, plant and equipment are tangible items which are held for use in production, supply of goods or service, or for administrative purpose, and they are expected to be used during more than one period. So this is a very, very critical definition of PP&E. Two things which clearly calls out, it should be held in the use of production or supply of goods or services or for administrative purposes. And secondly, it should be used more than, the useful life should be for more than one period. So we will touch upon that in examples also in the upcoming slides. The next definition is residual value. Residual value is what the entity will get on disposal of the asset. It is just not straight amount what you get on disposal of asset, but there are some adjustments which you need to make, especially after reducing the estimated cost of disposal. And when we say what amount we will get on disposal after deducting the estimated cost, if the asset was already, the asset will already be in use, everybody will know that. So if the asset was already of that age and in the condition, in the specific condition which is expected at the end of the useful life. So every asset will have a useful life. So at the end of the useful life, what is the value at which you are going to sell that particular asset? What is the residual cost that you are going to incur to get your asset sold? So that has to be adjusted to find out your residual value. Useful life, we know that it is the period which an asset is expected to be available. It depends on the class of asset, whether it is a property, whether it is machinery, whether it is building, whether it is vehicle, furniture, fixtures. It depends on the class of asset. So the useful life is the period over which an asset is expected to be available for use by the entity, or number of production or similar units which is expected to be obtained from the asset by the entity. So if it is machinery, the useful life will differ for plant and machinery. Useful life will differ for buildings, as I said, for class of assets. And it also depends upon how much that particular machinery can produce and over that period. So basis that also you can conclude that the useful life of the asset is so many years. Not always, but where we need, where there is a change in the useful life. Like Schedule 3 suggests that this should be your useful, Companies Act suggests that this has to be useful life of the asset. But the company is engaging into a lower useful life or a higher useful life. If there is a difference, then we also seek the opinion of the technical expert to understand why the company is sorting for a change or a different useful life, and whether it is appropriate to consider that useful life. So that basis, that is what you will disclose in your accounting policy for that particular class of asset, and that useful life will be considered for computing your depreciation. So not every time you will have a technical expert giving the opinion, especially when there is a change in the useful life, as per what is required in the act and what is actually being considered by the company. The management, it is not defined by the management. Management will go by whatever is the useful life which is actually applicable as per the act. So if there, normally it will align. Most of the cases it will align. In case there are differences which the management decides like this will be the useful life, management can go ahead to decide what will be the useful life for that class of asset. But they have to establish why of it through a technical assessment and other information which is required. 1 year. See, one period we are saying because ours will be, what to say, an reporting period April to March, Jan to December. So we say one period. Normally more than a year the asset has to be used for us to classify it as a PP&D. For us to basically capitalize. So we'll take an example of hotel property. I have taken some examples because the standard per se will appear to be simple when you're reading it, but few things through an example, if we understand, it will be better. So whether hotel properties should be classified as property, plant and equipment as per IND AS, or is it an investment property under IND AS 40? So this is the simple question here. So what is the key factor which we need to consider if you have to capitalize this hotel property as PP&D? So the main aspect you need to look at is whether whoever is the owner, say the company or the entity who owns the asset, suppose the owner, he acts as a hotel operator or he is the landlord. So if the property owner's main source of income, it really depends on your day-to-day or every week-to-week occupancy of what are all hotel rooms are there or restaurants are all there and other facility, then here what happens, the property owner is actually providing the services to the people who are coming to use the particular property, and he is also getting a return for the property that is being used by the guests. And he is actually using it for his business to render the services. So in that case, it will be capitalized or it will be taken under IND AS 16. Suppose the owner's primary source of income comes from, say, long-term lease. Clearly he is leasing. He is giving the property on lease. He is getting rental basis the lease which has been entered into with the customer. Then it becomes an investment property because he is using that property to generate an income. So in this case, the property owner, it is sort of, he does not provide any specific services of making the guests use the accommodation or the restaurant or all that, but simply he enters into a leasing arrangement and he gets the, a lease income arising out of the leasing arrangement. So in that case, it becomes a investment property. And so everywhere you have to just understand and identify what is the basics. So whether the conditions are clearly getting satisfied to be capitalized as PP&D, then you go ahead to capitalize. Otherwise, what is the other relevant accounting standard which gets applicable? Accordingly, it has to be accounted. The second example is gold bullion. We know that central banks, they hold gold bullion, they sell gold bullion and all. So in that case, how do whatever the gold reserves which the central banks are holding, okay, and you say that those reserves are not traded. They are not just buying and selling, but they are having bullion so that they will sell it to who requires, especially from the jewelry in the business and all, they will buy bullion from banks. And for other industries also, some people will buy in gold bullion. So in that case, whether this gold bullion is to be treated as PP&D or whether it is to be taken as inventory from a bank's perspective. So the gold bullion, sir? No, it is not tradable. That's what I'm saying. It is not traded. You are not buying and selling. You are holding that gold bullion, and where it is required, it will be sold to the customer, whoever is your customer. Mainly if I am into, say, a jewelry industry where I purchase gold, I will purchase bullion from banks. So I am like a repository of a gold bullion where I will sell when required. My business is not trading. I will not buy and sell. So that is why I am saying I am not trading it. So in that case, you capitalize it as PP&D. You use a cost or a revaluation model, whatever, because this gold bullion, it meets the definition of a PP&D. It is a tangible item. Again, it is held for use in the supply of services. Supply of services in the sense, it's basically what to say, stabilization of exchange rates for the benefit of entities operating in the jurisdiction, and can be expected to be used during more than one period. But why it is not an inventory is, it is not being consumed or it is not being used in my production process. So I cannot call it as an inventory. It is more of where banks and the customers, they enter into what to say, contracts. They enter into forward. So they will have a forward rate. They will take into a forward cover. There will be a spot rate. So they exchange currency forward, or a gain or loss which happens on account of this what is a purchase or sale of this bullion, that gets covered as part of different accounting standard. But the base what we are saying is this gold bullion which is held by the bank will be taken as a PP&D and not as an inventory, because I am not using it in my production process to produce anything or sell anything. There's example, bank. Huh? We cannot generalize, but only RBI sells bullion, I'm not coming to tell. Even other banks have bullion. So, but there are restrictions on how much a bank can hold and sell and all, that will be determined by RBI. But banks generally have bullion. Other income, what you're saying, I'm talking about capitalization of taking it as a PP&E, and when you sell the bullion, whatever income you realize out of that, that will go to other income only, because it is not a direct income for the bank. Whichever bank it is, whether it is RBI or any other bank, the sale of bullion is not going to come directly as a revenue from operations for them, because that is not the primary source of income. Huh? It doesn't. See, one is it is used in the production process. Another thing is you enter into forwards, you enter into contracts, and thereby you sell this. And there are derivatives also which get entered into because of this bullion. So it enables you to carry on your business. So that is why you are capitalizing it as PP&D. Not necessary it has to be used in production. Yeah.
Services, it's what's mentioned over there. So in that case, effectively it is used in their process of stabilization, which is the business kind of services that they do.
Correct. In order to maintain. Correct.
In order to mitigate the dollar rate and our rupee against the pound,
Correct.
sterling pound. So in such a case, it generates the income indirectly, and it helps us our economy. So I think that stands for making it as a PP.
PP&D, correct. Yeah. Because that is what I told, every bank will have restriction on holding the bullion, how much they have to hold and what is that they have to sell, and also basis that it is considered as a PP&D for the banks. Oh, okay.
So ICICI is the pioneer in that. They used to sell the gold coins. They will stamp it as a 99.9%. That's almost, it's a 24 karat gold.
Correct.
So that generates the additional income to the banks. That time we have some gold.
So in that case, it becomes an
Inventory, it will not be a PP&D. Yeah.
Then in that case, it is other income.
Correct.
It becomes an inventory for them, and maybe it will be classified as another income.
Yes.
So that also stops.
No, now banks don't sell gold coins and all. It is only bullion which they have and they sell it.
Ma'am, just one doubt. So in this case, they will recognize unrealized gain or loss at the end?
Yes, yes.
Though being proper to PPE, it will be...
Yes, because this is basis your bullion, you will have a spot rate, forward rate. So whatever happens on account of that particular transaction, unrealized gain or loss will be recognized.
Based on the year-end stock?
Yes.
Okay, and one more thing, how you say, let's take Titan. In that case, where will it be accounted? It will be as an inventory?
For the jewelry, yeah, it will be an inventory for them.
Okay, thank you.
It will be an inventory.
In the first example, the hotel is likely to be investment property, in which case IND AS 40 applies. Whether the lease should be operating or even finance lease, both lease.
It was it's an investment property. So
The
you
lease
would
should be
account it as an
operating.
investment property, and then you're saying lease, na? It will more go like it can be a finance as well as operating. I think.
Even in finance lease, it is fine if I apply IND AS 40.
Yeah.
Okay.
It is not a primary income. You can apply, but I can get back on that because primarily what we are trying to tell is if it is not for the purpose of generating your income, like you are not the occupancy of the rooms and the restaurants by the guests which happens, that involved, that becomes a PP&E. Otherwise, you put it as investment property. But finance and operating, it can be either ways, I guess.
Just to answer your point, the finance lease or operating lease classification comes from the lessee's point of view today. It's only the ROU or it's governed by that IND AS 116. From the lessor's point of view, it's going to be the investment property only, irrespective of the lease that they offer, whether it's a finance lease or long-term lease. When you give us a finance lease, mostly it will be a long-term lease or a short-term lease. It will be an investment property because their objective is to earn rentals out of it or a capital appreciation out of it. Whereas from the lessee's point of view, it could be a ROU, right of use asset, governed by 116 that will come.
That's what he's asking. Here it is an investment property is clear, but he's saying whether it will take the shape of a finance lease or an operating lease, it can be either in the books of the lessee. So it is not that it will only be a finance lease or it will only be an operating lease. In my books, I should either take it as a PP&E or as an investment property depending on the conditions that are satisfied. So moving to initial and subsequent measurement. So there we saw what are all the exclusions which is not applicable. But here when we say property, plant and equipment, it's get covered under IND AS 16. The next question is how do we recognize or how do we measure the PP&E? So there are two valuation methods. One is cost, which is very straightforward. It is the asset is measured at cost at the end of each reporting period. Revaluation is asset is measured at fair value at the end of each reporting period. Both methods are allowed as per the standard. You either value it at cost or revaluation method. Then we come to depreciation and derecognition. Simple formula of depreciation is my cost minus the residual value. No further depreciation if my residual value is more than my carrying amount. I restrict my depreciation, I need not depreciate it further. Method of depreciation, useful life of asset and the residual value shall be reviewed by the company. So year on year, your useful life assessment and the residual value will be evaluated to see what is the depreciation that has to be charged off. And the property, plant and equipment can be derecognized upon disposal. So whenever you are selling your plant and machinery, derecognition happens and you sell your PP&E where no further economic benefits is expected to come out of that particular asset. And finally, whatever gain or loss you get on the sale of that PP&E, it has to be recognized in P&L. Yeah. It can be straight line method or it can be WDV. But it has to be consistent. Again, if you want to change your method of depreciation, it becomes a change in the estimate and you have to give a prospective impact. So in the earlier slides, we saw what are all not included as part of PP&E. So then what should be covered as part of PP&E? So the definition under the accounting standard is property, plant and equipment are tangible items which are held for use in the production or supply of goods or services for rental to others or for administrative purposes. So when we looked at couple of examples, so you can fit that clearly here. It is held for use in the production or supply of goods or services, both the hotel example which we saw and the bullion example we saw, and the investment property which we saw, or for administrative purposes and are expected to be used during more than one period. So this has to be clearly satisfied to classify it as PP&E and capitalize in your books. So it's a tangible item held for use for production or supply of goods or for admin purpose expected to be used for more than one period. Satisfied, capitalize as PP&E. See, two things which you need to look into. If I can understand your question, you're saying you carried a PP&E for a particular business. Say that business was a segment or part of your, then that thing you're closing down, and that asset is no longer usable. So if you clearly decide that particular segment is getting closed, this particular asset is not usable at all, then you accelerate the depreciation for that particular asset and you make the net book value 0. You also assess for impairment and see what needs to be provided, because you are not going to use that asset at all. You are very clear. This asset does not have any other use. But if you are assessing that there will be future use for the asset where you can move it to another location, or it can be used in the other production process, that can be evaluated, and according to that, again, you can assess what will be your impairment and then continue. But otherwise, you can accelerate and make the net book value 0, because immediately that asset is not usable and you're closing down a particular unit or a segment or whatever it is.
For a temporary period, maybe for 1 year or 2 years. After that, it will be used. So that I don't want to go back and buy the asset at that point of time. So that I will make the asset in workable condition. But only the thing is, I am not generating any revenue out of it. So in such a cases, I don't think so. We can stop depreciation and keep it, and we can re-estimate the useful life of the asset when we asset put into the use. That's what my opinion.
So if it is only a temporary stage where you are not going to use your assets, that is going to be 6 months or 1 year is what you're saying, and your management is really confident that it is going to start off after 1 year, there is nothing wrong in you to continue to depreciate, because it is only 1 year and you're going to continue to use the asset. So not necessary you need to stop depreciation for that 1 year and then continue it later, because it is a temporary phase, and it is not that the entire production is shut and closed and management is not going to, it is not going to look into that part of the business itself. So you continue, and then if you see after say 1 year still you and management anticipates that this is not going to happen, or it is going to take 1 more year, or it is near future it is not going to happen, you assess at that point in time, and then you take a thing whether it should be accelerated depreciation has to be done and impairment should be done. Uncertainty. See, 1 year you can wait and see, but that doesn't mean you need to stop your depreciation for 1 year, not provide for depreciation, because you're saying that for 1 year that asset may not be used completely. So you can give that assessment. Maybe you can you have to do an assessment year on year, extend that assessment. Maybe for the second year, if you're able to clearly foresee that it is going to be another 3 years or 4 years, the same thing is going to happen, then you need to revisit and see what you need to do.
Depreciation, it's not just when the asset is wore and tore. It's also an efflux of time. So even if there is a passive use where you don't use the machinery on an active basis, it needs to be depreciated. And to add on to a point on useful life is an estimate. So every year the management is required to evaluate its estimate, that if a machinery is to be depreciated for 10 years, they'll have to every year evaluate whether this machinery is to be depreciated for 10 years. So to answer your question, every year the management of your so-called company should have to evaluate, okay, if this machinery is worth to be depreciated for 10 years or 5 years or the remaining useful years.
Charging the full 10%, because my revenue matching concept will not take place, because the asset is not going to generate any revenue for the next couple of 1 year. So that's in such a case, and I'm also spending some repairs and maintenance cost on it, but that particular, that is absorbed as a cost. That is certainty. I have to do it. So in such a case, rather than charging the 10%, I think I can restrict to 1% only for the wear and tear or the estimated life. That assessment I can take it and I can do it. No.
When you assess your useful life, say you assess the useful life of that particular asset. Okay. So it is not that When we say you estimate your useful life every year or assess your useful life is there, unless there are some specific circumstances coming up, like you assess there will be a close down of a business unit, or there is going to be a relocation, or a new line of business has to come in, then that is something different. But existing asset, just a temporary reason, you are going to not use it for a particular 5 months or 6 months and then continue. You cannot just like that change your rate of depreciation or useful life for the purpose of saying that I am not using it to the fullest extent. So normally it is 10%. So for this purpose, for 1 year, I will take it as 5% and then come back. Because you can't keep... Correct. You cannot keep changing your useful life year on year. It has to be assessed where required, and as we said, any technical evaluation has to be done if you are saying I'm going to reduce my useful life or I'm going to increase my useful life.
What is finding out matching concept.
So,
Since there is no income, where is the question of charging?
so yeah. So, just to add all these things, the question was, what if the asset is idle? I've decided to keep the asset idle for 1 year or 2 years. What happens in that case is, we're talking about the measurement of the asset, right? The measurement says that it has to be at a carrying value or recoverable value, whichever is less. So, when you decide that it is going to be idle, right? There's, of course, we can continue to depreciate in your original useful life as a normal efflux of time. But at the reporting period, you have to assess the carrying value of the recoverable value. And how do you assess your recoverable value? Whether you are going to have a future value in use coming out of that asset. Maybe 3 years down the line, 5 years down the line, or 8 years down the line, right? Or you can, if I'm going to dispose of that asset immediately to a second-hand asset, right? What is that I'm going to get today? So I'll get a quote probably and see what is the probable sale value, that is the recoverable value that I will get, and I'll carry that asset only at that value irrespective of whatever the depreciation that I charge in the year. Maybe 1%, 10%, or even 80% accelerated. But at the end of the reporting period, I should have a basis for my measurement, which is a recoverable value of the asset. That's the essence of the standard. When I'm carrying the asset, it should be at a recoverable value, which is on a more scientific basis.
That is what we say, go in for accumulated depreciation, assess for your impairment. So that will cover at what value you are going to carry your asset in the books. So classification as inventory and property, plant and equipment. So what are the instances under which I will classify it as an inventory and where I will classify it as PP&E? So if you see most of the spare parts and service equipment which is used in the plant and machinery, that will get categorized as inventory, whereas it is major spare parts for servicing the particular equipment, and that spare part is going to increase the productivity of that particular plant and machinery, then that becomes the same. The major spare part where it enhances the useful life of the asset will become as a PP&E. Otherwise, normal, the repairs, maintenance, whatever you use your spare parts will be as inventory. Second, the spares and service equipment recognized as expense. So the smaller spares and other items which you consider, and the services, whatever cost you incur, that gets expensed as repairs and maintenance. The major spare parts which becomes a part of the plant and machinery, which becomes a standby to that main plant and machinery, that will be capitalized along with that machinery and it will be depreciated. Then major spare parts, which you call them as major spare parts, maybe based on the value, based on the volume of requirement which is required by the plant and machinery for the spare parts can be classified as major. But if it is the life of that spare part is only less than 1 year, again you keep it as an inventory. And where the useful life of the spare part is lower than the useful life of the PP&E, or useful life of spare part is it can be lower or it can be the same as that of the PP&E, then whatever spare part you are getting replaced in the PP&E, that has to be depreciated for the remaining useful life of the asset. That is what we are trying to tell.
See, some time back we were talking about realizable value. Let's assume as per the normal useful life, my carrying amount as of 31st March 2025 is 10 crores. June or July, I have sold it for 8 crores. Now there is something called events occurring after the date of balance sheet. What should I do now?
Value as on March was 10
10
crores.
crore after depreciating as per the normal useful life. What I was doing on a year
And you sold the asset subsequent to the year end.
to the year end, but that event has occurred before signing the balance sheet date. Now what should I do? Should I do any adjustment in the March itself or only in the next year?
See, again, if there was already a decision to sell that plant and equipment and you were aware of that as at the year end, that this event is going to happen, then you have to give the effect in the P&L.
See, I'm contemplating during
If it was a sudden decision after the balance sheet date, you had to sell, whatever be the reason, but that event was not there as at the year end, then definitely a disclosure at least has to come saying that the event was not there as at the balance sheet date. It only fructified after the year end. So you are showing it as a disclosure, and in the next year it will come as whatever has been the impact, you will give it in that way. But that is very aggressive. Otherwise you will say the condition existed as at the date of balance sheet, and you are also aware. Obviously in your minutes or any discussion, if you have clearly discussed saying that this asset will be sold subsequently, the approval has been obtained and all that, straight away it will become an adjusting item in the P&L.
So let's assume before March I would undertaken a huge repair. In April it is not working out. So I decided to sell the asset in June. In this situation?
Correct. The same thing only, no sir. That particular asset, yes.
Situation is prevailing. So I'll have to adjust in the market.
Correct.
Itself.
Whatever pertains to that particular asset, if you have decided that you are going to sell, but because before selling you want to do some repair, some expense, anything you had incurred, all adjustments, because the event existed as on the date of balance sheet, you make the adjustment in your P&L.
I've decided not to sell so that I'm incurring a huge expenditure.
Yes, that you can expense it, yes.
I'm expensing.
Yes.
But that expenditure also failed because of the expenditure, the asset is not recovering. So in June I am selling it.
Yes.
That loss, that is carrying value minus the realization value, that loss, should I recognize in the March?
Yes,
or
March.
the next year?
March, that's what I told.
Because my decision as of March is not to sell, is to recover the asset by incurring a capital expenditure.
Yes, so that as at the date of the balance sheet, you had an option, you want to spend on that particular asset and you want to use it for your production, which you thought it will improve your, and you went ahead doing that.
Yes.
But what happened? You incurred that, but subsequently realized that this is not going to work out, and so you are selling it.
Yes.
So we can say that yes, there was a condition as at the balance sheet where management estimated that this expenditure will be incurred for that asset for continuing. But however, that did not happen. So it is being sold, you can.
So some disclosure in the notes will do.
Correct. We know it before the balance sheet signing. Do anything. This is what he is saying is year end and the reporting, the balance sheet.
So you are saying in the second example, we should adjust in the March itself.
Even the first example, you sold it. That also the profit has to be adjusted in the P&L. Second example, you are not selling it. You have incurred the repairs and maintenance, still you have to expense. Consider it in your year end.
Thanks.
Again, we see a couple of examples in the balance sheet classification. So there is a restaurant which maintains a base stock inventory of silverware, okay, and dishes. Additions to stock are charged to expense. On an average, the turnover of these items is 2 years. Is it appropriate to classify the dishes and silverware as PP&E? So there is some silverware and dishes, and additions are all charged to expense, and the period of these items, the turnover of these items is 2 years. In that case, they are saying we need not complicate too much and think into inventory, other accounting standards. Read simple English and say what they are trying to tell is testing the concept of whether it is a current asset or a PP&D. That's all. So here, it is a tangible asset which is held for supply of goods and services, and definitely it is expected to be more than 1 year period of use. So they should not be current assets. That is what they are trying to tell here with that example. So
Every addition is going to have the 2 years life, no ma'am?
correct. Normal plus additions, maybe the example which was given, that's what I was saying, word by word, you need not get into it. Overall, what we are trying to tell is, considering the period of usage, whether I need to take it as a current asset or a PP&D. So where the useful life is more, where the asset is being used for more than 2 years, so we are straight away taking it as a PP&D and not as a current asset. So your see, another, normally the companies, they will have a policy of, say, the value of assets is less than 5,000. They will not even capitalize it, they will charge it off in P&L. You are right, maybe that will be one of the instances where I am not, I don't want to capitalize it, but I want to expense it off, whatever I am, I have additions which I am bringing in. Even the normal, suppose for example, classic thing is this computers and all which they purchase, and if the value is less than 5,000, they will not even capitalize it in your books. They will directly charge it off as expense, and that will come as part of the accounting policy itself, clearly calling out. So what we are trying to tell is, yes, if it is more than 1 year, you take it as PP&D. If it is not more than 1 year, it is considered as current asset.
There's a construction company, and I've purchased scaffolding equipment, essentially to reach access greater heights. So is there a possibility that it can be written off in the P&L? And under circumstances like, say it is not possible to use it for other projects or something like that, is it a possibility?
Can you write off scaffolding equipments itself fully, you're saying, when you purchase that? For a construction company. But that scaffolding equipments, if I understand, is for actually, for what purpose? For
reaching heights.
For roofing and other things and all, no? So it will normally be part of the asset because it will be continued to use for, being used for other projects also, and the value of the asset is also going to be more, and your construction period is not going to get done in 1 year, it is going to extend over a whatever period. So considering all that, and considering the nature of the equipment which is getting used, I think it is to be capitalized and depreciated and cannot be written off in year 1 of purchase itself.
Is it possible to claim accelerated rate of depreciation?
Accelerated you can look at. If you say that I can use this particular scaffolding machine only for certain specific period of time, or for this particular construction, and beyond that the wear and tear is more and it is not usable, you can consider accelerated depreciation. But you cannot say I will write it off in year 1 of purchase itself. Correct. Correct. Accelerated depreciation, yes, because year on year you are going to evaluate. If you want to depreciate it, saying that this, I initially estimated that this equipment, scaffolding equipment will be used for 7 years. Now I see it will be used only for 4 years. You do an accelerated depreciation.
So, sir, typically the scaffolding equipments, as you asked rightly, I mean, there are numerous in numbers, right? And it keeps shifting between one site to another site, and for multiple purposes. And there could be potential loss also in terms of transporting or by wear and tear. So, as sir has asked, it will be based on the initial useful life that I determine. Basically, if I determine that I'll use it for 2 years, I'll depreciate it over 2 years. Or if I determine based on the size of the project and the churnout that I use in the projects, multiple projects that I use, if I can determine that it's going to be only 1 year, It's like it's not that I'm writing off. I'm using the I'm determining the useful life as 1 year rather than writing off fully. So that way it can be that's what accelerated depreciation is also about. So you can actually write off in 1 year by way of saying that my useful life is only 1 year.
Thank you.
But that assessment, please make it carefully, because you're just taking the hit in 1 year, whereas you're going to extend your construction for another 4 years or 5 years. So the message is possibility to be done, but please evaluate and do whether it is required in year 1 itself.
Thank you, ma'am.
So next is classification of a standby equipment. An entity has installed 2 turbines. Okay, one will produce energy for the plant and the other will be used as a backup in the case your first turbine fails or is otherwise rendered out of service. So the probability that the spare turbine will be used is very low. The spare turbine is necessary, however, to ensure the continuity of the production process if your turbine 1 fails. The useful life of the standby turbine will equal to the life of the plant, which is the same as your primary turbine. So in this case, what does IND AS 16 state? Standby equipment, we agree it qualifies as a PP&E. Okay, when it meets the definition of PP&E. Although the definition requires that entity should expect to use the turbine during more than 1 period, it does not state that such use should be regular. So here we are saying the second turbine will become operational only if the first turbine fails. But that it should not be a factor for you to evaluate and say, I will not capitalize my second turbine because it is not usable now and I don't know when that will be usable and when will the first turbine fail. That is what they are trying to tell here. So although the definition requires that entity should expect to use the turbine during more than 1 period, it does not state that such use should be regular. Therefore, the spare turbine is classified as PP&E and should be depreciated from the date it became available for use. That is, when it is in the location and it is in a condition necessary for it to be capable in the manner it intended. So even I am not actually using it. It will be put to use only when the first turbine fails. But still I have that. You have to capitalize it as plant and machinery. That is what they are saying. Even if it only says it should be more than 1 year period, but not necessary that regularly it has to be used. It answers your question. Normal. That the original turbine, what they are saying, even the secondary turbine has the same useful life as the primary turbine. So same way you will capitalize what is the useful life for the original primary turbine, same useful life will be for this and you will depreciate. Correct. There is a pause, yes. Yes. Correct. Even if it is spare, if it is not used regularly, you capitalize both turbine 1, turbine 2, you will depreciate. Then this is on depreciation of spare parts. Company M buys 5 new machines for use in production facility. Simultaneously, the company purchases a spare motor to be used as a replacement if a motor on one of the 5 machine breaks. Okay, when should this depreciation of the spare motor commence? So the useful life of the motor commences when it is available for use within the machine, rather than when it was acquired. It would therefore be depreciated over the period stating when it is brought into service, continuing over the lesser of its useful life and the remaining expected useful life of the asset to which it relates, which means you are buying, it is clearly a spare motor that you are purchasing. And when one of the machine breaks down, it is a major spare part which is getting replaced into your main machinery. So you will depreciate it for the remaining useful life is what we are trying to tell. The original... See, turbine, both are asset. There is a turbine 1, there is a turbine 2, primary turbine, secondary turbine, and you will use that secondary turbine, and it does not say that if there is a failure of the primary turbine, you will use the secondary turbine. So there, this turbine is, the period is going to be more than 1 year definitely. So that what the standard is saying, that your use need not be regular, but where you have an identified asset and it is capitalized, you depreciate that. Here machinery is there, but it is a major spare part which is getting replaced in that particular machinery. So machinery is running. That is what he is saying. The company purchases a spare motor to be used as a replacement. That turbine 2 was not a replacement. Requirement. Yes. So you are using this to, we saw in the previous slides, no, the major spare parts, if you are going to replace it in the plant and machinery, how do you treat it? So this is a replacement to the main plant and machinery. So you are, the depreciation will commence when you are replacing that particular part, and it will be depreciated for the remaining useful life of the asset. Yes. Once it is, that's the major spare parts, when you are putting it into that plant and machinery, it is a PP&E only, and you will depreciate it.
So here it's not just because it's made available, it is put to use.
Yes, because it is a major spare. There it is a equipment. Correct. He will ask for the turbine that was not put to use. No, how would kepar? Adu vera. It is, even if it is not put to use, it is like a standby equipment. If the asset to which it relates will be replaced at the end of its useful life, and the motor is expected to be used or usable for the replacement asset, longer depreciation period may be appropriate. And during the period before the motor is available for service, any reduction in value should be reflected as an impairment loss. So what they are trying to tell here is, you are replacing a particular asset in a particular machinery. So remaining useful life basis that you evaluate and you depreciate. And if the asset does not become useful, or you want to sell it off, then assess whatever is going to be the impairment which is coming out of that asset. No, you will only when there is, you're saying. No. If it is in PP&E, it has to be depreciated. It will be as spares. Once it is capitalized, then it will get depreciated. You cannot show those spares as PP&E and not claim depreciation. Spares, it will be kept as spares, and then once it is identifiable, that is what you have, that repairs and maintenance, no? If it is a normal routine expense, you charge it off. But if it is a replacement of a particular spare or major item which gets overhauled in a machinery, then it gets capitalized. So at that point in time, it will get capitalized in PP and depreciated. So till then, it will not be in PP&E, it will be kept as spares. It is not, all spares are not capital assets.
There is actually a subtle thin line of judgment involved here. You can either keep it under the inventory as spares, or even the fixed assets, PP&E. It essentially comes from the concept of componentization. We have this concept of componentization when the Schedule 2 came under the Companies Act, which determined the useful life. So this spare part, which is explained in this example, is essentially in the nature of a component where, it can be fit in any of the 5 machines. So that's where they say that when it is put to use, you can, until then, it's a choice of judgment that you initially adopt as a policy by the company. Like whenever I have a spare part, I will keep, as of this type, I will keep it as a PP&E. If it is in PP&E, it should start at least a normal efflux of time, a normal wear and tear. If it is in the inventory, and later, it's not a routine or regular one, but it's one-off cases, but I keep it in PP&E. If it is going to be a routine spare part which I keep using it, then it will go and probably sit as a consumption of spares, and it will go in that route rather than in PP&E. until you determine that it will have a longer useful life when you put into use. When this is this example where it will move to PP&E, and from then, that's where the last line says, the moment you determine when it is getting to put into use, that time you determine what is the recoverable value of that asset. And if, let's say I bought it at 1 lakh, and when the day on which I'm putting to use, it's only 80,000 rupees. On that day itself, I will recognize 20,000 first as an impairment loss. Then I will depreciate the balance 80,000 over a period of 5 years, rather than taking 1 lakh to 5 years. So that's where they say, okay, in that case, you determine that impairment, which anyway will come under the measurement standard of carrying value or realizable value, whichever is lower. For every asset, whether it is in PP&E or in inventory, you have to carry it at either carrying value or realizable value, whichever is lower. So effectively, it will get depreciated or impairment or reduction in the value in some way or the other at the end of the reporting. It has to be assessed, whether it sits in PP&E or in inventory. Correct. That is, it is not ready to use probably. Yeah, if it is your own, that is a different. If it is in the form of molds or jigs or tools which is internally developed, probably yes, it will sit in CVP until it is getting put to use. But there has to be again a proper understanding of what is exactly, whether it is completed or put to use.
No, but that so capital CWIP will not be a parking account for molds, jigs. If you are not when you don't know when you are going to use it, so till then I will park it in CWIP. CWIP doesn't work on that basis. CWIP is pending to be capitalized, as he said. So there is a period by which you have to capitalize and you have to put it to use. So it can't be indefinite period, or you can't have assumptions in that. Mostly பார்த்தோம்னா இந்த jigs, fixtures, mold, spare parts எல்லாம் inventory-ல it will be there. Then correct. But mostly it will be there, and when you are capitalizing that, then it will go to PP&E and depreciate. Predominantly it is like that, because I can check if there are certain spare parts or something which is specifically being purchased for an X machine, which is exclusively identifiable for that particular asset, whether it is there in the PP&E itself, and then when it is actually put into use for the remaining useful life, then you will consider. But again, once you say I am identifying this major spare part component as a PP&E, the depreciation will start, whether it is in part of the main asset or you have identified it as a separate asset. But according to me, everything will be in it will inventory, and then when you consume, whether it should go to whether you need to charge it off as expenses or whether you need to capitalize, that is the second question. What is overriding here? No, a standard does not say we cannot capitalize. Okay. Suppose there are spare parts are there. Okay. Spare parts, it is for minor repairs and replacements. We ourselves know it should be expensed off.
Yeah, definitely.
Our question is major.
Yeah, major spare parts. Instead of being parking capital this one, can the company form a policy stating that the year of purchase onwards, we can capitalize PPET like that?
You need not have a separate policy called out, but if it is the practice of the company that whatever major spare parts which the company used to purchase, say for a specific asset already identified, it was there already as PP&E, and then when the repair came in, they fit that major spare part into the PP&E and was doing it as a practice. I don't think so separate call off of any disclosure is required.
Okay. If at all they having continuous policy like that.
If it continues, they can follow. See, because it is ultimately the option of the management to say whether you are showing it as keeping it as inventory, and when you are using it, you are bringing it into PP&E and depreciating.
Is it means that it is against the policy, accounting standard? No? Yes.
It's not specific like it's.
Is it not required to qualify and something like that?
No, it's not required to.
Since there is no 100% clarity, and as he told, it is a thin line where we have to take a decision. So why don't I put it as in a policy, and I can continue to take it in either in spares or either in capitalization.
So that is, it is not a major, what to say, special call out in the accounting policy saying that if it is a major spare, it has to be shown only in PP&E. So if it is like that and you are taking it as inventory, then you may need to call out. Standard itself gives that judgment, benefit of judgment.
Necessarily for asset specification.
Correct.
It can be a general specification.
Correct.
The policy should be only for the general specification and it should not be for the asset specification.
The policy will say what you need to do in this situations.
In this situation,
If
yes.
it is pertaining to your spare, the decision of the management whether you need to take it as a PP&E because section allows you, accounting side allows you to take it under PP&E, or you can take it also in inventory because there is a standard which deals with inventory. There is no, the accounting standard here is not compromised in any way. You are not bypassing any standard in doing your accounting. You are following either inventory accounting or PP&E for initially. And then, of course, once it is capitalized, we are clear. It is before getting capitalized whether I should take it as an inventory or whether it should be in PP&E.
As long as it is consistent, nothing will prevent us. Yes.
Yeah. So just to add, the very fact that it is a spare part, the moment I buy, I'm not going to use it. So that is where the question comes up. I'm going to keep it as it is, whether I'm keeping it as an inventory or whether I'm going to keep it as a fixed asset. That's where that thin line of judgment comes in. Now, when it comes to judgment, then based on the type of that spare part, the management has to decide, okay, is this in the nature of a fixed assets? Like any other asset that I'm going to buy, like in this example, if it is a 5 assets on which this motor is an asset, basically, when we talk about a motor. But there could be any other spare part which is really in the form of a spare parts as a consumable. So that's where they take a decision between, they have to take a decision between fixed assets versus inventory. Now, to answer your question, sir, some companies, large companies, which I have also seen, has a long list of spares. Then it's going to be a very cumbersome process. That let's say, for example, I have 20,000 line items of purchases of spare parts because of the intensive, it's a capital intensive industry, right? So it's going to be very cumbersome for them to decide whether I'm going to inventorize or whether I'm going to capitalize. But they can always, depending upon the size of the entity and based on the materiality, they can always take a position. Let's say, for example, as a policy, any item below 50,000, I will consume it. Or any item above 50,000, I will evaluate whether it's going to be a fixed assets or an inventory, right? Their policy choice will comes. They can decide based on, but the concept of whether it's going to be an item of fixed assets or an inventory depends on the type of the spares that they use and the frequency of with which you purchase.
As well as the value, in some cases.
The value comes as a policy choice, yes.
Obviously. If you go to
not frequently. You have to take a choice. If you keep moving it, it's like an error that you made.
Sir, 1 minute, sir. Assume that I purchase a fixed asset on 15th March, okay? Or say January 1st. I have not put to use because the building is under construction. I have not put to use. Where I will park this? See, no, plant and machinery. Plant and machinery also CWAP.
No, because it a lot depends on the facts, because it requires an installation, because it is not put to use for your intended use. Right. The standard says it has to be put to use for your intended use. It is not put to use for your intended use in your example. So unless it is there, it cannot be, it won't suffer a depreciation. That's a question. But the moment it is put to intended use on the day, let's say it's 3 months or 12 months, whatever period, waiting period, right? On that day, you have to assess whether the value in which you are going to carry it in the books is the value at which you purchased.
That's right.
You have to then at one shot take a reduction in the value if it is not the value at which you purchased it. And then you continue to depreciate over the rest of the remaining useful life.
Actually, there was a case where the wrong purchase was made, right? And it was stored without being put to use. What will be there in this case?
You can, as an auditor, probably you can understand the need. And I mean, there's always a waiting period. Maybe 3 months you will know it as to what could be the fate of that equipment. Whether they're going to send it back Are they going to use it in their facility, any other facility, or they're going to have plans to use it? So you will have to understand as what is the real use of that. It cannot be a parking lot for us, right? And in that case, you have to accordingly maybe take a position as to whether I'm going to capitalize it and start depreciating. Let's say if I'm anyway not going to send it back. I have no choice to export it back or send it back, right? And I'm not going to, am I having a plans to use it in future for some purposes? It's not going to be used at all, then it's becoming my liability. I have to then immediately write it off, scrap it off. Obviously scrap it off or find a code to sell it locally and then see whether I can carry it at the realizable value.
So, in this situation, should it not go to inventory?
No, it will not go in because the intended use is a fixed assets.
Okay.
It will be a non-current assets or a PP&E. Then the moment you say that it is going to be disposed of, right? Then it will move to a current assets in the form of non-current assets held for sale, which is your property, plant and equipment held for sale, and you carry it at the carrying value, realizable value. But never it will go as an inventory because you have to differentiate between what you normally sell and what you occasionally sell. Your business is not to sell this equipment. Your business is to sell a product coming out of this equipment.
Right. Thank you, sir.
Non-current assets held for sale also, when you're identifying, that sale has to happen in 1 year or so, because you should have identified a buyer to whom you are going to make that sale. In that circumstance, you can show it separately as a non-current asset held for sale in the face of the balance sheet. Otherwise, in your case, you have purchased this equipment wrongly, thinking that it will be usable. So currently, it will be in CWIP because it is not to be capitalized, it will not be used by you. But the option from here will be identify if there are any alternate usage for that particular machine, and if it can be used, capitalize that machinery and assess the useful life. Say you identified, but you feel that it can be used, you initially assess that it will be 8 years or 9 years, but now you feel that it can be used only for 4 years. Then in that case, you assess your useful life, you depreciate it for the 4 years, and then at the end of the useful life, if you want to sell it and realize the money out of that, that is one option. Or it is in CWIP, you don't have any choice, it is a wrong purchase. Then now what happens, it is an asset held for sale. Identify the buyer, and then whatever is the expense which you had incurred, you need to charge it off fully, and whatever loss or gain you make out of the sale, that has to be recorded. Only these two options are there. Then you cannot take it as inventory. Balance sheet la taniya or line item le varu balance sheet la.
It is there.
No, asset held for sale 105. Oh, you are asking which accounting standard it is. Okay. So we will push on. Okay, now I think there is another thing also coming up. So I'll just take in fast. Wherever you have clarifications, you just pause there. So the property, plant and equipment, we are saying it is measured at cost. So cost includes what? Your purchase price, your taxes, all that comes in. Any cost directly attributable to bring the asset to the location, and any cost to dismantle or move the assets. But it does not include your promotional advertising activities, your initial operating loss, and any relocating expenses and other expenses incurred. So directly attributable cost, when we say, it is your site preparation cost, testing cost, any borrowing cost, initial handling cost, all that will come as part of direct attributable cost. Repairs and maintenance, we know that if it is a part of day-to-day servicing of your machinery, expense it. If it is specifically a replacement of a spare or something, then capitalize it. Replacement we touched in length. Yeah, initial operating loss. When you are starting to just build up that particular asset, anything which is there identified initially, that you need not include it as part of your cost, initial cost. Yeah, it will be expensed. Then you have your land clearing cost. I'm not touching into that, I'm just telling you the example. Any clearing cost, any cleanup and grading of land and all which you do, that also will be included as part of cost. Then compensation for late delivery of asset. So we can just go through the example. Like under the terms of a contract for the purchase of an asset, a supplier may be required to compensate the purchaser in the form of penalty or additional discount if the asset is not delivered on time. So in the majority of cases, such compensation will be a reduction in the cost of the asset, and it should be accounted for accordingly. So when compensation is calculated as a percentage of contract price based on some whatever damages suffered by the purchaser, the compensation represents a penalty imposed for the delayed delivery of the asset, and it should be adjusted in the cost of the asset is what they are saying. However, in very limited circumstances, when the contract specifies that this cost will be reimbursed, whatever cost is incurred by the purchaser, it may be appropriate to account for those elements as reimbursement, and whatever amount you receive from that supplier as a reimbursement, you are taking it as your other income. You incur the cost, but you are getting it reimbursed from the supplier. Then any training cost, especially the cost for hiring specific people for that particular project to understand the nuances of that particular machinery, to install that particular machinery, all that can be capitalized. Then proceeds from selling output when testing property, plant and equipment. So whatever that this example I didn't read. Normally what I'm saying is if it is specifically a particular team is hired for installing that particular plant and machinery or to understand what needs to be done, the current employees do not have an idea of what needs to be done in those cases. But here what happens is over and above, you need to conduct a training for the employees, for the work is going to get performed by the employees, but this is the training which is done to the current employees for them to do the work. So in that case, that training cost which is getting incurred will not be capitalized is what we are trying. Then this is on components of cost for a self-constructed asset. So what this is for a self-constructed asset in which the entity makes similar assets held for sale. For example, there is a car manufacturer, and the costs used to determine the cost of a car could also be used in determining the cost of a car that will be held as a property, plant and equipment. So however, if the entity does not construct similar assets for sale, only those elements described in IND AS 16 can be incorporated. So what are the type of cost which gets included? Direct material, direct labor and any other construction activity cost which is directly attributable to bringing the asset to the working condition. So again, directly attributable cost, case on case, you have to evaluate and see what needs to be capitalized under PP&E. I'm going a bit fast because these are basic definitions, and if there is anything, please stop because the next session also has to happen.
Branch at Andhra Pradesh, they purchased MRI equipment, 8 crores. They are not supposed to take input, they capitalized to the asset. 6 months went, response was not proper, meaning operations was not good. They have decided to ship the machinery from Andhra Pradesh to Karnataka. Thereby they have to pay 50 lakhs additionally GST. Okay. Now initial measurement of cost, if it is not refundable, we have to add with the
cost of the asset.
Cost of the asset itself. When it comes to subsequent measurement of cost, this refund I cannot claim as a this GST I cannot claim as either refund nor it is a eligible input. What should I do with this GST? Whether I should write it off in the year of incurring or I should go and add it with the cost of asset.
So this is your, because of your shift of machinery from one location to another location, the GST component that you incur.
Yes.
Subsequently. So originally you had whatever was the GST you had, you added back to the cost and you depreciated. Okay, so this, if you say, it is a cost which is incurred to move the asset from one location to another, and any which case you have to pay the tax.
Yes.
So that has to be taken as an expense only.
See, if you look at AS 10, in that subsequent measurement of cost, they are talking about change in the tax rates. that can be capitalized. Can I equate this to change in
No,
tax rate?
change in tax rates where, because earlier what rate at which you capitalize that particular amount, now it is undergoing a difference. So the differential, you can consider it to give an adjustment in your value of asset. But this is the normal tax which is applicable, which you have to pay for shifting the asset from one location to another, which is the expense that you need to incur, and that needs to be charged off. Because now at the time of capitalization there was X rate, then there is a change in the rate because of which you are getting that benefit in the cost that you capitalized. So on the differential I can adjust it, because I originally took it as a cost in the I capitalized it as a cost. But this is purely additional, the cost which I incur to just shift the machinery from one location to other. I have to pay the tax. That is an expense for me. I have to charge it off.
Only when it increases the useful life of asset, you subsequently capitalize it. That's what I am saying. So, since
That is there in the paragraph.
Correct. Agree. Your question is, his question is, there is a change in the tax rate. That is not going to enhance my useful
Exactly.
life. But in the initial period, you capitalize that at X rate. Now you are changing it at Y rate. The difference in that impact has to be given because you had already.
See, I'm not able to appreciate what is the difference between change in rate and extra tax which I am paying. There is no change in rate, but I am supposed to pay because of GST law. What's the difference? There is no enhancement in the asset value at all.
no, that's
Whatever, whether you like it or don't like it, you added it to the cost of other and depreciated. Now there is a change in that now, because you had already included as PP&E. Now you are giving that impact because of the change in the rate.
Here also there is no enhancement. That's what I
Correct.
am saying.
It is a fresh one. You tried something, you capitalized in a place, it didn't work out, you are moving. So purely it is a separate event which is not relating to that specific asset. You are moving it, you incurring the expense.
If I'm not doing that event, my asset is not useful at all. Because அது ஒரு 10 நாளோ இல்ல during movement, if I'm not paying GST, if it is kept somewhere outside 10 days, there is something called chip or something technique. அது போச்சுன்னா then machinery you cannot use at all. So unless I incur this cost, my machinery will become unuseful.
Correct. So you incur the cost will be debited to your P&L, and you continue using your machinery. It is not, you cannot capitalize.
The rate.
Couple of things, sir. The change in the rates may be contemplated from the angle of the change in the legislation, and because of which the change in rates is coming up. Because nothing under your control, it's the change in the legislation because of which, or some notifications causing a general change in the rates. Earlier you were charged 10-12%, now we are charged 18%, and there is a differential that is collected, not applicable only to you, to all the assets, all the people who are doing that. So then in that case, it is eligible. But what in the present situation that you are talking about is, if I were to say, it could be a bad decision to import in a particular location and then move it to another location without understanding the market intelligence of that, let's say if I were to put it. In that situations, it cannot be subsequently capitalized for the.
Suppose I buy a machinery and there is a screwdriver which is not working. It is worth some 3 lakhs and the machine is 30 lakhs. Then, if I am buying a new screwdriver to make my machine work, I have to impair the cost of screwdriver contained in the earlier capitalization. I impair whatever is left over, and then I can capitalize afresh, limited to useful life of the machine or the screwdriver, whichever is less. Similarly, you can do in taxation also. You capitalized, but it is no more useful. Then you impair it, and you cannot exceed the capitalization value because of some wrong decision, some malfunction, is what I have understood.
So the state GST may differ state to state. I can't be transporting the equipment to 25 states and then keep subsequently capitalizing every time when I move from one state to another state and do this. Yeah. Yeah. So in this case, I think the definition of the standard says very clearly you can capitalize the cost to bring to its present location and the duties paid to its present location for its intended use. The moment you do that in the first location, that's done and you are capitalized it. Intended use, that's what I'm saying. You can keep shifting across 20 states for various purposes, like if a project sites are moving from one
I cannot
location.
question a businessman.
Right.
What is your business exigency?
But the standard doesn't allow you. It stopped. Once you
Standard talking
capitalized
about present condition and location.
and to its intended use on that time.
My surprise in the element of cost, when it talks about initial measurement, it's talk about cost incurred for present condition and location. When it is talking about subsequent measurement, it is not talking about present condition and location. I don't know why it is.
As he said, then every location you are shifting, you keep on capitalizing. That is not the intent of the standard. No, we are. But your question is valid. You say change in rate, I am given the benefit to capitalize. Then why not the tax? Illa, sir. Unfortunately, illa. Correct.
Not only from the taxation angle we have to say, that is okay, additional tax. Also we have to incur transportation, installation in other place. So all those things will be debiting to the revenue only. That is P&L only. The same thing should be applied to this taxation also.
So he's saying it is like normal expenditure, you take it. Here you are just covering other elements of cost. So your normal depreciation, your administration overhead cost, general overhead cost cannot be capitalized along with PP&E. And any cost incurred to demolish some pre-existing structure which is specific to build this particular asset, then you couldn't capitalize that. Depreciation, normal ROU depreciation நம்ம பண்ணுவோம்ல. We are not adding it back. I am saying depreciation of the leasehold land right of use asset during the construction period should be incorporated in the cost of the building. This is because depreciation is an unavoidable cost that is attributable to the construction activity and bringing the building to the intended condition for operation. Incorporate means cost order, saying that it should be included as part of cost. No, this is constructing a building. You are constructing a building on a leasehold land. Appo, and the depreciation of the land, leasehold land right of use asset, and the cost of the asset order, it has to be incorporated. And we are saying. And the ROU asset la vara tani depreciation, it will be covered separately. Demolition of some structure for that particular asset which you want to construct, appo you can add it. If it is specifically to that particular asset, na ipo asset inga construct pannadhukku the demolition cost I have to incur and get that done, that means it can capitalize. That is what is written. Then cessation of capitalization, recognition of costs in the carrying amount of an item of property, plant and equipment when the item is in the location and condition necessary for it to be capable of operating in a manner. Therefore, cost incurred in using or redeploying, which we told. When you redeploy or move your asset, it is not normally getting capitalized. It is a routine expenditure. Determine when an item is in the location and condition necessary for it to be capable of operating in the manner intended by management. See, in the case of a self-constructed asset or installation of a major asset, a policy decision should be made and applied as to what event and at what point the construction or the installation is getting completed. So, all costs which is incurred up till that point in time, that gets capitalized as part of your PP&E. So, when commissioning period is involved, it will similarly be essential to determine the point that characterizes reaching the capability of operating at normal levels and then ensure that costs incurred after that particular level is being reached is all being expensed. So we should first identify what is up till the point in which I can go in for capitalization. Suppose there is a delay in achieving the final physical completion. Costs arising during the period of delay are likely to fall into the category of abnormal costs. And so you are expensing it off. Borrowing costs incurred during such a period of delay will not qualify for capitalization, which requires where your capitalization is suspended or ceased, then you don't capitalize your borrowing cost. Once you commence, then you take it to a part of your PP&D. Lot of regulatory consents are required, like safety clearance, health clearance, are sometimes required before you put an asset to use. So cost of capitalization will not necessarily continue until you are getting all those consents in place. So normally the management will ensure that such consents are in place to the very close to the time frame for completion, and before the commencement all this consent will be obtained, and then that will also be capitalized as part of PP&D. No, different. The borrowing cost you are you have taken loan from the bank to develop this particular asset for which you are going to pay interest and all. So this is attributable to this particular asset itself. So when I am not there is some temporary suspension in that activity of completing the asset, I will not capitalize the borrowing cost. That's operating loss. Whatever now if I have taken a site, I have done some expenses which I have incurred. So up till a point in time, it is fine. I will be able to capitalize whatever till the identified specific point in time. I was supposed to complete all these activities within this period. Adukku beyond a pochna, there is an operating loss which I cannot take it as part of PP&D but charge it off as expense. This is specifically borrowing cost, the loans that you have taken for the particular machinery on which you are incurring, paying your interest.
For 5 years of a loan, and the total cost at the initial stage was $5 lakh. I will pay every year $1 lakh with interest. So here if you see at the end of the reporting period, there is also an element of exchange fluctuation. As per Income Tax Act under section 43A, I used to add as an addition. What about in the books, ma'am, with respect to Ind AS?
That is you're saying?
Two elements. One is exchange fluctuation. On the
exchange fluctuation on what? On your loan which you borrowed.
Yeah, principal and interest element is also there. So
at the year end, you will restate whatever is your loan in your balance sheet. Na? Yeah. So whatever is the exchange difference which is arising because of your restatement, that will get into your P&L. No? That is a normal restatement
so
only.
In income tax, I am adding it as cost of asset. So here I don't have option 43A.
Other tax, what you're saying, which section under the accounting standard allows me to...
I can capitalize it, or how the exchange fluctuation on the principal element?
Expense only.
Okay.
Yes. It is possible to capitalize in this case. There was 46A. There was a provision under section, that is income tax, under income tax provisions and section para 46A of the erstwhile standard and accounting standard was allowing this to be capitalized. So what is the extent of capitalization is, you said in your example, you've borrowed a foreign currency loan. Now you have to compare, if had I borrowed Indian currency loan, let's say the interest is 10% and you are paying, of course the foreign currency loan will be a lower rate of interest, let's say 3%. The difference between this 10% and 3%, this 7% is considered as an interest cost, and that interest cost will be qualifying under this borrowing cost standard, and that will be eligible for capitalization. So under the books, not for tax. Tax is a different matter. For books, this is eligible to be capitalized. So let's say if you are paid 1 lakh rupees of interest through foreign currency, and you are paying 1,50,000 had you borrowed in Indian currency, the difference is 50,000. Now there is also a restatement that is happening in the loan that you borrowed. That is 75,000. So the 75,000 is compared with this 50,000. To the extent of 50,000 it is capitalized, 25,000 is charged off. Both should be there, yes.
But so the understanding is when you're restating the loan, the differential has to go to P&L. That is correct,
To the extent of difference in the interest rates between the domestic borrowings and the foreign currency borrowings is eligible for capitalization.
That is eligible. Interest is one part. Two parts are there. Your interest.
No, there is
and
no.
your
That's a notional
closing.
interest. So in this example, so there is a restatement. That's a loss. That goes
That
to
should
the
go
P&L.
to the P&L. That
only
is what.
Only to the extent of the difference between, in excess of the difference between the domestic current loan and the foreign currency loan. That gets capitalized, and the balance will go to the P&L. That's how the standard says.
So the interest portion, that is getting anyways capitalized, and when you're restating it, whatever you have already capitalized as part of the interest component, you will remove that, and then balance will go to your P&L. So if there is an exchange of asset, cost of asset acquired, the transaction has a commercial substance and fair value. If you can measure reliably, you take the fair value. If the transaction does not have a commercial substance, you don't know what is the fair value of the asset, then the carrying amount of the asset which is given up. Basically, what will be the value in case of exchange of assets? So an exchange transaction has a commercial substance if there is cash flow from the asset and it is received from the asset which is given up. There is a specific value pertaining to that particular asset. And so we saw it will be considered either at fair value or at carrying value. That is what is a breakdown. Here we have an example where there is a ship charter who owns land and building which is carried in its financial statements at an aggregate carrying amount of 10 million USD. It has a fair value of 15 million. It exchanges the land and building for the ship which has a fair value of 18 million and pays some additional 3 million in cash. So provided the transaction has a commercial substance, entity should recognize the ship at a cost of 18 million, which is the fair value of the exchange value of the asset, which is the fair value. And it should recognize a profit on disposal of land and building of 5 million, because you are exchanging this land and building for the ship. The ship will be valued at fair value because you know that it is at the fair value is 18 million. So there are two things which you will do. You are recording your profit or loss on account of the transaction, sale of building and purchasing of ship, and value of the ship, which is your asset, which will be done at fair value of 18 million. Subsequent measurement, again cost model and revaluation model. Cost minus your accumulated depreciation and impairment. Revaluation model is revalued amount minus your accumulated depreciation and impairment. So again, revaluation model has to be applied consistently. Your fair value should be measured reliably. It should be there for the entire class of PP&D, and all these type of assets will get covered, and year on year you assess your revaluation. So revaluation method, it is at fair value. It is done for all class of assets. If there is an increase in revaluation, it is part of equity as reserves and surplus. If it is previously already written down, then you reassess that and you reverse it in the statement of P&L. If there is a decrease in revaluation, again you adjust it in your reserves and surplus, and whatever is the balance that gets charged off to the P&L. So depreciation is quite straightforward, where the useful life, you know, it is the period over which the asset is being used. And then of course you identify what is your residual value. So when you are identifying the residual value, whatever additional cost you need to incur to sell that particular asset also needs to be factored in. So this is a straight line method and WDV. So the basic concepts where depreciable amount is cost minus residual value. If your residual value is greater than your carrying amount, no depreciation. And it should be reviewed at each financial year end. And change in the method from SLM to WDV, it is a change in estimate, and the effect has to be given prospectively. Then we touch about a component approach. So every item of a PP&D with a cost that is significant, that has to be identified having a separate useful life and depreciated separately. So a classic example here is that your airframe and engines in an aircraft, where you will identify the useful life separately for the airframe, separately for the engine. That is where he told about componentization. So you have different useful life for within the same asset itself, and you will depreciate it basis the useful life identified. it will be prospective. That is, when you are changing the method of depreciation from straight line to WDV, whatever was the impact of that particular change, that has to be charged in the current year P&L only. And going forward, a revised method will be followed for that particular class of asset. And you also have to make it as a disclosure in the financial statement, saying that till previous year you were following SLM, you have changed it to WDV, and your impact in profit because of the change in the method of depreciation for the current year in your depreciation expense is so much. Correct. You will not go back. It will hit, the change will hit the current year, and going forward the change will continue. That and the varsho profit then it will goes to your retained earnings. Then component, we have a comparison of the cost allocated to the component to the total cost of PP&E, and that's what we told. If your component you identify a separate useful life, then depreciate it using the separate useful life, and you have to review your component whether it is the useful life continues to be same or whether you want to accelerate it further. So disclosure requirements, we have what we need to disclose is your measurement basis, your depreciation method, your useful life, then what is your total carrying amount and accumulated depreciation, and other disclosures is whether there is any restriction on the title of PP&E, whether the construction cost is recognized at the carrying value, your contractual commitments, all these are related disclosures. So there is a couple of case studies, but if you want to, we can go through, otherwise we can break for tea, because whatever we read as concept, there are some examples here, but there are simple examples only. I leave it to you. We can break for tea, or if you want to go through, we can go through. Yeah, because they were, I actually rushed it through very fast. Beyond this, I cannot compress. No? You can change, sir, but again there should be a reason of why there is a change, and then that has to be, the impact has to be disclosed. But again, you can't, year on year, you can't keep changing it. Once you decide you go for the change, then you have to clearly, vice versa, both you can.
So I'm going to take a very interesting and simple standard, IND AS 116 leases. So I've tried my best to keep it very simple, and I'm happy to answer all your questions. So we'll begin with what doesn't come under IND AS 116. So one is leases to explore for use of minerals, oils, natural gas, and other similar non-regenerative resources. Then leases of biological assets is not covered over here. Then service concession agreements, which is coming within the scope of Appendix D of IND AS 115, and licenses of intellectual property granted by lessor within the scope of IND AS 115. And the last one is rights held by lessee under leasing agreements within the scope of IND AS 38, that is intangible assets. Okay. So there are two more exemptions, recognition exemptions. So the one being short-term lease and the other being lease for which underlying asset is of low value. So I call it as low value lease. Okay. So what is an underlying asset can be low value only if the lessee can benefit from use of the underlying assets on its own or together with other resources that are readily available to the lessee. That means lessee should be able to use the asset exclusively by itself. And the second is the underlying asset is not highly dependent or highly interrelated with other assets. If an entity applies either of the exemption, it must disclose the fact and certain information to make the effect of the exemption known to users of its financial statements. So I'll quickly summarize it. Short-term lease term is less than 12 months. There is no purchase option. Factor in lease option to terminate or extend lease if exercise is reasonably certain, and then it should be applied consistently. And the second, for low value leases, it's based on the value of equivalent new asset it's not determined by materiality. It's made on a lease by lease basis, and the leases can benefit from the use of the asset. So the most important criteria is the lessee should enjoy the benefit from the use of the asset, and underlying asset is not highly dependent or interrelated to other assets. Yes, you have to treat it as an operating expense. Okay, now let's get into the definition of lease. Okay, so a contract is or contains a lease if the contract conveys, first is the right to control the use of an identified asset for a period of time in exchange for a consideration. Okay, what is an identified asset? An asset can be either explicitly specified in the contract or implicitly specified at the time it is made available for use. So I am stressing on the word identified asset to determine whether that asset will qualify for a lease or no. Yeah. Okay. So how do you assess whether a contract conveys the right to control the use of an identified asset? So to assess this, an entity shall assess whether throughout the period of use, the customer, that is the lessee, has both of the following. The first, right to obtain substantially all the economic benefit from the use of that identified asset. And the second one is the lessee should have the right on the direction to use. He should be able to use the asset on his own. Any questions on this? Because I'm going to take examples in the next slide. Okay, so we'll go to the next one. So this is a broad summary, to determine whether it's a lease or not. Whether a contract is a lease or it's not a lease. So first one, is there an identified asset? Yes. Okay, does the customer has a right to obtain substantially all or the economic benefit from the use of the asset throughout the period of use? Then the next question is, yes, does the customer, the supplier, or neither party have the right to direct how and for what purpose the asset is used throughout the period of use? If it is not predetermined, then does the customer have the right to operate the asset throughout the period of use without the supplier having the right of change? So what does it mean is the lessor should not have any right once he is leased out the identified asset to the lessee. And the last condition is, did the customer design the asset? So I have a beautiful example over here to explain you the last point. And if in either of the cases, if it is a no, then it's not a lease under IND AS 116. As Sir rightly told, we need to do it as an operating expense. No, we'll come to that. Yeah, so in IND AS 116, in the books of lessee, there is no distinction between operating lease or a finance lease, only in the hands of the lessor. Okay, so what is identified asset? That is the substitution rights. So as I told, the lessee, to keep it very crisp and clear, the lessee should have the entire right and control of the use of the asset. He should have the direction to use the asset. So over here, what it says is a supplier's right would be substantive if both the following conditions are met. That is, if the supplier has the practical ability to substitute the identified asset to an alternate asset throughout the period of use, and the supplier would benefit economically from the exercise of the right to substitute the asset, then it will not come as a lease. Because to qualify as a lease, the lessee should have the right and the control. To keep it very crisp and clear. Okay, in situation where it is not readily determinable whether a supplier has substantive substitution right, a customer shall presume that any substitution right is not substantive. Okay, I give you a scenario over here. So a customer enters into a 10-year contract with a freight carrier, that is a supplier, to transport customers' goods. The contract requires the supplier to use rail cars of a particular specification and it will require 20 rail cars to transport the required quantity of goods over the 10-year term of the contract. So supplier has a large pool of rail cars that can be used to fulfill the contract. All rail cars are stored at supplier's premises when they are not being used to transport goods. Cost associated with the substituting the rail cars are minimal for supplier. Is this a lease or no? No. Yes, I think absolutely right. So in this case, the contract does not contain identified lease. The supplier has a large pool of rail cars available and it can use any of the pool to satisfy the contract. So if in contrast, the rail cars was stored some distance away at, say, the customer's premises, such that supplier would have to incur significant cost to substitute those rail cars would outweigh the potential benefits of substitution, then the substitution would not be substantive. It would then be necessary to consider the other aspects as per IND AS 116. So, is the portion of an asset physically distinct? If in the contrasting scenario, yes, because then it is an identified asset. No, it might be a lease if it represents substantially all of the capacity of the asset. Supplier. Yeah, no, I am talking in the books of a lessee. Yes. So if the 10 rail cars are in the control of supplier, that is, it's in supplier's warehouse, he is directing how to use that asset just to fulfill the contract, it will not be covered under IND AS 116. If those 10 rail cars is with the lessee, so those 10 rail cars is exclusively for the lessee, and if there's a significant cost for the supplier to replace those rail cars, then in the books of lessee, it will be taken as a lease, IND AS 116. Correct. Okay. Yes, I will come. I will come to your... Right now, I'm speaking in the hands of lessee. Okay. For lessor, it is two things. You need to determine whether it is a operating lease or it is a finance lease. If it is an operating lease, it will continue as a rental income and there is a corresponding asset depreciation in his books. If it is a finance lease, he will bring down his assets. He'll create a net investment by doing present value of future lease receivable, and he will recognize the profit and loss in his books in the year when he's giving out the finance lease. Yes. Yeah. Yes, correct. Both. Yes. Same. We'll come to that. Right of use asset. We'll come to an example in the later slide.
I've read, I vaguely remember reading, banks. I vaguely remember reading, they have delayed adoption of IND AS series to banks because, the impact of this particular standard is going to be high.
Sorry, so the impact of
this particular standard on banks,
okay.
or possibly, they will have to recognize more assets and the return on capital employed will drop. So I just wanted to know, banks entering into normal rental agreements. So it should be more than 1 year. Definitely they will not enter this year. Will they be forced to show it as a leasehold property? Or will they have to recognize it as a right of use asset? That's the first question. Then the second thing I remember is this ATM machines. possibly that's also on a lease basis.
Okay.
Maybe what do you, especially the rental agreements, will they be forced to treat it as an ROU asset?
Okay, so over here, what my understanding is, the bank is taking rental premises on lease. First question, and second question is, banks are also taking
ATM machines also are possibly on rent.
rental
But,
basis.
Maybe they will avoid owning it.
Okay, okay, got it. So the first thing you need to determine is the term of the contract. So as I told you, if it's a short-term lease and if it's a low-value lease, you can do, the banks can take it as an operating expense in their books. Okay, so for example, we'll take renting of a place. For example, this hall. If bank is renting this hall, then yes, definitely they need to create a right of use of asset.
They said, it's going to be a huge impact. So 15,000. So SBI will have, say, 15,000 branches. Maybe that's phone, but the private sector, it's going to be a huge hit. The balance sheet will change. Yes. But I remember vaguely reading it, but after that I tried searching, for my academic this one, but I couldn't locate it. So otherwise, which is advantageous? Maybe they'll have to redraft it as a, every year, the 11 months they're going to renew it. I think that will be a better option, rather than.
No.
No. It will be amortized.
Balance sheet size will go up, and your return. Your ROCE will look small.
So right now, as I think the break also we discussed, the IND AS is still not applicable for banks, as you said. When IND AS itself is not applicable, this concept is not applicable for banks itself. And that is the reason why ROU is not, if IND AS is applicable, then they have no choice but to recognize the ROU asset in their books for whatever examples, whether it be ATM machines or whether it be the places that they rent out for branches, everything needs to be capitalized. The reason why banks are still not adopted, as far as I understand, is that, it's governed by the Banking Regulation Act 1949, and still they have not given that leverage to still adopt this IND AS, because that gives the set of the way in which the financial statements has to be prepared and presented for the users, right? And so their government is still working with the
possibly that ECL also expected.
Everything. The moment you adopt IND AS, make it applicable. There are a lot of concepts in IND AS like fair value measurements, the ECL, the ROUs, everything. And the banks, as you said, because of the volume and the complexities involved, it's not going to be easy for them to adopt so quick. And they have to get a lot of preparedness for these purposes. And then probably they will put it on implementation path. So that's the reason why it's still not done. And in that situation, the banks continue to follow the erstwhile accounting standards. And in that, there is no concept of this in ROU asset coming in place. And they continue to show it as an expenses, not as an asset. That's the...
But
for complete banks,
But surprisingly, they have adopted it first for NBFCs.
NBFCs it is adopted. Small finance banks also accepted, like small finance bank which comes under the NBFC category. But banks, it is not, because RBI has deferred the application of this particular IND AS, and still the date has not finalized for the applicability. The reason being, as he said, a lot of volume and other public private banks,
banks and insurance companies also not
small finance bank, yes.
But NBFCs it's adopted.
Small finance banks irukku sir, na adha check panni solren, but NBFC definitely, because I am doing an NBFC, I have seen ROU assets on the balance.
Okay, we'll move on. So, okay, what is a right? Okay, so coming back to the conditions, so there should be an identified asset, and then the lessee obtains substantially all the economic benefits, and the lessee should have the direct use of the asset. So I'll take an example right now. For the lessee is enjoying the substantial economic benefit. So the scenario is, a retailer enters into a contract with a lessor for the lease of a retail space in a shopping center for 5 years. The lease payments are equal to 20% of the gross sales revenue of the sales. the lessee has the right to determine which product are to be sold and the design of the store. So will this get covered under substantially economic benefit being flown to a lessee? So yeah, okay. In this case, it is the customer's control and use of the property which generates all of the sales revenue. So the lessee has a right to 100% of the sales revenue generated from the store. So this represents all of the economic benefits that will be generated by the store over the period of use, even though it has negotiated a contract which results in rental payments being a percentage of sales revenue. So this type of contract term is common in lease of retail real estates. So I'm just trying to convey that the lessee is having substantial economic benefit. Yeah, correct. I'll take a second scenario. So there's a very interesting scenario. So customer enters into a 10-year contract with a power company supplier to purchase all of the electricity produced by a new solar farm. So supplier owns the solar farm and will receive tax credits relating to the construction and ownership of the solar farm. And the customer will receive renewable energy credits that accrue from the use of the solar farm. Now, the question is, who has the right to obtain substantially all of the economic benefits from use of the assets throughout the period of the use? Lessee, yes, absolutely. So the customer has the right to obtain substantially all of the economic benefit from use of the solar farm over the 10-year period because it obtains the electricity produced by the farm over the lease term, that is the primary output from the use of the asset, and the renewable energy credits which are a byproduct from use of the asset. So although the lessor receives economic benefit in the form of tax credits, these economic benefits relate to legal ownership of the solar farm. They are not derived from the use of the solar farm and therefore are not relevant to the assessment of economic benefit. For IND AS 116, as you guys rightly told, the lessee enjoys the identified asset. Okay. The next question is on the right to direct the use. So who has the right to direct the use of the identified asset? So if it is a supplier, the contract does not contain a lease. If it is predetermined due to the nature of asset, further analysis will be required on case-to-case basis. And if the customer has the right, then its contract contains a lease. I'll just take a scenario over here. Okay, so customer enters into a contract with a supplier where the customer will purchase at least 80% of the energy produced by a biomass facility. The contract specifies that energy must be produced from this particular facility. The supplier is responsible for building, operating, maintaining the facility to the customer specification. The customer designed the biomass facility before it was constructed and hired experts to assist in determining the location of the facility and the engineering of the equipment to be used. There are no decisions to be made about whether, when or how much electricity will be produced because of the design of the asset has predetermined those decisions. Okay. Any answer? Yeah.
It will be a lease and they will have to recognize it as an ROUs.
Sorry, I couldn't hear you.
It's a lease and they will have to recognize it as
Yes. Yes, absolutely. The reason is, so neither the customer nor the supplier has the right to direct the use of the asset during the period of use because the functionality of the facility is predetermined based on its design. And however, the customer design of the biomass facility gives him the right to direct how and for what purpose the asset is used. So the customer's control over the design is equivalent to the customer having control over these decisions. In addition, as the biomass facility is clearly identified and through the purchase of 100% of the energies produced, the customer obtains substantially all of the economic benefits from the facility. The contract contains a lease. Yes, it's a lease. Yes. He has to determine whether he is finance lease or yeah.
So just one doubt. So there could be transactions where the lessee will treat it as an ROU asset, and even in the lesser, it will be treated as a financial lease. That is, he will also recognize it as an asset.
Okay. Not all the time.
It can happen.
It can, yeah.
It need not be ROU asset. So naturally, it need not be an operating lease then.
Correct.
It can be.
Yeah. No, that they will not have an asset. No, in lessor's books, he will de-recognize the asset and he will record a finance lease receivable.
No, it's possible if it's a. So there is a case, where in the lessee books it will be an ROU. It will classify as it's not a short-term lease, so it will be an ROU asset. So he's recognizing it as an asset, and in the lesser books, when he assesses, it will classify as a financial lease.
Correct.
So he will have to.
No, he has to de-recognize his asset and show a finance lease receivable.
Or alternately, it can be also. Can it be an operating lease? No.
Yeah, it all depends on the risk and reward being transferred. Yeah, financial. No. It will be split. Okay, go ahead, sir.
So just to clarify the concept as a lease on the whole, right? I'll just take 2-3 minutes so that it clarifies a lot of questions over here. Let's understand the background why the standard came, right? For example, an airline operator like Indigo, they don't own the assets, the plane. What they do is that somebody owns the plane and they take it on a lease, long-term lease, let's say 20 years lease. When you look into the balance sheet of Indigo, you will be surprised to see that they don't have an aircraft in their fixed assets schedule. So, which is why this actually came up, right? As a concept of, in the form of a lease, where it says that, okay, when I look into each aircraft, as you know, it's about 100 crores. But when you look into the balance sheet of that Indigo or any airline operator, it will be like a very light balance sheet. It will not be reflecting thousands of crores of assets in their balance sheet. So, then this concept of right of use assets came, that what is happening actually? I take into 20-year terms of lease, right? And what happens? I only recognize as an expense in my books and they show as an income in their books, the lessor. So then they globally then they said no, under IFRS they had this concept of right of use because I actually use the entire aircraft's life and I consume it as a lessee. It's right for me to show that in my balance sheet and reflect that I have so much of right of use of asset by entering into this contract, right? That is the reason why he said, okay, they brought the concept of, that's the reason why he defined as it's a contract and an identifiable asset, and it should be like the economic benefit should flow to the lessee, right? The economic benefit comes with the control, right? Yeah, you will, once you capitalize. So what is this right of use asset? Right of use asset, it is technically an intangible kind of thing. Though it's not intangible, it's not physically with you. It's not a physical one, it's a notional one. It's a right of use. It's only a right of use. I have the right to use that asset for a particular period of time. I put a value to it and capitalize in my balance sheet. So that's how it is. Now, some of these, so this is the concept of lease, right of use, the standard. So then it essentially applies only in the case of the lessee because he acquires the right of use. So he capitalizes it in the balance sheet by way of a right of use asset. For lessor, in this, my example, the aircraft is still owned by the supplier. In this case, we call it as a supplier or a lessor, right? Now, according to that old standard, whether he is giving away fully the right and treating it as a finance lease, that concept still prevails in the books of the lessor. If he is giving away entire right at 95% of the value for long term, the entire useful life of the asset, and there is no benefit out of it coming to him, then he will treat it as a financial risk and he will de-recognize in his books, and it will be like, or if it is not the case, then it will be like a sitting in his books as fixed assets. The question or the confusion comes whether is it an asset in the lessee books as well as in the lessor books? Yes. For example, I take a simple example of, you take this property which may be having a life of 60 years, but you give it on a 5-year lease to somebody here, right? By giving 5-year lease on a non-cancelable basis, right, you are giving the right to use to the lessee for 5 years, and you don't have a control for that 5 years. That doesn't mean that you are not the owner of this property, and it still sits in your books as a land and building, as an asset in the lessor books. Whereas in the books of lessee, it's only the 5 years of right to use that you are getting a right to use for 5 years. Only to that extent it will get capitalized in his books as right of use asset. So it is possible that a same asset will be sitting in the books of the lessor as also a PP&E, and in the books of the lessee also as a right to use for a limited period of time, right? Value is again that comes in the contract, the lease terms, lease contract. You will have to, let's say you enter into a contract for 1 lakh per month and it gives 12 lakhs annually, and 5 years is 60 lakhs, right? That is the value in which you capitalize. However, because it's a 5-year period, the discounting rate will apply and you will book it, bring it to the present value and capitalize it on the date.
Okay, so let's recap. So the 3 important points I was focusing till now was, there should be an identified asset, there should be a substantially all economic benefit being flown to the lessee, and the third one is the lessee should have a right to direct the use the asset. Land in what, like lease? No. Yeah, no. I cannot hear you, sir. No. Land doesn't get covered, sir. Yeah. Yes. Yeah. Yes. So it will be amortized over a period of the duration of the lease term. Yes. Okay. So let's summarize. I've come back to the old table which I showed initially. So is there an identified asset? No, it's not a lease. If it's there an identified asset, then does the lessee has the substantially all the right of the economic benefit? No, then it's not a lease. If he has, then does he has the right to direct the use the asset? If it's no, I mean if supplier has the right, then no, it's not a lease. If the customer has the right, yes. And then the right to operate, if it is predetermined, then it needs to be further seen. And the third one, I mean the last one is the design. We had an example over here which we discussed on that solar thing. So even if the lessee is designing and he's structured everything, then yes, it will come as a lease. Now we'll get into case studies. So the background is, an automobile company intends to operate a small desk in the airport to sell and advertise its cars. The company entered into negotiation with the airport terminal operator, OTG, and they recently signed a contract in respect of the same. The contract provides the company with the right to use a space in the airport to advertise and promote its cars. The contract is for 3-year period, which is commencing now. The contract terms and conditions note that the company will have access to an area of space equal to 10 square meters, and space will be located outside the main arrival doors in any of the several terminal buildings within the airport. The contract also states that OTG will retain the right to change the location of the space allocated to the company at any time during the period of use. OTG will incur minimal cost in respect of a relocation. The company can use the space in whatever capacity they require. Is this a lease? No, okay. This is not a lease because the area of space the company uses, yes, is specified in the contract. The actual location of the space is not specified. in the contract and can change at the discretion of the supplier. That is, it can change at the discretion of the lessor. So therefore, this is not a identified asset specified in the contract. So it's not a lease.
So the contract is for 3-year period.
So
Is very binding 1 year, 2 year, 3 year for lease?
see, short-term lease generally it's presumed 12 months and less. So you need not even come into IND AS 116. Yeah.
More than 1 year means all the other things.
So you have to see all the conditions,
Just to again add a more relatable example which we all practically see is that your clients may have a transport contract for transporting the goods out of the factory to a customer's location, right? Now, just think about an analogy of this to that. If there is a contract with the transport providers to provide 20 lorries or containers to transport the goods, then in general, it's not a lease. But if the contract specifies saying that a 50-ton container of a particular category, of a particular specification with this so-and-so registration number should be allotted to me, specified, allotted to me, which means that that transporter is not able to use that vehicle to anybody else, right? Full control, that's what it's called as a substantive right. The substantive right coming out of that asset is actually conveyed to me as a lessee, as a contractee, right? So in that case, then this contract is containing a lease arrangement, right? That's the subtle difference, or one has to understand. It's more practical and easy to relate. That's why I thought I'll share this.
Yes, yes. Lease period will be there. Yes. Yes, absolutely. We'll go to the next case study. So, an automobile companies enter into a contract with a manufacturer to purchase a particular type, quality, quantity of an automobile part for a 3-year period. Identified asset is the factory which, that particular factory can manufacture that part. The substantive substitution right, there is no alternate factory available, and the customer has the right to control the use of the identified asset. So customer does not have the right to obtain all of the economic benefit from the use of the factory during the contract period, because its output does not represent substantially all of the output of the factory, and supplier can use spare capacity to supply other customers. Will this scenario come under lease in IND AS 116? Absolutely right, ma'am. Because the customer is purchasing an part. Okay, the next case study is an automobile company enters into a contract with an information technology company for the use of an identified server for 3 years. So the identified asset is the server, though there is no substantive substitution unless there is a malfunction of the server, and the customer has exclusive use of the server and is enjoying the benefit of it. Will this qualify as lease in IND AS 116? Yes, absolutely. The next case study. So, contract between customer and a freight carrier. Yeah. Lease of the server for the contract period. Yes. Because there is a 3-year contract period, right? Okay. It's a lease. Yeah. Okay. Case study 4. So, there is a contract between a customer and a freight carrier. It provides customer with the use of 10 rail cars of a particular type for 5 years. Supplier also provides engine and driver when requested by the customer. So what is an identified asset? It's a specific rail cars identified in the contract. Is there any substitution? Can be substituted for repairs or maintenance, and customer has exclusive use of the rail cars during the contract period, so that it has the right to substantially all of the economic benefit from the use of the cars. So customer has a right to change how and for what purpose the cars are used. It directs when and where the cars are used. So is this a lease under IND AS 116? No, yes, because it's lease of rail cars. So there are two separate contracts. The first one is the rail cars, and then in addition to that, the supplier will provide engines and drivers on need basis. So the primary thing is on the rail car. Yes. So on the rail car, it is a lease.
But it can be substituted for real maintenance.
Yeah. So see, supplier does not have a right to substitute. Like he cannot easily substitute. There will be an economic outflow for him, and substitution will only happen when there is a repairs. This customer.
When a repair or maintenance comes in, it will be done by some other, whatever is that required to be done. But we are talking about that rail car is specifically used only by customer.
Yes.
So this is something like a coffee machine.
Yeah, you can take that with. Yeah, you can take for a rent for a period of 5 years. Huh?
Period is not specified.
No, it's specified, right, for a type of 5 years. Okay. So, okay, we are coming to the next scenario. So, what happens when contracts with multiple components? So, there are two aspects over here. So, a contract with multiple components can be lease and non-lease components. So, what can be a non-lease components is something when on the need basis, just like how we saw in the previous example. And the second one is multiple lease components. So, there might be one contract which will have multiple lease components. So, in those cases, what we need to do is we need to determine the standalone selling price of those multiple lease components in the single contract. So how will we determine? We have to use our estimation method, which is like adjusted market assessment approach, then expected cost plus margin. It's based fully judgmental. Okay. So next one we go is what is a lease term. So as of now, we are clear with what is an identified asset, who has a economic, who is enjoying the substantial period of the economic benefit of the asset, and who has the right to use the asset. Now the next two criteria for us is the term, that is the lease term, and the consideration. So I'm coming into the lease term. So what is a lease term? The lease term is determined at the lease commencement date based on the non-cancelable term of the lease. That is including period covered by an option to extend the lease if the lessee is reasonably certain to exercise that option, and the periods covered by an option to terminate the lease if the lessee is reasonably certain not to exercise that option. For example, over here, so there is a corporate XYZ which is taking a floor in a business complex for a period of 5 years with 3 years of lock-in period and 2 years of, what do you say, he can continue for further period of 2 years at his discretion. So over here, the lessee can take the term as 5 years because there is a non-cancelable period, and second is he is sure that he is going to continue for the further period of 2 years, and he has the control whether he is going to renew the lease or no. But if I change the scenario wherein after the end of 3 years, the lessor also has a right to terminate the lease, then you should restrict for IND AS 116 until the non-lease cancelable period. Yeah.
First case also what you said?
Lessee.
Lessee.
Yeah.
That case also it is IND AS 116.
Yeah, because in the balance 2 years, the lessee has an option to extend. But primarily, even though the agreement is for 5 years, the first 3 years is for, you cannot terminate the contract. After 3 years, if you want to terminate, you can, lessee has the option, but lessor does not have the option. So lessee is certain that he is going to stay for 5 years, so he will consider the term as 5 years.
If the lessor demands that you pay the remaining rent if you want to take before the end of 5 years, from 3 to 5 years, then is it a lease or?
So, okay, so this is something where, okay, you are determining the lease term at the commencement date. So this is something events happening after commencing the lease. So for example, after 2 years, the lessor says, you vacate and go. But according to the lease, I mean the agreement, they cannot terminate the lease for the period of 3 years. Okay, so ma'am, your question is whether the lessor demands to terminate during the 3 years? Okay. Yes. Lessor will not pay, no ma'am. Lessee will pay. Yeah. 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 Yeah, then you need to de-recognize the ROU and yes. Non-cancelable period is 3 years. Yes. I've just given an example. Okay. So again, just summarizing, determining the lease term. So that is the non-cancelable period of the lease, extension option if reasonably certain to exercise, and the termination option if reasonable certain not to exercise. So in the same scenario, what happens is first 3 years is non-cancelable period, then the next 1 year option is with the lessee, and in the 5th year option is with both. So you need to see, if I would like to take a stand, I will take 3 plus 1 year, because lessee has the right until the 4 years. So the 5th year will be very judgmental based on the situation and the facts. Correct.
So who will actually do all this?
Yes.
He's signing, right? He's the person who ultimately. No, India is at just compliance.
Okay.
Line by line, they have to do.
So we'll come to the next. Okay, so we'll come to the next part, that is accounting by lessee. So the recognition and measurement. So if all the criteria falls, then we need the lessee has to recognize a ROU and a lease liability. Now the next question is the amount. So lease liability will be at the present value of the following components that have not been paid at the commencement date. So that is fixed payments less lease incentives receivable, then variable payment, residual value guaranteed, and exercise price of purchase option and exercise price of termination option should be your lease liability.
How do they do this when a lease payment is connected to your revenue?
Okay, I'll come to that. That is the variable payment. Yes. So for variable payment, the payment vary only according to an index or a rate. Then only you can take that component for your lease liability computation. So it should, for example, over here, the portion of payment made by a lessee to a lessor for the right to use an underlying asset during the lease term that varies because of change in facts or circumstances occurring after the commencement date other than the passage of time. So over here, my initial recognition will be on the lease payment. So I have an example. I'll show you, maybe with that example, you'll be able to get a clarity. And okay, I'll go to the example. So yeah. So a new lease contract where Market Fresh enters into a 10-year lease of a building to be used as its head office. So annual rent payments are $100,000 payable annually in advance, but will increase every 2 years on the basis of the increase in consumer price index for the preceding 2 years. So CPI at the commencement date is 125 and at the end of 2 years is 135. So how is the lease liability accounted for? So at the commencement date, you will pay $100,000, which will be received annually for 10 years. You will do the present value of that. So at the end of the second year, that is beginning of your third year, what you're going to do is you're going to remeasure the lease payments for the balance life of the years. So what you will do in this instant case is you will take $100,000 into 135 divided by 125. So that will be your expected cash outflow over the remaining period of the lease term. And then you will do the present value of that and you will remeasure your lease liability and ROU at the end of second year. So the variable pay should be linked to a rate or an index. Yeah. Okay. So discount rate. So what rate should be taken? So if it is specified in the lease agreement, we should take that rate. If that is not specified, we should take incremental borrowing rate. I mean, that's a general practice which we practitioners follow. Okay. Then the next question is the recognition of ROU, that is right of use asset. So that will be my total lease liability plus payments made to prior to commencement. For example, interest-free refundable deposit given to a lessor. What we do is we do a present value of that. So I said, sorry, incremental borrowing rate by the company. Okay.
That's what is meant by interest rate. So you do the fair value of asset and you backward present value of capital. Find out the, go and seek the interest rate that will be
the. Yeah. And then you will add the initial direct cost to take that asset, then cost to remove or restore minus lease incentives received. That should be the value of my right of use asset. I also have an example I will show you over there with numerical numbers. Deposits, advance. Yes, yes. So when will we revise the discount rate? Only in two scenarios, that is when there is change in the lease term and then when there is a change in the assessment of an option to purchase the underlying asset. So if the rate is available in the lease agreement, we will take that rate, otherwise we will take the incremental borrowing rate. And then coming to recognition and measurement, so this is an example. Through example, I would like to show you what will be the amount in my lease liabilities and ROU. So entity XYZ, a lessee, enters into a 5-year lease of a floor of a building with a 5-year of extension option. So lease payments are INR 50,000 per annum, all payable at the beginning of each year. To obtain the lease, the lessee incurs initial direct cost of 20,000, that is 15,000 paid to the former tenant occupying the floor and 5,000 as commission. The terms of the lease also require entity XYZ to pay the lessor 2% of the gross sales revenue generated from the space being rented. Now, entity XYZ concludes that it is reasonable certain that it will exercise the extension option. The rate implicit in the lease is not readily determinable. The lessee has determined that its incremental rate of borrowing is estimated at 5%. So, if you see the fixed payment of lease, less the incentive receivable for me will be rupees 50,000 plus 50,000 paid annually over a period of 9 years, for which I will do present value. This sums up to 3,55,391. Okay, it's over here. I think, yeah. Okay, and then yeah, there was some variable component, if you see in the previous example, that he will pay 2% of the gross revenue. But as I said, it should be linked to a index or a rate.
So then this is not applicable?
No, this is not applicable. So it will be 0 for me. We cannot determine, exactly. So my sum variable payments will be nil, my residual value guaranteed will be nil, everything else is nil. So my lease liability will be 3,55,391, for which I'll have a corresponding ROU.
Lease term is 10 years.
Huh?
In this case, lease term is 10 years.
Lease term is 10 years.
What about advance without advance years?
So my example is without advance, but I'll come to that ROU. So if you see the question states that 50,000 is paid annually in the beginning of the year.
Could you just quickly run through the 355 number? What you
Yeah, okay. So 355 is nothing but 50,000 rupees paid over a period of 9 years into present value. I'll come to that. No advance payment. This is a lease rental payment.
You are paying only 9 times, no? See, 10 years lease.
Correct. Correct. So first year, why will I do present value when I'm paid in the beginning? The time value of money is 1, right? So that won't be present valued, right? Clear, sir? Yeah, simple. So my contract is for 10 years. The first year I pay upfront payment of 50,000, sorry, 50,000. And for the next 9 years, I'll be paying in the beginning of the year. So for the 9 years, I should do present value. Yes. Yeah, 50,000 plus 50,000 will go to my ROU. Yeah. Okay. So this will be my entry. My right of use of asset will be 4,25,391, which consists of 3,55,391 plus 50,000 paid at the initial date, that is the beginning of the commencement of the lease, and my upfront indirect cost of 20,000. So this 4,25,000 is my right of use of asset on the commencement date of the lease. My lease liability will be 3,55,391, and I'll have an outflow of 70,000. So present value of 9 payments at 50,000 discounted at 5%.
That is only 3 lakh.
Yes. Yes. And my cash outflow on the commencement date will be 50,000 rupees plus 20,000 the direct cost. So what happens in terms of subsequent measurement and remeasurement? So subsequent accounting is similar to other interest bearing liabilities except for more specific guidance on remeasurement. That is the initial value, interest carrying value minus lease payments plus measurements. So until now, if you're following based on the commencement date, the first 3 boxes will click in. The last remeasurement will happen when the instance takes place during the term of the lease. Yeah, for example, at the end of the 4th year, the lessor says, okay, I want to renew the lease for the further period of 3 years. So again, you will remeasure the lease at the end of 4th year. And then when there's a change in term, you have to see the borrowing rate as on the increasing the term of the lease. Then coming to the right, yeah. No, ma'am. Revised rate will take only when there is a change in the lease term. Inception. Correct. Yeah, as ma'am told, if you go and purchase a similar asset, what will be the rate taken from the bank? So that rate you need to take.
For this new borrowing?
Yeah, for this new borrowing, exactly.
So if this company has cash credit limit now, straight away I cannot use the cash credit limit.
No, but cash credit is taken for short-term working capital, right? No.
Akash, if the lease contract contains total 60 months.
60 months. Okay, 5 years. Okay.
And the initial 6 months has a rent-free period. How it has to be?
Yeah, so rent-free period will be considered as your lease term. So, for example, it's a 60 months contract where the first 6 months you need not pay anything. So, you will anyways consider those 6 months as a term of the lease, and you will discount the 7th month based on that discount rate, the 7th month discount rate.
So part of the year.
Yeah, part of the year.
But that is considered as a lease term.
Yes, that is considered as a lease term because.
Similar to the refundable security deposit.
Yeah.
Does it take some nature like that?
No, see, refundable security deposit, you will discount it on the beginning itself. So what happens is, so in a lot of industrial areas, industrial warehouses, they give 3 to 6 months as rent-free period so that the lessee can come and put its infrastructure. And they are charging a consideration. So it is presumed that consideration is also a component for giving the lease for the first 6 months. Okay, so okay, I'll come. So what happens is my lease liability. So I'll take an example of 3,55,000, which we had in the previous example. That was my initial value of lease liability. Then I will add the interest for the year, and then I will reduce my cash outflow to the lessor. And if there is any remeasurement during the year, will come in the last bucket. So every year on year, the lease liability will reduce.
What about asset side, sir?
ROU, so ROU, you will have a depreciation. So for the next period of 10 years, the 4,25,000 will be amortized over a period of 10 years on a straight line basis.
This liability asset mismatch will be there, sir?
Yeah, it will be mismatched, but at the 10th year, it will square off.
Oh, both will be, sir.
Yeah, both the liability and the asset side will become zero.
Any year asset will be there, liability will not be there. It will not happen.
No, it will happen only when that is you're terminating the lease. So you will anyways de-recognize the entire liability and asset. So coming to lease modification, so if there is any modification in the lease, okay, so you need to see whether it can be taken as a separate lease. So when it can be taken as a separate leases, the modification increases the scope of the lease by adding the ROU to one or more underlying asset, and the consideration for the lease increase by an amount commensurate with the standalone price for the increase in scope. So basically, to keep it in a simple nutshell, that if there is any modification and there is a new asset, then you need to take that as a separate lease. You need not add it to the existing lease.
Treat it like a separate.
Yes, treat it like a separate lease.
Old one will square off.
Old one will continue. So there's a modification. That means you're adding anything. When you're adding a new ROU, then you need to take it as a separate.
Even though it may be related to
Yes,
same
yes,
asset,
yes,
same lease.
yes,
And two ROUs will be.
yes.
Liability also two.
Yeah.
That option is with the.
No, the contractual terms
Yeah.
bring out clearly whether it is a separate lease or whether it should be considered as a modification to the original lease.
Lease agreement itself.
Yes. So I'm showing a presentation of leases in the books of lessee. So in the initial recognition in balance sheet, I will have a ROU asset in asset side, and I'll have a lease liability in the liability side. In my statement of P&L, I will have interest expense on the lease liability, and I'll have amortization of ROU asset under depreciation and amortization. And under cash flow, I will have my cash payments towards the lease liability during the year, and the cash payments for the interest being paid for the lease liability. Apart from that, I will also be having operating expenses, for example, short term and low value lease or assets taken, so that also will come under cash flow. And then in the subsequent recognition, that is after the end of 3 years, what are the components I'll be having is any additions to ROU, and then carrying value of ROU at the end of the reporting period, and the maturity analysis of the lease liabilities separately from other liabilities based on IND AS 107 requirements. And in your statement of P&L is the same thing. There is a depreciation, interest expense, short-term lease expense, low value of lease expensed, then the variable lease payments, where we had an example where 2% of the revenue will be paid as rental, and then income from subleasing, gain or losses arising from sale and leaseback. So these are like, just broad things I've included over here. And in cash flow, you'll have the cash payments during the period.
Cash payments for lease liabilities as financing activities.
Yes. So your lease liability, when you're making a payment, so it will come under your financing activity, right? Yeah. Investment sections of?
So normally when you buy fixed asset, that's an investment of.
Correct.
So here there is no impact on the.
Yeah, because my ROU is a notional asset, right?
But you're taking a financing activity, you're showing it as an inflow, am I right?
No, I'm not taking in inflow. I'm taking it as an outflow.
No, initial recognition.
Yes.
Same, assume you're taking the asset on lease on 31st March.
Correct. So, okay, so I'll tell you. So,
it's a notional.
it's a notional thing, it won't come. Correct.
So by showing like this, you will have a investment outflow, the impact on the cash flow.
because my cash flow statement basically says what is my actual cash inwarded, what is my actual cash outwarded. So it won't.
All the three things will come to the cash flow. For interest in accordance with IND AS,
Interest paid.
interest in accordance with
In,
these payments we are paying.
yeah, lease payments.
Then interest.
So other interest expenses will come under financing activities.
He's asking how is interest coming when these are lease payments. That's what is.
Okay. You want to take, sir?
So it's like taking a housing.
Yeah.
And when you pay,
No, sir,
like it will be
this-
the principal and interest.
No, sir. He is lesser problem. SC problem, what is the interest? He's only making the lease payment.
Every payment you are making, your account.
It's a component of interest also, no, sir.
That means
Come here. Yeah.
So all this interest and all is a
Notional.
Because ROE itself is a notional asset that is created, as I explained. So in the liability is also a notional liability. The actual outflow, not a notional liability, but the value which is carried is a notional liability. There is also the actual outflow that happens. All the actual cash outflows will be presented in the cash flow statement. Whereas this interest that is calculated on this lease liability is a notional interest that is calculated. And the depreciation that is calculated on the ROE asset is also a notional entry that is passed. So all these will not be considered from the cash flow perspective. Cash flow is only the
Actual cash payments.
that comes over here. Though it is spread into three different line items, but
In essence.
let me simply understand that, like how you pay a monthly lease rental, whatever is that will come in a cash flow.
But that monthly lease payment, a component of it will be interest.
No.
Yes.
Yes, sir.
Yes, because that.
Yeah, because
Now the lease payments is the actual
outflow. Yes.
So if I'm paying 2 lakh rupees monthly lease rental, maybe possibly 40,000 could be towards interest. 1,60,000 could be the amortization. No, both interest plus principal.
So typically that's what you are in both the EMI model. In an EMI model, when you repay the payment, there is an interest component and a principal component, as you say. It's not like that. That is not. This is the lease that I agree with them to say actually I'll pay you a monthly lease rental of 2 lakhs. Let's take a simple example of I pay 1 lakh as lease rental a month and 5 years, so 60 lakh becomes. So my cash
But initial recognition would be say 45 lakhs.
Right.
And later on, but actually your payout will be 60 lakhs. So that differential of 15 lakhs every periodically you will recognize as an interest expense. That will come in cash flow. No. Interest is operating. Oh no. So interest is financing. Interest is a financing.
Financing.
So this interest of the gap of 15 lakhs is unwinded over a period of 5 years. It's only a notional.
It's a notional calculation that comes up. But what actually happens is that 1 lakh a month and 12 lakhs annually and 60 lakhs over a period of 5 years is the actual outflow that's happening, which will come as the outflow in your cash flow statement. And this 15 lakhs which is going and hitting your statement of profit and loss over a period of 5 years. It's only a notional interest of unwinding that lease liability and bringing that lease liability is unwinded, and then that gets amortized to make it to 60 lakhs at the end of the 5-year period. So that's a notional entry which gets adjusted in the cash flow. That's why it's represented there in the appropriate section. But when it comes to the cash flow outflow, it's only that actual cash outflow that gets disclosed there.
Both.
Pressure. Yeah.
But incur interest cut.
That's for cash flow. So
Cash flow.
But how do we consider it in the cash flow presentation? Where will this principal component come? Where will the interest component come?
for the lease? Fixed amount தானே இல்லைன்னா interest principal எங்க தெரியும்
சார் ஆக்சுவல் பேமெண்ட் வந்து பிரின்சிபல் அமௌண்ட் தான் ஆக்சுவல் பெய்ட் எடுத்து இந்த கேஷ் ஃப்ளோ ஃப்ரம் ஃபினான்சிங் ஆக்டிவிட்டீஸ்
Separate term. Yeah. Okay. Next one is further disclosure in the books of lessee. You need to show nature of entities leasing activities and variable lease payments, extension option. It's all additional disclosures. And so these are just a broad level, case to case basis. There'll be additional disclosure. And I think with interest of time, I have to wind it up. Sorry. Okay. Yeah. Yeah.
So I wanted to ask, like, there used to be an old tradition. There used to be something called a pagdi system.
Okay.
Where suppose you take a shop in take an office in Sankarakrishnan. Okay. There is no question of any rental payments per se on a monthly basis.
Okay.
Right. And I pay up say 50 lakh rupees like a deposit. Okay, though it is a refundable deposit, okay, but it is that I will only pay that, and I'm not going to pay any further payment till my term for 10 years, 20 years, or whatever it may be. Okay, in that sort of a scenario, how now I have paid that 50 lakhs to my owner.
Got it.
And I have got the
Lease for a term of 10 years.
Term for 10 years.
Okay.
For 10 years, full use is mine.
Got it.
Right. So in this situation, what exactly
You're going to do?
Yes.
Yeah. So you just need to do present value of this 50 lakhs, record a ROU asset, and you need to amortize. Because you told it's a refundable deposit, you will get it back after the end of 10th year. Am I right?
Yes, absolutely.
Yeah. If you're not going to get back this 50 lakhs after the end of 10th year, you need to amortize this 50 lakhs over a period of 10 years. If in case it's not a refundable deposit. No. I just told if in case in the next scenario, if I take, yeah. No, but they're not taking any rental, no sir, for the next period of 10 years. They've only taken the deposit.
Initially he said no, a long-term leasehold land given by the government, right? You give it for 99 years lease and you make an upfront payment. Something similar to that what you asked for, right? So given upfront, you won't get it back. So there can be two scenarios where you get it back, you don't get back. As I said, in case of non-refundable or refundable, it just need to amortize over the period. And if it is a refundable one, then you also have to have a liability booked, which is also present valued, and then you will. There are two separate accounting that will follow. One is the ROU asset that will get amortized, prepaid as a prepaid, and there is a liability that you will also have you will record it, and you will unwind it over a period of 10 years in this case.
Thank you. Thank you so much.
I would like to just congratulate Akash. This is his first presentation here in SIRC, and he has done a great job taking a very complex topic like leases, and he's done a fabulous job, I guess. So he needs a round of applause again and recognition and more, encouragement for him to come up with more topics. Thank you, Akash.
CA RAGAVENDER Arulmurugan, Senior Manager in the Auditing and Assurance Practice. Over 10 years of professional experience in handling a wide range of audit and assurance engagements. Expertise spans across statutory audits, group reporting audits, and tax audits for clients across diverse industries, including manufacturing, information technology, automotive, and hospitality sectors. Strong technical capabilities in auditing in accordance with the Indian GAAP, IND AS, and IFRS. Experience in regulatory compliance under the Companies Act 2013, Income Tax Act, and the GST regulations. Also have accreditation in CAS, CISA, CFE, CMA, and CIA. With a short profile, I request Raghavendra Arulmurugan to take this session.
Good afternoon, ladies and gentlemen. My name is Raghav. Audible? Yeah? Cool. So my name is Raghav. I'm here to take a session on IND AS 38. Before that, first question. How was lunch? Lunch was good? Good. Okay. So generally, the session after lunch is used to be so interesting, you know. Like, so being a student, you know, when I was a student, I used to love lunch sessions because, you know, you master the art of sleeping with your eyes open, right? So I completely understand what you're going through, and the lunch was really good. So I'll try to make the session as interactive as possible, but where I would need your help is try to pitch in, share your perspective wherever you have something to share, any doubts or questions, please feel free to share, okay? And this session is a bit more interesting. It's not a complex or heavy topic as such, your 116 or 16, but it's a bit interesting, okay? Now, out of all the standards, I find this standard to be much more interesting, not because of its simplicity, but what it could be, right? India being a software tech developing country, right? This standard would be much more aggressive going forward. So your clients, whoever is involved in software tech, they're going to be using this standard, interpreting in so many different interesting way, which I'll take you through, okay? Cool. So the objective of the standard is first on the accounting treatment, definitions, and scope exclusions, recognition and measurement, research and development expenditure, retirements, and specific disclosures. Okay? Now, before getting into what this standard covers, let's just try to understand what this standard does not cover. Right? So basically, whatever that you see in other accounting standards, your intangible assets which are not within the scope of the standards, basically your goodwill, right? And financial instruments, your evaluation of exploration of minerals, which is a specific standard in IND AS 106, which I'll just touch base upon. And your intangible assets, I mean your inventory under IND AS 2, deferred tax assets, goodwill, insurance contracts, and non-current assets held for sale. Okay. So these are specific exclusivity because these are covered in other standards and not in IND AS 38. 38. Yeah. Okay. So what exactly is intangible assets? Anyone? Any wild guesses? What do you think could be an intangible asset? Okay. Brand value. Okay. Nice. Anything else? Physical substance. Okay. Nice. Anything else? Software. Good. Patents. Right. I think you guys are on the spot. It's good. I think you've covered every much. The clear demarcation of an intangible asset is that it shouldn't have a physical presence or physical substance, right? And it should be non-monetary. If it is a monetary item, it will be covered under financial instruments, okay? And it should be identifiable. What exactly is identifiable? Identifiable without physical substance and non-monetary. What exactly is identifiable? Anyone? Sorry? Let me just explain the question again. So you buy a computer, right? There's a hardware and the software. Is the software separately identifiable? Do you pay for the software? Okay. So does that mean that the software is identifiable? Right? So basically, identifiable is something, if you're able to sell the software, if you're able to transfer anything, any intangible asset, it should be identifiable. Okay. This becomes even more important when companies purchase assets which has both tangible and intangible components included into it. Okay, so whenever you start with intangible assets, the first question that should come is whether it is separately identifiable, right? Now, control over resource. Any idea? What do you mean? What do you think could be a control over a resource? Okay, ownership, right? Right to use, someone said, okay. Okay. Nice, okay. Anything else? Command value, okay, nice. Okay, so basically it's power to obtain economic benefits as rightly said, and restricting access. That's the key word I was expecting. You can't expect an intangible asset in your books if it's used everywhere by anyone else, right? So ability to restrict access. You should have control over the use of the asset. That being said, I'll just ask an interesting question before I jump on to that. Is ROU an intangible asset? You have right over the control of use of asset. What if I use a... Okay.
That is why there is an exemption in Schedule 3. That is, you don't mandatorily need to present ROU on the face of the balance sheet. You can club it again inside your PP itself. Okay. But there is no such communication that you can include inside intangible asset. That is the differentiation that they are drawing.
Nice, good one. Anyone else? Why do you think ROU is not an intangible asset? That's the right. Never question institute, okay? Never question your MCA. So it's covered in 116. No, that's what I'm saying. Never question institute. It's specified in 116. So let's cover there. Okay. So good one actually. So, but as he said, the absolute correct answer is what Sankar said. You know, like the tangibility in ROU, you can really have that tangibility, whether it's land or any assets. You have the tangible factor in the right of use of assets. So that's why it won't get covered under your IND AS 38. Okay, and the last one is simple: power to obtain economic benefits out of the intangible assets. Then that would be classified as intangible assets. Okay, either it should be revenue generating or it should be cost saving. Okay, so 3 words, please remember: identifiable, control over resources, and existence of future economic benefits. What do you think? Why do you... understood. Software. So let's see the first 3 conditions. Is it identifiable? Okay. Control over resource, do you have? Existence of future economic benefits. And the first line item, non-monetary without physical substance. Do you have a physical substance? Intangible assets. Okay. So, okay. Trade receivables, is it monetary or non-monetary? Car or a fixed asset building, is it monetary or non-monetary? Monetary, why do you depreciate that? If it is a monetary, why do you depreciate? Trade receivables depreciate, we will do that. Why? Monetary in the sense is that it should be it should be a financial instrument. It should be exchanged for cash, right? Can you exchange a building for cash? Yes, you can sell it and then exchange, but the liquidity factor is not there. I cannot exchange a building just like that. Okay, hence it is called as non-monetary. It is revenue generating, not cash itself. Okay, that's why it's called as non-monetary. So when I say liquidity, don't you consider, let's say, a security deposit given to when you rent a house, you give a security deposit. It is a financial asset itself. Would liquidity come into that? But it's still a financial instrument. Okay, liquidity is just an example that, let's say, cash or mutual funds or investments in stocks and those are all liquid, highly liquid. It can be classified as cash and cash equivalents per se. But trade receivables, again, it's not liquid, but it is It's a current asset which I can liquidate and then get cash into it. So that's the difference. If you arrange current assets in its order of liquidity, trade receivables will come at the fourth or fifth line item. Okay, it is a liquidable asset, not liquid assets per se, right? Non-monetary. Why do you think it's monetary? That's the example. So is building comparable to a trade receivable or building comparable to a bank account? What do you think it's monetary? Is bank account monetary? Right? Building is non-monetary. That's why your IND AS, so in your financial statements of balance sheet, we present non-monetary items first, fixed assets, intangible assets and everything. But your banks, non-banking financial institutions, they present on liquidity basis. They present assets first, current assets, your loan receivables and then whatnot. Right? Agree? Any? It should be separately shown as intangible assets. When do you see some circumstances where it can be shown as separately? So let's say a scenario, I buy a system, right? It's a hardware. This is worthless if there is no software installed into it. Right? Anything else? Any doubt? Okay, so certain brain teasers, okay? So this one is interesting. Blinkit. What is it? Is it an intangible asset? Okay, basically this is like a Zomato, Swiggy kind of 10 minutes delivery applications, okay? So Zomato acquired this for some, I don't know, 150 crores for this brand. It's an intangible asset, right? Etihad Airways sponsoring Chennai Super Kings. Is it an intangible asset? What? Not an intangible asset. Okay. I will get to that. Just give me 5-10 minutes. I'll just be done with this. I'll explain why it is a brand. Okay. What is this? It's a brand. What brand is this? Exactly. What is this exactly? Indigo, right? Why do you think they sued? So Indigo sued Mahindra for this tagline 6E. Right. So I'll consider this as intangible assets then, right? That's a good question. I'll answer to that. I'll just come back to that. Okay. What do you think? What do you think? Etihad Airways is sponsoring Chennai Super Kings. Okay. What do you think they will do? Intangible, is it? Sponsoring is just like an advertisement. If I just sponsor, I'm promoting my brand. I'm promoting my brand, not a brand itself. It can generate revenue, but it's not. You don't have a control, right? Control or separately identify. It doesn't fall under the definition of intangible assets, right? Okay, Netflix, not the brand, but let's say a new movie is sold to Netflix, like OTT rights. Is that an intangible asset? Anyone has a contrary view? Tangible. Okay. Why do you think it's tangible? Movie reels are tangible. I'm saying the movie rights. Can I just take that movie rights and then publish it in my YouTube website? I can't do that, right? That's why it's intangible. Bitcoin. Interesting. Anyone of your clients? So tangible. Tangible. Okay. Is this a intangible asset? As simple as it is. Okay. Okay, so the correct or the appropriate answer is IND AS 18 does not recognize cryptocurrency yet. Okay, but your international accounting standard consider this as a intangible asset because it is still not accepted as a medium of exchange or a medium of currency globally. If it was accepted, then it would be forming under financial instruments. Okay, so cryptocurrency for now, if any of your clients or anyone have, interesting though, but ask them to classify it under intangible assets. It is an intangible asset. Okay. Netflix, as in not the brand, the movie rights which has been sold, OTT rights, right? That's an intangible asset. It's an intangible. So suppose if I'm a movie maker or a movie producer, I make a movie, I sell it to Netflix without even releasing it in theaters. That's an intangible right. Right? Okay, so patent, I think fairly simple, it's an intangible asset. Satellite rights. The movie that you see in your Sun TVs, KTVs, whatever. Intangible, right? Nice. Got it? Spectrum rights. Intangible? Book publishing rights. Copyright. Intangible? Insurance expense. Okay. Is it identifiable? Yes. Is it non-monetary? Okay. Separate physical substance does it has? Okay. So contract copy though, then I can even say a software has a bill. It has a physical substance. Does it come under intangible assets? Sorry? Okay. Yeah, but intangible asset is, does it fall under intangible assets? Great. Your subscription. No. I'll answer. The point is to get interact everyone. I'll answer definitely. Okay. Your subscription to Zoho or Tally, is it an intangible asset? Okay. Subscription for 5 years. Okay. Okay. So answer to question you, sir. Do you have control over the subscription? Can you sell it? Can you transfer it? Can you transfer it? We can't, right? So would that fall under intangible assets? This is a classic thing, okay? Every clients do that, okay? So they buy subscription for 5 years, they classify it as intangible assets, okay? So, but it's basically any subscription to anything is a prepaid expenses, okay? So just make them show it under prepaid expenses and current and non-current, okay? So yeah, so Blinkit as a brand, it's an intangible asset, but yeah. See, where we are subscribing to that software, we're not buying that license, right? I'm subscribing to something where I can use only for that purpose, for certain time, exactly. I cannot, okay, let's say I have a system, it has Microsoft 365, okay? That's inbuilt into that, right? I cannot sell that Microsoft 365 to you, right?
Inventory. Yeah.
So the first thing, whenever you have an asset, right? Okay, the first thing that we need to see is what does that asset mean to that company? So if I say a car is an asset, Does Hyundai consider car as an asset? It's an inventory, right? So look from a context of who is handling what kind of the purpose of this asset. So in your question, sir, you're subscribing. You're not acquiring that license. Do I have a right to sell that license to someone? I don't think so. Do I have control? Yes. For the period of time I have control. I can use it. I can choose not to use it. And I do also have some economic benefits arising out of it, but I don't have the identifiability is the fact.
Yeah, just to add upon what Raghav said, in today's scenario, we are able to see this kind of examples in many servers in many of our clients. Okay, today many servers are cloud-based. Okay, those kind of cases, company doesn't own that server. It's just a cloud-based server. Company pays amount towards us, so that's just a prepaid expense. It cannot be an intangible asset. Where I own that ERP, I have the ability to sell the ERP tomorrow without the permission of anyone. That gives you the flavor of intangible asset.
I think what you said was, sir, I think there are circumstances where it can be considered as intangible assets. For example, big companies, like let's say Tata Motors, they have SAP as an ERP, right? For that SAP, there's a significant customization that is required because you have to customize as per the company's requirement. So there is significant customization involved that is unique for the company. That case, I can say it as an intangible asset. Because the entire inventory module or the entire inventory management is driven by SAP. I'm just giving you an example. That can be considered as what I'm trying to tell you, right? Yeah. See, okay. Okay, Blinkit, yes and no. Okay, so if Zomato had acquired Blinkit, in Zomato's books, Blinkit would be a brand intangible asset. Okay, let's say Blinkit as an individual company. Let's say it's not acquired by Zomato. At that point of time, Blinkit as that individual company cannot recognize intangible asset. I'll tell you the reason separately. Okay, so Etihad Airways promotional expenses not an intangible asset. 6E trademark intangible asset, but it is not recognized in Indigo's books, which I'll explain separately. Netflix satellites or OTT rights intangible asset, Bitcoin intangible asset, patent obviously intangible assets, television rights intangible assets, Spectrum intangible assets, publishing rights intangibles, Zoho subscription to Zoho no. Insurance expense, no, not an intangible assets. So Blinkit and 6E, if let's take Blinkit as an individual company, right? And let's say that Blinkit wants to evaluate its brand. What exactly is the brand value? Can it record it as an intangible asset? Why? Why? So let's say I am the company owner of Blinkit. I know my brand value. I know because of the Blinkit brand, people would buy products from me. Can I recognize intangible asset? Sorry? But the brand has a value, right? Why wouldn't I not recognize? Okay, let's say right, goodwill, any self-generated brands or trademarks cannot be recognized. You can register a brand, you can register a trademark, but it cannot be recognized because there's no cost. That's why we're going to come to the next question. So these are some classic examples. Just align through. I'll just move on to the next slide when you're done. So for you to recognize an intangible asset, you need to have a cost. There should be cost to measure intangible assets. Okay, so that's the definition. So if the conditions are satisfied, identifiability, non-monetary physical substance is not there, then cost needs to be measured and there should be an economic benefit coming out of it. This condition is very important. Insurance. Why do you, tell me sir, why do you think insurance should be an intangible asset? Please enlighten us. Understood. Okay. Do you have control over that? Can you get economic benefit out of it? Only when the insured thing is demised, right? I'm interested on how you do though. If you're able to make a profit out of insurance contract, please let me know. Okay, so just absolutely. Prepaid expenses and amortize over 3 years. Intangible assets. No. No. Yes. Yeah. 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 Fair enough. Prepaid expenses, insurance expenses, let's be straight, not an intangible asset. Just capitalize in, take it into prepaid expenses, amortize it over the period. That's it. Fairly simple. Okay. So there was questions on why Blinkit is not a brand for the company in which you bring it. So this way. So when you have a separate acquisition, when Zomato acquired Blinkit, in Zomato's books, Blinkit is a brand. It is an intangible asset. So your intangible assets come only when you acquire something. Self-generated brands, goodwills can never be recognized. Okay. And goodwill is an intangible asset. Is it? Where is it covered? IND AS 38? It's covered? Okay. Yeah, which standard? Super. So this standard only references goodwill, okay? But the true essence of goodwill comes from 103, business combination, where when you pay something more than its fair value, that's recognized as goodwill. Okay? But goodwill is nevertheless an intangible asset in the books of acquirer. Okay? Yeah. So let's get this question. So Alpha Foods Limited spent 12 crores over the last 3 years on advertising, celebrity endorsement, packaging, redesigning, and promotional. In its fast growing in-house brand, Fit Bites. The brand is now well recognized in health snacks segment and has contributed to significant increase in sales. The company management wants to recognize Fit Bites as an intangible assets. Can it do so? Okay. Okay. Any other different perspective? What do I do? What do I have to do with this 12 crores? Should I have to deferred revenue? So it's been spent over the last 3 years. Can I still not expense it off in P&L? Should I have to take it to balance sheet as a deferred revenue? Any other perspective? So the answer I was looking was, it doesn't matter because you can't classify an expenditure of an internally generated brand. If it's a company, whatever that you incur as an expenditure to promote your brand, expense it off. Don't even think of bringing it in balance sheet as a brand. Okay, because it doesn't matter if the company says because of this brand only I'm getting so much of revenue order. It doesn't matter. Only when the company gets acquired, there'll be a brand value. Because brand cannot be quantified. Internal generated, yeah. I'm coming for a separate slide for that. I'll do that. I will explain it separately. I'll answer your question. Okay. Okay, this is an interesting one. Melody Makers enters into an agreement with legendary composer to acquire exclusive rights of the commercially exploit one of her previously unreleased composition for a period of 10 years. The agreement Melody Makers the rights to use the songs in films, albums, OTT platforms, a legal contract granting exclusivity and enforceable rights, and ability to license these products to a third party for a fee. Melody Makers pays 20 crores as lump sum for these consideration. Can these 20 crores be classified as intangible assets? As what? What intangible assets? Rights. Nice. Okay. So basically, you have exclusivity. You have there's a separate asset, identifiable, non-monetary, non-physical substance, and you have control over the asset. So intangible assets. Okay. So internally generated goodwill and intangible assets. Okay, this is the point I was trying to explain. Goodwill, internally generated, please don't recognize. Internally generated brands, trademarks, please don't recognize. The standard does not allow. However, if you had acquired a company and the company has a brand, company has a copyright, company has a trademark, that can be recognized. That your standard allows. Okay? Why do you think it's a business promotion in the first place? Because Melody Maker is in the business of acquiring these song rights and then publishing it, right? Why do you think it's a business promotion? Right? That's why the question, the purpose of the company becomes all the more important. Okay, just a fun, interesting fact. Uber Labs. Anyone knows anything about Uber? Uber, the app, right? That company's value as a company is specifically from this Uber Lab. They have a division called Uber Labs, which is an R&D division, right? So what it does is that we would rather have the news than to wait for the uncertainty. So when you book a cab, right, there's always uncertainty as to when that cab would come, where the cab it is, and how much do I have to pay. So what Uber did was it did a research that if it's able to publish or show to the customers that your real-time tracking of your cab and how much you're expected to pay and how delayed the cab would be, customers are more prone to stay onto Uber. So entire valuation of Uber is coming from this Uber Labs. So if it was in India and some other company acquired Uber Labs, it would be a significant brand value. Okay, another interesting theory. Can a past expenditure be capitalized as intangible assets? Something that you have incurred, can it be capitalized as intangible assets? Fair point. Any other perspective? Is it a yeah? So let's say you have a company and I'm purchasing that company. From your perspective, do you value goodwill? My perspective, I will value. Your perspective? Yeah. In my books, it will be goodwill. Goodwill on acquisition of your business. But would it be an asset in your company's books is what I'm asking. What would you quantify as goodwill in your books? You would say 1,000 crores, 10,000 crores. Okay, so the next interesting part, which is okay, the interesting theory. So research and development expenditure. Any idea? So let's say I'm developing a software, right? And I'm incurring expenditure. So what do I have to do with the research part of the expenditure? Can I capitalize it? Okay. What about development expenditure? What exactly is the difference between a development expenditure and a research expenditure?
Those kind of can be development expenditure, and development expenditure can be capitalized. Research cannot be capitalized.
Okay. Any other perspective? Okay.
Whether it will succeed or not will not be known. So
okay.
Development intends to commercialize and get some benefit out of it, so we can capitalize.
Okay. Any other perspective? But why would I do a research if there is no certainty or
uncertainty in the outcome? It is a intended.
Super.
Effort.
So let's say I've spent 100 crores in research and 100 crores in development. I know the product is now viable. Can I capitalize 200 crores? Or should I capitalize only 100 crores? Only 100 crores. Okay. I think you guys are right. So research expenses, your standard says don't even bother. Please expense it off. Research expenses are just funny play. Like I can say anything as research expenses. So research expenses mandatorily expense it off. Development expenditure, however, there's a different story. Development expenditure can be capitalized. It should be capitalized if there are certain conditions which are satisfied. Okay. So what are those conditions which needs to be satisfied for us to capitalize a development expenditure? So basically, I'll just explain it with an example. So there was this company which was into research of converting seawater into petroleum. Okay. Now, right now it seems to be a laughable theme, but back in the days when petrol was like 100, like 36 or $150 per barrel, there was a huge expenditure for petrol. Okay, so there was this company which wanted to convert seawater into petroleum. Okay, and it wanted to capitalize all the expenditure, everything. It paid salaries. It wanted to capitalize it. It capitalized left, right, center. Okay. The standard says that, boss, when you don't have the technical feasibility, when you don't have the ability to sell, when you don't have the intention to complete, and when you don't have the probability of future economic benefits, and when you don't have the adequate financial and technical capability to complete the asset, it is not into a development phase. You cannot capitalize an expenditure as an intangible assets. So the 5 conditions or 6 condition is technical feasibility, intention to complete, ability to use, probable economic benefits, and adequate technical, financial, and resources available. Only then a developmental expenditure can be capitalized. Only then an expenditure can be capitalized as intangible assets. Okay, so I also have an intention. I have a beautiful intention of converting everything into gold. Those two are separate conditions. Adequate technical and financial resources is one. Ability to measure reliable expenditure, yes. Can you capitalize something without? Thin line, I agree, but let's say let me just give you an example. Okay, generally, okay, these software companies and everything, okay, they have a separate R&D division. They'll do so much of research, okay, and just to know whether a research is good or not, just to know whether the research is plausible or financially viable, they have this testing called alpha testing. Okay, so kind of like a prototype for softwares. Okay, it has to pass an alpha testing, as in the algorithm or the configuration of the software should be viable enough to market. Then they have beta testing. Beta testing is when your WhatsApp and Instagram, so those are all beta tested software applications. Okay, so when it passes an alpha test, then it means that every condition is satisfied. So I'm talking from a software perspective. This can be different for a pharma industry. Pharma industry will have its own research. So pharma industry, what they will do is they test it on live subjects. And if the subject lives, yes. Subject dies, then no. Okay, this will be very different and unique for different industries. Manufacturing companies have R&D. All the cars that we see right now was once an R&D expenditure. What exactly constitutes that division of research and development? It's that prototype. Okay, this is more important because when you do an audit or when you evaluate companies which is into software development, most of the companies, they'll try to capitalize research expenditure. Yeah, I can capitalize the developmental expenditure. Yes, yes, yes. So once I demonstrate, okay, this product is viable, and whatever expenditure that I incur subsequently, we can capitalize. Fully. AS 26, I think. It's same. It's similar. 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 All around the globe, this is the approach. Only in US gap, they entirely take it as an revenue expenditure. In US, even if it is development expenditure, they take it to P&L. That's why they do more research. They don't bother about capitalizing anything. Everything is. Yeah, yeah, yeah. This is to encourage companies to spend more on research and development. Right? Okay, another example. Okay, Tune AI is building an AI tool that composes background music for films and games. January to April 25, 12 lakhs has been spent on experimenting with different AI modules. May to December 25, 30 lakhs spent in creating a working prototype. The beta is ready and the management expects future revenue. As per IND AS 39, which expense to be expensed off and which is to be capitalized. Okay. 12 lakhs research expenses, please expense off. 30 lakhs is development expenditure, you can capitalize. Right? This is an interesting one. Coal Grit Minerals Limited, an Indian mining company, obtains a 10-year exclusive license from Government of India in April 25. The company pays 10 crores as one-time upfront fee. In the next 6 months, Coal Grit incurs the following cost. 1.2 crores for geological survey, 3 crores for exploratory drillings, sample analysis 80 lakhs, and 2 crores on acquiring heavy equipment for drilling and sampling. By 2025 December, Coal Grid concludes that the coal block is commercially viable and plans to move to the development phase. How should Coal Grid account for its expenditure? How 5 crores? 1.2 plus 3 plus, okay. Expenditure, okay. 10 crores? No, intangible asset, tangible asset, ROU, prepaid expenses. Prepaid license. Nice. Okay. Research. 10 crores. Company will be so happy. Any other different perspective? $10 crores intangible assets. It's a right. It's not an ROU. It's a right, commercial right. Okay. 5 crores entirely not expenditure. It is an exploration asset which is covered under IND AS 106. Nobody uses the standard except for mining companies. Your Vedanta, NLC, those companies, right? So they'll have a separate. It is not a PP. It is an exploration asset. Okay. So both are capitalized. Yes. 15. So 10 crores in intangible asset, which is our standard. Okay. 5 crores exploration and evaluation assets. Other standards. Okay. Okay, last question. Nexa Tech Solution Limited enters 6 years lease agreement for a commercial building in Bangalore to house its head office. The lease contract gives Nexa exclusive rights of identified space, fixed monthly payment of 5 lakhs. Nexa Solutions has acquired right to build, operate and transfer commercial spaces in Ritchie Street. After the term ends, the asset is transferred back to the government. What is the treatment? First one is right of use of asset. Okay. Second one? No, focus on whether it's an intangible asset. Right of use of asset, that's okay. What is it? Is it a intangible asset, the first one? Or the second one? Government, okay. Right to build, yes. I'll give you an example. Yeah. Mm. Okay, so I'll give you an example. So Chennai Corporation leased out a building to subcontractors, and subcontractors can use that building for whatever purpose that they deem necessary for revenue. And that period is for 10 years. So for 10 years, that subcontractor did everything. They built a auditorium, they rented out separately. So that subcontractor has a right. It is not an ROU, it is a commercial right. Okay, so commercial right. So let's say airport authorities in Chennai, it is maintained by airport authorities of India. In Mumbai or in Delhi, it's maintained by GMR airports, which sole job is to maintain and manage the airport. Okay, and that is for a period of 10 to 20 years. So is that not an asset? I have the right, a commercial right, and I can charge whatever. I can charge 200, 300 for a user development fee. So right, you enter an airport, you have to pay a bomb, right? And that's up to GMR to decide what's the rate, right? So is that not a commercial right? It is. And is that not an asset? Is that not an intangible asset? It's an intangible asset. It is not an ROU. That's why thin line, it's not an ROU, it's an intangible asset. It is not a lease. That's what I'm trying to tell you. So let's say a commercial right, I can do whatever I want to do. I don't have an identified asset. The primary condition in India is 116 is you should have an identified asset. Here there's no identified asset. There's a commercial right to exploit that property to generate revenue. It's a commercial right. So the first thing is IND AS 116 accounting. Yes. The second one is intangible asset, which comes under IND AS 38. So remember this example, just airport management, airport authorities and everything. Okay. Sorry? Toll. Should be similar. Should be similar. Okay. This one is fairly simple. Okay. So like IND AS 16, IND AS 116 and IND AS 38, you have two models where you can value the asset: cost model and revaluation model. Revaluation model is generally rare. None of the companies do. However, certain companies, they revalue their intangible asset. For example, there was this recent commercial Tamil movie where they played some retro songs, and that song becomes so popular that everyone started to listen to that. Okay, and you know, the music producer of that song, they can revalue, or they can fair value that song rights, because the song is popular and is able to generate revenue, right? If it chooses to account its assets in revaluation model. Okay, that's just an example. I'm not saying they're doing that, it's just an example. So intangible assets is always valued at cost, unless or until the model chosen by the company is to value it at its fair value. Okay, so this is, again, we touched upon useful life, just like how we have useful lives for PPE, useful life for intangible assets. Okay, Schedule 2 specifies the rates for software and then commercial rates and whatnot. If you believe that the rates are not appropriate for your intangible assets, you can get a technical evaluation from an expert saying that this should be the useful life. And you can do that. Okay, there's a small question: can an intangible asset have infinite life? Infinite life. Spectrum is only for 20-30 years. No? Any example that you find that a brand should have an infinite value? Okay. But the book will always be purchased at that same rate, is it? Can it have infinite life? Can I have it only at cost for entirety? I cannot? Those are royalty kind of a stuff, right? If the book or the movie sells, then whatever royalty comes out of, then agreed, agreed. But is that the same value? Is what I'm asking. Can it be at the same value? Just because something was bought for 20 crores right now, can it be 20 crores after 20 years or 100 years? Agreed. That's why I'm asking. Can there be an intangible asset having infinite life? Okay. Nice. Okay, so basically, JLR, Jaguar Land Rover, right? It was acquired by Tata. It has infinite life because the brand of Jaguar and Land Rover, people would buy shit cars for that brand. Even if there's a small car which is not even worth buying, if it has JLR as a brand, people would buy it. The car value is not determined by the car itself, is on the brand, right? Similarly, your Gucci, Louis Vuitton, your bags and Rolex watch, right? Is it worth that much? No. But the brand has it. Exactly. It has infinite value. People buy for that brand. Sorry? Exactly. It has infinite life. Right? People would always buy for that brand itself. So in Tata Motors financials, the value for this JLR is it's not amortized. Exactly. That's why your standard says that, boss, if you classify an intangible asset as infinite life, you'll have to provide a detailed rationale. How is it? So in 2020, when COVID happened, this was impaired. This JLR car brand, it was impaired in Tata Motors. It can, the value can reduce, but it needs to be assessed every year. Every year, I'll have to see whether there's an infinite value, infinite life or not. So let's say it'll hit the P&L. So if let's say it's 1,000 crores JLR brand, and if that is brand is not performing well, I'll impair as in I'll reduce its value by 50%. I'll have to evaluate. Yes. So that's your indefinite lives, and this is simple fairly for retirement disposal, just accounting entry. So retirement, remove the accumulated depreciation, the gross cost of the intangible assets, recognize the profit and loss. If you keep an intangible asset held for sale, it gets covered under IND AS 105. So in your balance sheet, you'll have to show that asset as non-current assets held for sale. Okay. Last slide, disclosures. Basically, your gross, addition, deletion, total gross, accumulated depreciation that comes into it. Separate class of assets. So you can have your intangible assets as in this way: brand, masthead, computer software, licenses, and then whatnot. And indefinite useful life. If you have an asset having indefinite useful life, a detailed rationale needs to be given for that. It needs to be evaluated for impairment or reduction in value every year, every reporting period. So some gentleman asked this question, like, how would I have to, if I have intention to sell an asset before the date of signing the balance sheet, what do I have to do? So you have to show it under non-current asset held for sale. It's an asset, nevertheless. It's just not a PPE or intangible asset. When you show it as PPE or intangible asset, it should generate revenue. It is held for sale, right? Or held for disposal. It's just not happening as on 31st of March. Subsequently, okay? Any questions? Anything? Yeah.
I have a doubt regarding this goodwill recognition. Let's take a holding company acquiring 80% stake in a subsidiary company. The stake fair value was 100 crores. The holding company paid 150 crores. Now, this goodwill, so in the holding company books, will they have to record investments as 150 crore, or it'll be 100 plus goodwill of 50?
So,
or my question is, will the goodwill come into play in the standalone financials of holding company, or only when we consolidate?
I'll answer. What's your perspective?
I definitely know that when we consolidate, a goodwill will come into play. But I was thinking, even here it should have come. I was just, both the goodwill, I know that, when you overpay, it's goodwill, and when you underpay, it's capital reserve at the time of consolidation. But later on, I was thinking, even here it should have come, that's my confusion.
So, consolidation, sorry? Can I ask you, I understood your question. So let's say you accounted, let's say you paid 150 crores for 100 crores worth of company. In your standalone, if you recognize 100 crores of investment and then 50 crores of goodwill, does that goodwill generate any revenue at a standalone books?
Definitely through my...
Does it generate at your standalone books?
Yes.
Standalone.
Because I would be accounting when I consolidate.
Consolidation, yes, at standalone.
But even otherwise also through dividend income I get, no?
Let's assume dividend anyway, if you're getting from your subsidiary, it will get knocked off, no? Intercompany transaction will get knocked off, no? It's like from left to pocket to right to pocket, you're transferring money. How is that income? At a
I also come from another angle. Assuming that in a rare case, so if I want to see the impairment part, I have to see only for the 150 crores, not for the 100 crores and 50 crores.
Exactly. I'm saying that 150 crores. Exactly, sir.
So the question is, if I account it in a standalone books as a 50 crores in goodwill and 100 crores in investment, tomorrow in case if I want to see as an impairment of asset, I have to benchmark only as for the 150 crores, not for the 100 crores. If at all I am bifurcating in this between goodwill and cost of investment, I cannot see that. So that is the purpose. In the standalone, it should be obviously at the 150 crores. In consolidated, automatically the goodwill come at 50 crores.
Correct. See, so basically, when you invest in a company, okay, so let's say in your example, you pay 150 crores instead for a fair value of 100 crores, okay? Yeah, you're paying more than what it's supposed. In your standalone books, it should be investment debit 150 crores, no exceptions, okay? Because standalone, let's say that it's your cost of investment. Yeah, it's a cost of investment. And in your consolidation books, so the fair value is 100 and then you paid 150, 100 gets cancelled, that 50 will be goodwill. One is the common control method of goodwill. So in your IND AS 103,
pooling of interest, or
exactly. So that's your AS 14. Your IND AS 103 has a different terminology. It's called common control. Okay. Basically, common control is if you acquire something of within your group. Let's say Tata Motors acquires Tata Consultancy Services. It's the same group. Okay. So you can't do a fair valuation. So whatever is the book value of that book, that needs to be counted here. That's it.
That's called common?
Common control transaction.
And other one is called?
Acquisition method.
Okay, fine. Thanks a lot.
103. 103. That's where your goodwill and everything comes into picture. So before that question, sir, are you from ISRO, sir? Or you look like a scientist, so I'm just out of curiosity I'm asking. Are you from ISRO or some other? Okay, enriched uranium. Okay. What do you... Okay. You cannot use it. Okay. It's not that you cannot use it. You cannot use it for bombing people. You can use it for generating electricity. Okay, so the problem with Iran is not with the usage. The problem with Iran is intention to use. Yeah. So yeah, it would be, in my sense, I think it will be a tangible asset. It will be like because it has physical substance. It is identifiable. It is non-monetary. It will be tangible in that way. But I'm not sure. I think I should ask someone from ISRO or someone from Atomic Energy Department. So yeah. But good question. So, anything else? Anyone has some different perspective to share? If you believe that the value would only last for 10 years, yes. Patents 20 years is more of an economic life. Its useful life is determined for the accounting purpose. Yes, you can amortize it for 10 years if you believe that the patent would last only for 10 years. What do you mean by different categories? Different patents, you mean? Yeah, okay, yeah. Patents are different. But why would it be different in a way? So, do you mean it's a different asset altogether? Yeah, yeah, yeah. Okay, so your standard says that when you classify an category of asset, so let's say PP, you have fixed asset or building, cars, vehicles, and then whatnot. So when you classify an asset into a particular category, you have to follow the same useful life for that category only. So let's say patent, if you classify it as patent, it has to have the same useful life. It has to have the same useful life. Yeah, that's okay. Different stages, as in different patents can have the same useful life, is what I'm trying to say. It should have same useful life. You can't have one patent having 20, 35 years and another patent having 8 years. Or at least you can have a range. Yes, that is possible. So you can have a range. Yes, that is possible. You can have a range. Yes, but it should be within that range. At least ensure that. So normally companies classify buildings, right? So it'll be between 30 to 60 years. So they can't exactly pinpoint that. So 30 at that range, if it is false, then it is okay. Normally for a software, it is 3 to 6 years. Okay, software generally what I've seen. 5 years. Okay, anything else? I need to wrap up. Anything else? So questions can be answered separately. I think the next session. Thanks. Yeah, thank you so much. Yeah.
Thank you so much, sir. We would like to introduce CA Sateesh Kumar, sir. He holds a bachelor's degree in commerce and qualified chartered accountant from the Institute of Chartered Accountants of India, ICAI, as well as a certified information system auditor, CISA, from the ISACA. He has over 13 years of experience in audit and assurance practice. He has expertise in statutory audits, particularly in compliance with Indian accounting standards requirements across diverse sectors, including automobile manufacturing, IT and ITES, infrastructures, and INVITS. With this short note, on behalf of SIRC of ICAI, we would like to welcome our session speaker, CA Sateesh Kumar sir. Thank you on behalf of our SIRC of ICAI for accepting our invitation. Over to the speaker. I would like to welcome CA Srinivasan sir to give memento to our speaker.
Thank you. Good afternoon, everyone. So thanks, Raghav, for enlightening session. So he was mostly touching upon the all the modern technologies and AI and so on. So I'm going to talk about the borrowing cost, which is very age-old accounting standards. So I'll just keep it very short and simple. So thank you so much for your patience. So I'm going to talk about the borrowing cost, which is very age-old uh, standard which is issued by the institute. So in terms of borrowing cost, we are going to talk about what constitutes borrowing cost, how this needs to be treated in the books of the entity. So mostly when it comes to borrowing cost, we all come to know that there is a cost we pay for borrowing. How this needs to be treated, whether it's a revenue or capital in nature. So this is the more common doubt which comes to our at the time of accounting it. So coming to this session, so I'll just take you through the core principles, some key definitions of this particular standard, and also I'll take you through the practical challenges in respect of each of the areas what this standard talks about. And when we are in any stage of as a finance professional, these concepts may help you into understand how to how this particular standard will impact our analysis or financial strength of the entity. So moving to what we are going to talk about is, we are going to talk about the principles, scope, definition and recognition, and some of the key principles for capitalizing, when to capitalize the borrowing cost. And also these concepts we will touch upon some of the practical issues faced by the industry, along with some of the study materials, and also EAC opinions issued by the institutes. Finally, we will go through some of the key difference between the old AS 16 and IND AS 23. Moving to the core principles of the standards. So what constitutes is a borrowing cost. So the standard says the borrowing cost which is directly attributable to the construction, acquisition or production of any assets which constitute the borrowing cost. So basically an asset needs to be constructed in order to avoid whether this borrowing cost needs to be capitalized or not. And in case if any of these tests has not been passed, then it directly needs to be expensed out. So the rule is very simple. If it's a directly attributable cost, then needs to be tested for capitalization. Otherwise, it's not. So some of the directly attributable costs, when you see, for example, the loan taken for construction of a plant, which is a directly attributable cost. The loan taken for working capital purpose, in a very simple rule, which is not a direct attributable cost. So any borrowing cost which we pay, so needs to be charged to the P&L. Coming to the scope of this standard. So this standard predominantly talks about the borrowing cost. So there are certain scope exclusions are there, which needs to be applied at the time of testing whether this particular borrowing cost needs to be capitalized or not. So when it comes to what this particular standard does not deal is, it does not deal about the actual or imputed cost of equity. For example, in case any loan has been taken for acquisition of subsidiaries, this loan does not create any qualifying assets. So we'll talk about the qualifying assets in subsequent slides, but to understand the scope of this standard does not allow you to capitalize this particular borrowing cost. And also this standard is not required to be applied on the certain assets, though it's called as asset, but it does not need to be applied. So one, the biological assets like rubber trees, this standard is not required to be applied. So basically where we do the valuation of assets under fair value method under the other standards, already these assets exist in the fair value, hence there is no requirement to apply this particular standard. And also the inventories which is manufactured or produced in large quantities. Generally, the industries produce inventories at large quantities. This standard is not required to be applied on those assets as well. So moving to the definitions. Sorry, sir. Yes. Those costs needs to be expensed out, not to be added as part of the qualifying asset. Okay. So moving to the definitions. So after this definition, I will pause for a minute for take your questions if any. So when it comes to definition, what all the cost we incur for borrowing, all this constitute as a borrowing cost under this particular standard, which includes, there are certain inclusion has been given to state that these costs also needs to be considered as a part of the borrowing cost. So one, EAR based interest which we compute generally as per the IND AS 109, and interest on lease liabilities as per the IND AS 116, and foreign exchange differences. To that extent, it constitutes as a difference between the local currency borrowings and foreign currency borrowings. So generally, this particular criteria is also is available in the normally AS scenario. The same is applicable for this IND AS as well. So all these three major concept which also is includes as a borrowing cost. So the crux over here when it comes to calculation of the foreign currency differences, this standard permits cumulative approach. In the sense, in the year where we recognize the loss, in case this loss to meet the difference between the local currency and my foreign currency for borrowings, it can be added along with the cost of the asset. Subsequently, it resulting in a gain. Those gain also, to the extent of loss which I capitalized before, it can be adjusted against those interest. However, this particular concept was not there in the normal AS 16. So this is one major difference. And moving to the what constitutes the qualifying assets. So there are, because the borrowing cost can be added to the qualifying asset. Considering there is the question arises, what constitutes my qualifying assets? So the qualifying assets are generally it will take substantial time to construct and resell. So when I buy something which is readily its usable condition, this may not be a qualifying asset. So when I buy something which needs some substantial time to make it ready for their intended use or intended sales, that particular asset will qualify for a qualifying asset and as per this particular standard. So generally, if you say inventories which take substantial time to bring both them into the in their actual intended use, some manufacturing plants, power plants, etc. And also comes to non-qualifying asset. So there are some non-qualifying assets which this particular standard prescribes. The financial asset, inventories which are normally manufactured over a shorter period of time. So we had just gone through about the substantial period of time. So when the inventories which is produced in the shorter period of time, that does not qualify for a qualifying assets. And the asset which readily available for use, we already have spoken. So those are all things is not qualifying for a qualifying asset. Yes, sir. Yes, it comes in the first category. So borrowing cost refers to interest and other charges. So whatever the processing charge you incur, that should be added as part of the borrowing cost. Effective interest rate. So when it comes to AR method, so all the borrowing cost which effectively you pay for this particular borrowing needs to be computed based on the ER method. It's provided by the IND AS 109. So based on that, this needs to be taken to the borrowing cost for the respective period. Again, if that particular cost related to the qualifying asset, then instead of taking it to the profit and loss account, it needs to be added as part of the asset. In case if this expenditure is incurred before you get the legal ownership, I'm not sure whether I'm right or not, legal ownership, those things will not be applicable. So again, considering it's a partnership firm, they choose to amortize over the period of the loan. In case if you take a facility to construct a plant, okay, so that you take it on leases basis, then the interest what you debit in the P&L as per the IND AS 116, that you have to take it as added back along with the part of the assets. So which is readily usable condition. So hence that's not needed. So it's the standard says which is includes, not only that, with that also. No, includes in the sense if it's meeting the criteria of borrowing cost, then yes. Yes, it does not qualify as an asset. So if you take a shop on lease, which is straight away, which is in usable condition. So the modification, whatever you do, which is to meet your specific requirement purpose. So hence, the moment you take those leases, is straight away it's in usable condition. It's like ancillary to the original activity. Yes. Asset until it's ready for use. So once it's ready for use, then it needs to be follow the regular treatment of charging to the P&L. No, so I'll just come to the calculation part later. So now let's discuss about only what constitutes the borrowing cost. So when it can be capitalized and when it can be stopped, that comes in the subsequent slides. So some of the key challenges faced by the industry I just brought in. So one, in terms of dividend on the preference shares. So when the preference shares is classified as a financial liability, any dividend on those preference shares, which is fixed in nature, which will take the substance of interest. Hence, it will be disclosed under the finance cost as per the IND AS. So, when such finance cost, when it's considered as a finance cost, if that particular preference shares has been taken for the purpose of building or constructing any qualifying asset. So until that particular asset complete the construction or ready for use, that also needs to be added along with the qualifying asset. So this is one different perspective which is not there in the old borrowing cost standard, which is there in this particular standard. And if it has a fixed tenure where I have to redeem it compulsorily at the end of this tenure, say 5 years, 10 years, or 20 years, and it has a fixed coupon rate. And so anyway, it has two criteria: one, liability or equity. So in case if no, in case if it's compulsorily convertible, then it will take the characteristics of equity. Hence, dividend what you pay, it won't be considered as a finance cost. Not likely to be. So on that, the company need not to pay any, cost. No. So when it's when you classify your either preference as a equity or liabilities. Yeah. So even if it has if it's an embedded derivative, I feel no. I think you are talking about the embedded derivatives. Even if it's embedded derivatives, then you have to assess whether it's a equity or liability. Okay. So if it's take the characteristics of liability, then if you pay on that any such thing, then it needs to be considered as a borrowing cost. Otherwise, not. So moving to the next one, we spoke about the inventories which is produced, or no, it will take longer time to get converted into for their intended use, which we spoke in the earlier slide. So certain inventories like beer or cheese, which will take longer time to convert. So which means no, it will take substantial time to convert into from raw material to their intended use or intended to sell. So those will take the characteristics of qualifying asset as per this particular standard. However, so there is a EAC opinion is available. The company can choose whether to consider as a qualifying asset or normal asset. So the choice is with the company. However, once this particular choice has been opted, this needs to be followed consistently. This also needs to be disclosed in the financials on what rationale this particular stand has been taken for it. Okay. So before moving to the yeah. Borrowing cost, as and when you incur, that needs to be charged to the P&L. Yes. It's not required to be added as part of the asset. Okay. And so another interesting scenario, whether it's to be considered as a borrowing cost or not. Say for example, when you pay the prepayment charges to close the old loan and take the new loan, whether that particular charges needs to be considered as a cost for the purpose of new loan or not. So this also, there is a clarification has been given by the institute. So this particular thing, it will take the characters of gain on loss of extinguishment of old loan. So hence this not to be considered as a borrowing cost. Yes. Yes. And as we spoken earlier, the borrowing cost which you incur for acquiring any shares in these subsidiaries or associates, that also does not create any qualifying asset. So hence that will not take the characteristics of qualifying asset, hence not to be charged to the added along with the investment. So Raghav also has spoken when he was touching upon the intangible asset. So this won't be part of the cost of the investments. So I'll just pause here for a minute. If any questions, then we can take it. Okay, I'll just move to the next one. So how to recognize the borrowing cost in the books? So the borrowing cost, as we seen before, which is directly attributable for construction, production, or acquisition of the any of the assets. So the asset, in the sense, it's a qualifying asset. It's supposed to be qualifying asset. So the list of qualifying asset has been given in detail before, and which we need to assess what constitutes qualifying asset, what constitutes qualifying asset. And so when it needs to be recognized as a borrowing cost, there should be economic benefit available for those particular qualifying asset, and those can be measured reliably. So in that particular scenario, this particular borrowing cost can be recognized. And if that particular test fails, this needs to be recognized, charged to the P&L. That is very simple rule. And here there is a one underlying condition. In case of hyperinflationary scenario, then if that particular entity applies this hyperinflationary standards prescribed by the the separate standard which has been prescribed. So in that particular scenario, only normal interest can be considered as a borrowing cost. Any inflationary cost which has been considered as a borrowing cost, not to be considered for adding to the along with the qualifying assets. So then comes to what cost qualifies for capitalization. So the general rule is, if there is a cost is incurred, we have to test whether it needs to be added along with the asset or charged to P&L. So then what constitutes as a cost which can be added along with the assets? So one is, if this any borrowing has been taken for specific purpose, otherwise that particular borrowing would have not been taken. Say I would have avoided taking that particular borrowing. So in that particular scenario, this constitutes a specific borrowing for acquiring that or constructing this particular asset. Hence, it qualifies for a straightaway. It qualifies for a adding it along with the attributable. Yes. If not, then we have to test whether have I taken a general borrowing or not. So if it's specific borrowing, rule is very simple. Directly add it along with the assets until it's ready for use. If it's a common borrowing has been used, say I have taken a loan, but I have constructed various assets, and also I have used for my day-to-day operations, say for working capital purpose. So hence we have to see to what extent I have used that borrowing for my constructing a qualifying asset. So in that case, there is a specific methodology has been given the standard. So we have to find out a capitalization rate for the each borrowings to what extent I have used. So it's prescribed weighted average borrowing cost method. That particular rate we have to apply on the total cost of this cost of the entity for that particular period. Then that particular borrowing cost needs to be applied against the respective assets. Sorry, sir? Yes. Yes, we have to find out the capitalizable borrowing cost. Then that needs to be added along with the cost of the assets.
Only this part of it.
Yes, yes.
But if it is revenue in nature, that is then no need for capitalization, right?
Yeah. So in case if I'm constructing an asset, then I have used a general borrowing. This scenario applies. Where I have not used this particular general borrowing. Say for example, I have raised a equity. That document specifically gives that this particular equity needs to be applied for the so and so assets. So in that particular scenario, there is a utilization criteria has been given. Hence, those proceeds can be utilized to construct only those assets. So hence those assets straight away won't qualify for applying this particular test. Clear, sir? And coming back to the calculation of the generalized borrowings. So there is an underlying condition that when I take a total cost for that particular period, I have to exclude the borrowing cost which is attributable to the specific borrowing, because specific borrowing straight away it will take the characteristics of it has been obtained for that particular loan. Hence, that straight away it needs to be removed from the total borrowing cost for the purpose of computing the weighted average capitalization rate. And in case of in any case, the total capitalized cost should not exceed the total cost for that particular. This is general terms actually. So moving to some general challenges faced because of this particular because of this particular last slide is the cost accrued versus actual spending. So when we take the borrowing cost, specifically in the case of general borrowings, so eligible borrowing cost that needs to be computed based on the actual utilization rather than my accrual. So generally we do accrue the cost in the books. However, we don't actually that not be an actual outflow for the company. So in that particular scenario, actual outflow of the company has to be considered for utilization to arrive this general borrowing rate. And there is a common the scenario where there will be some interest savings. Say I have taken a specific borrowing. However, I have the ideal or excess money raised out of the specific borrowing has been kept under the cash credit or OD account. So ideally the interest on the cash credit or overdraft account is ideally reduced. So there is a cost saving involved. However, this standard does not permit you to capitalize those borrowing cost. So still it needs to be expensive. So the income generated out of the specific borrowings, to that extent it has been held as a income, which means to that extent it has been specifically deposited and the income has been generated. Those income alone has to be reduced from the borrowing cost, not any notional interest saving arises out of this parking of those excess money.
Clarify with some example on that.
Yeah, so
because
generally
now I'm not able to understand. I'm getting a little confused with the mercantile system of accounting vis-a-vis the actual cash outflow. So could you just
sure. So in the general borrowings, we talk about the capitalization rate. Capitalization rate is computed based on the weighted average utilization. So that utilization, how we identify that utilization? So the utilization has to be taken actual cash outflows. So not accrual. So accrual where it comes to play is, say for example, I construct a asset. I generally accrue that particular expenditure for that period. However, my credit terms may be 30 days or 60 days. So this particular standard says whenever you accrue that expenditure, need not to be considered as a utilization for identifying whether it's a utilization or not. So when you actually make those payments, at that particular point of time.
So suppose I make the payment in the subsequent period only, that time.
Yes. Say for example, you record your expenditure in the month of June. However, you make the payment in September. So for that weighted average purpose, you should not take 9 months. You have to take 6 months. Yeah. So we spoke about the interest saving and temporary parking of those income. Moving to the commencement of the capitalization. So in terms of commencement, there are 3 conditions has been given. So in order to commence the capitalization, all the 3 conditions needs to be met. It's not a single, so all the 3 conditions needs to be met. So basically, the expenditure for the asset would have been incurred, and the borrowing cost for that particular asset also would have been incurred. Lastly, the activities to undertake this particular construction of the asset, that needs to be started. So without having any of these conditions, the commencement of the capitalization cannot be made. So we'll take some examples of when to commence the capitalization of this asset. Say for example, it's not only about the physical construction of the asset, but also about the technical feasibility and the general admin work of this particular asset to kick off the construction. That also needs to be started. So not that the physical construction as such. So in case if any of those activities has been started, still it qualifies for capitalization of the assets. And in case say for example, if the land has been taken for development, okay, so the land procured for developing for constructing a land and building on that, when the development activities does not start, then that will not take the characteristics of qualifying asset. So which means the land has been procured, however there is no plan to construct an asset on that, hence does not qualify. So the intended, it's ready for use condition as such. However, the land has been taken and some of the activities for developing this any asset on that has been started. So hence it will qualify for as a qualifying asset, hence needs to be borrowing cost needs to be applied. So there is a thin margin in capitalizing whether at what time this needs to be capitalized.
So basically when you are applying for approvals and getting it,
Yeah.
intention is there to construct.
Yes, there should be intention, and also there should be a activities that supposed to be kicked on. So otherwise it's not. So then comes to suspension and cessation. So when to suspend the capitalizing the borrowing cost, when to stop the borrowing cost. This is SOR have asked for it. So the capitalization of the borrowing cost is suspended in during the extended period of delay. So there is a definition has been given. What is the normal delay? What is the abnormal delay? So when the activity for developing this particular asset stopped temporarily, say for the normal monsoon period, if this particular asset development activity has been stopped, hence that does not qualify for suspending the capitalizing the borrowing cost. However, if there is a abnormal delay, say for example labor strike or something called natural disasters like earthquake or national calamities like flood, so hence this particular borrowing cost capitalization needs to be suspended for those period. Again when it's kicked off again it can start capitalizing it again. For the normal scenario, when to stop the capitalizing the borrowing cost. So when this asset is ready to use or when the asset is ready for sale, so in that particular scenario that does not qualify for the qualifying as, hence the borrowing cost needs to be, that is borrowing cost adding to the asset needs to be stopped there itself. So subsequent any of the costs shall be charged with the P&L. Yes. Yes. So again, for example, in case this constructing a plant is ready, that is premises has been ready, however it's pending for installation of the equipment or installation of any of the machineries. So in that case, the construction cost of this land and building that can be capitalized. So the installation of the machinery is the subsequent criteria. So the borrowing costs associated with the land and building, by the time when it's ready for installing any machinery, that can be capitalized.
Can we say that till now the machineries have not been installed? It's the structure which has come. But our intention is to start a plant.
Yes.
So can we say that the intended use is, we have not yet come to the intended use?
Intended use for this land and building, because my intention is to complete the building. So building has been completed. So to that extent, I can stop capitalizing it. Yeah. Yes, you are right. So we spoke about the normal or abnormal delay. So that is one of the challenges. And coming back to the commercial production. So generally there may be a question saying that when I stop capitalizing the borrowing cost in case of any, whether if I start the commercial production, should I stop, or should I stop when I start doing my testing? So the standard permits until the testing is completed to kick off the commercial production. So until such time, this standard permit you to capitalize the borrowing cost. So post to that, it's supposed to be charged to the P&L. So then there is an impairment. Also, this particular standard has been spoken about it. So it's a simple rule. When there is a recoverable amount, or recoverable amount has been is lesser than the carrying amount, then that particular thing needs to be kicked off. Anyway, I'm not touching upon this particular thing. It's governed by the separate standard, but this particular standard says about this as well. Coming to the disclosure part, there are very two simple disclosure. One, the borrowing cost capitalized during the period needs to be disclosed in the financial statements, and the capitalization rate, which we spoke about before, in case of generalized borrowings, what rate this particular entity has been considered for capitalization, that needs to be disclosed. So which will be very specifically needs to be disclosed in the financials, so that the general users can understand what stand this company has been taken, what rationally began applying this particular standard. Coming to the last, the difference between the IND AS and IAS is a very one simple difference. IND AS provides the recognition criteria for treating how to treat the exchange difference arising on account of foreign currency loan. However, IAS does not provide any guidance to that extent. So this particular treatment already is there in the AS 16 as well. However, IAS does not have this particular treatment. Coming to the, what is the difference between the IND AS and AS? There are a couple of differences, specifically the scope exclusion. So financial assets, inventories, or fair value asset which does not cover any this particular standard. However, AS does not have any scope exclusion. However, no, those things may not be applicable considering there is no fair valuation under the AS. And interest cost as per the ER method, that is specifically available only in the IND AS, not there in the accounting standard. The exchange difference reversal, say we spoke earlier, accounting standard permits only if there is a loss that needs to be added to the cost of the borrowing. However, it does not provide any guidance for reversal of any gain, future gain if any. However, the standard provides such reversals. And substantial period of time, AS provides what is substantial period of time. This is generally a 12 months period. However, this standard does not state about the substantial period of time. So one has to take some judgmental about the substantial period of time to assess whether the asset is taking substantial period of time to develop or not. Hyperinflationary economics, which we spoke, that also is not there in the AS. The capitalization rate disclosure, which is specifically available on the IND AS, not there in the accounting standards. The foreign currency borrowings, which is the functional, it has been taken as a functional currency. However, in the accounting standard, it has been stated as a local currency. So when the company follows a functional currency different from the local currency, this does not. The AS won't cover, however accounting standards covers. Coming to the transitional, so when the entity follows accounting standards and it's transitioning to the IND AS, so there may be some certain challenges. So I have brought only one challenges. This IND AS 23 does not provide any exemption or exclusion for applying the the transitional. So it needs to be applied for all the criteria for borrowing cost needs to be applied retrospectively. However, there is a crux over here. Generally, this borrowing cost will be added along with the qualifying asset. So the qualifying asset can be your PPE or inventory or whatever it may be. So in case, to avoid this particular retrospective application, in case if the entity applies the deemed cost as a fair value at the time of transition, this can be avoided. In case if the entity chooses to reconstruct the cost of those the PPEs or whatever, then fair valuation needs to be taken. Then you have to assess what are the past borrowing costs in terms of ER method, in terms of dividend, etc. So hence those costs needs to be added along with the cost of the asset. Then it needs to be reconstructed for arriving the fair value of the PPE. So generally this will be a challenge if you choose to adopt a retrospective method rather than the cost as a deemed cost as a fair value. When see at the time of transition, whatever the assets you hold in your you control, for those assets it needs to be arrived for it. So in case the asset is already disposed, for those things is not required. So in case what are the assets you hold or own, for those assets needs to be. Yes. Yeah. So that's it from my side. So any questions, it can be answered. Yes, it can be added in case if the inventory is taking substantial time to convert into the intended sale or use, then it can be added.
So possibly it could be when a building contractor, flat promoter, that could be a practical example.
Yes. Thank you. Thanks for your time.
Thank you so much, sir. All. Now we would like to introduce for this session CA Sankarakrishnan sir. He is a professional in the audit and assurance practice and a company secretary. He is having 13 plus years of experience in Big Four audits handling statutory audits, group reportings, tax audits of manufacturing, information technology and other services sectors. He is well versed in Indian GAAP, Indian accounting standards, IFRS technical subjects. He have conducted several sessions in the field of audit. With this short note, on behalf of SIRC of ICAI, we would like to welcome this session speaker, CA Sankarakrishnan sir. Thank you on behalf of SIRC of ICAI for accepting our invitation.
Interesting session, okay, for any company. The reason is that any company as a reader of financial statements, the first key intent would be the revenue, not even profit. There can be companies who are willing to sacrifice the profit in order to penetrate to the market. That way revenue will assume that number one significance. And number two, we as auditors, invariably 99% of the companies, we consider revenue as a significant risk unless there is a very hard reason to rebut it as a significant risk, like cost plus companies. That way revenue standard is the most critical amongst all the IND AS standards. Having said that, this revenue IND AS 115 standards extends to a lot of things, which will extend to some 3 hours of, if I need to cover the entire session, it will take 3 hours, but they have said that we need to wind up by 5 o'clock, max 5 minutes, so I have half an hour to go, okay. So
what I am saying, I'm not going to run through the slides now. We don't have time. If we start the slides, I won't even be able to cover 10 slides. So what I think of doing is that key concepts alone, I'll just put across. Whatever challenges I faced in Ind AS 115, whatever the accounting complications, what I have faced, I can put across. Similarly, I would be glad to hear from you whatever doubts or queries you have in your practical experience of Ind AS 115 so that we can discuss on that. Actually, yeah, the day what we planned for certain hours for each session, but somewhere there was a spillover, and so we were not able to complete it. Yes, fine. So we have to live with it. Yeah, fine. Fine. So this is how the agenda was like. The scope, effective date. So I'm not spending too much time in all these things. Okay. The effective date was 2018 March. That was the first year in which we implemented, and this is the 5-step model. I'll go to the slide. Yeah. See, with the applicability wise, this applies to all the customer contracts. The only exceptions are lease contracts where it is governed by a separate standard, insurance contracts again separate standard, financial instruments which is governed by Ind AS 109, and the fourth one is only a little bit of critical, critical in the sense we come across this kind of a thing in our regular scenario, non-monetary exchanges in entities in the same line of business. Somewhere we kind of miss out in this kind of thing when we come to auditing large companies. Okay, I can tell you one example before I go to solution. For example, a telecommunication company, okay, they enter into an agreement with a power sector company. Okay, just now I'll just move the slide. The condition is that I will give you 1 lakh hours of talk time free, provided you give me so much electricity free. Okay, so with zero consideration, I will not pay you anything, you will not pay me anything. Okay, whether this is covered in the scope of, whether this can be taken for exemption under Ind AS 115, the answer is no. Okay, the condition is that both the companies should be in the same line of industry. Okay, for example, I will say Airtel and Vodafone, they get into a contract with each other. I will give you this much talk time, you give me this exemption. That is in the same line of business where we can draw this exemption and take it out of purview of Ind AS 115. But if it is not in the same line of business and not for a single commercial objective, this whole exemption will not hold good. So this is one thing which will assume significance, because in large companies and all, this kind of transactions are quite normal. Okay, so that is one thing. No, that will like a normal revenue. Like whatever I am getting from me, I will account in terms of Ind AS 115. He will also account in terms of Ind AS 115. That will very much be covered under Ind AS 115. I am saying. See, what I am saying is, if it is the same line of business, that can be just netted off. It will not hit your P&L at all. Okay, because zero consideration, not a purchase, not a sale. It will go out of Ind AS 115. That's what I am trying to say. That does not, that's what all these 4-5 bullets does not attract Ind AS 115. That's a heading. Apply to all contracts with customers except the following. Okay. Okay. Yeah, it will be covered under Ind AS 115. Yeah, that's what I am saying. So in order to get that exemption, make use of this exemption which is given, the condition is that should be in the same line of business. Okay, as long as it is not in the same line of business, I cannot make use of the exemption. That's what I am trying to say. Okay. Now I'll go to the 5-step model. Okay, identify the contract with customer. Okay, you see. Okay, I'll go to this slide. And every 5-step model has got number of sub branches. Okay, in this identify contract, there are some challenges in that. Identifying performance obligation, and the third is what is the transaction price. Fourth is allocation of transaction price amongst the performance obligation. Fifth is for the satisfaction of performance obligation, recognition of revenue. Okay, here 1, 2, 3 will assume the higher weightage, because if 1, 2, 3 is ticked off, 4 and 5 are more or less resultant only. Okay, so with regard to 1, 2, 3, if I go step by step, every caption has got various various unique things in that. But now unfortunately we don't have the time to cover each and everything. But for certain things certain key aspects of that I will be able to take you through. Okay, just a minute. Yes, please. Yeah, Sure, sir. Now the construction contract standard is subsumed inside IND AS 115. There is no separate standard. Okay. Yeah, for fixed bid projects and all, percentage, that's where in step 5 you will have at a point in time and over a period of time. Okay. This construction contract where I recognize revenue by percentage of completion method, that gets covered over a period of time. That is still applicable. See, the only thing is the entire standard has been taken out, but the same logics where what we apply over there, percentage of completion, cost incurred till date by estimated total cost, and that percentage we apply on the contract revenue, cost, everything. That thing is still live. It is still live. That's why in step 5 you will have at a point in time and over a point in time. Okay. This will get covered under over a point in time because the control etc. is not transferred on the spot. It's not, for at a point in time you have a condition, simultaneously receive and consume the benefits. Here you don't simultaneously receive, it is extended over a period of time. So that is why it gets covered under over a period of time. Okay, fine. Yeah, so here if I need to attach weightage, so identification of contract in the sense contract definition etc. I am not getting into it, like it can be oral, it can be written. Only thing is that the conditions of contract, certainty of collection, certainty of collectability etc. Collectability, certainty of amount, that should be in live in order to establish as a contract. Where the 5 conditions of contract is not fulfilled, the amount that I receive I cannot recognize as revenue, I can only park it as an advance. And only when the conditions are satisfied I can recognize as revenue. I can tell you one example over here. Okay, like nowadays manufacturing companies, they have this tool financing, they have something called a supplier tool financing. That is one small example. I am the company, okay, I am selling goods to a normal customer. Customer will not pay me, okay, there will be a tripartite agreement between me, customer and the bank. Okay, bank will pay me the amount. So as I sold, I got the amount, no problem for me, I got the amount. Tomorrow bank will go and collect from the customer. But the unique thing is, suppose if the customer dodges the bank, customer does not pay to the bank, bank will come and catch hold of me. I paid you the amount provided customer will pay me. Today customer is not paying me, give me back the amount. In this case, can any of you, out of your experience or out of what your thoughts, how do we recognize revenue in this kind of a scenario? Can you let me know your thoughts? So when bank pays me, I will recognize revenue. No, I don't pay to the bank. Like yeah, okay, I'll repeat. I am the man. I sell goods to okay, he is the customer. Okay, I sell the goods to him. Okay, in a normal scenario, I will sell goods to him. He will pay me. There ends the matter. Here there is a third party involved, bank. Okay, I sell the goods to him. He will not pay me. Bank will pay me. What is the amount? So from a seller point of view, I got the amount. What is the product that I sold? For that the amount came for me. Only thing is customer didn't pay me. Bank paid me on his behalf. Tomorrow bank will go and collect from the customer. That is between him and the I don't get involved. Yeah, that's what I'll come. But the one thing is, tomorrow if he doesn't pay the amount to the bank, come and catch hold of me. That's what I'm saying. So my question is, when bank pays me money, what should I account it? Should I knock off my debtors or how should I account that money? That's my question. Okay. That is also one thing. Okay. Fine, that is contingent liability is also one option, okay. But if you see the conditions for identification of contract, one of the things is a collectability threshold, okay. The one which is in the middle box, it is probable that the entity will collect the consideration to which it will be entitled in exchange for goods and services that will be transferred to customer, okay. Here I would say there is no direct answer, you need to see a trend, okay. At the initial stage, I cannot take 100% surety that this guy will pay to the bank and I cannot knock off my debtors and recognize revenue. I have to park it as a advance received from a customer. I have to park it like that, okay. Tomorrow when I get a confirmation that this guy has paid to the bank, only then I can move it to my revenue.
Only to that extent?
Yeah, to the extent that can yes, to the extent there is a question mark on the amount, to that extent. See, it can be various. 100 rupees I sold him. It's not that entire 100 rupees is a question mark for me. Tomorrow if he dodges, maximum liability bank can extract from me is only 80 rupees. 20 rupees nobody is going to challenge me. then I will knock off debtors to the tune of 20 rupees, and the balance 80 rupees I will park it as advance. Tomorrow when he pays to the bank, when the customer pays to the bank, I am dissolved of any further liability. That time I will knock it off with my debtors and recognize as revenue. No, it's not I got the amount here, that's what I am saying. The entire 100 rupees bank has paid me, but the contract is reading as tomorrow if he dodges the bank can sue me for 80 rupees. Example I told, example. Okay, if you can sue entire 100 rupees, will go to advance. Point I am trying to make is, to the extent of question mark that is lying, what can be the possible cash outflow from my side tomorrow if he dodges the bank? That amount I need to park it as an advance and not recognize as revenue. That's what I am saying. That amount you park it as advance, I am saying. That is because see, this is a common thing which is coming in across in many manufacturing companies. Okay, this supplier, because they have a tripartite agreement between bank and customer. Many firms take a version, and there's individual positions also. There is no hard and fast EAC opinion or ITFG in this regard. But on a commonly observed accounting positions that bigger companies are also taking. Okay, in OEMs and all, this is a common scenario. The end conclusion is this is what they decide. Okay. The end conclusion is that tomorrow, if assuming everything goes wrong, the customer does not pay anything to the bank, how much bank can come and sue me? That extent I have to park it against my advance, and the amount that bank can never recover from me. This once bank pays me, that is my money. Never they can recover from me. That amount I knock it with my debtors. Okay, why I brought this example was the collectibility, identification of the collectibility is one of the factors for identification of contract, right? That's the reason I brought this example over here. That's what I started saying. If I need to say trend or the first transaction, I cannot take that call. Okay. If as you say over a period of time he has been paying, etc., then I will bring the contingent liability fully, and I will recognize as contingent liability, because that could go against my contingent liability. Okay. So you have to see the trend, like how we do for our earlier MEAS and all. We see how much trend has been successful, and to that extent we provide for that. Similarly, I will take a call in that case. Okay. But one second, sorry sir. But this being a new concept, now it is a little bit safe not to go by the contingent liability route at the moment, unless you have an absolute surety he is a 100% good customer for me, he will not default, and that has been proved by the past trend. It's safe not to take that route. Yes sir. Okay, if the contract is worded like that, it's okay. Okay, fine. No, not even referenced to that. Not even referenced. Okay. Yeah. No, anyway, we are not going to complete. So whatever doubts we have, we can discuss. 15 minutes now. Whatever doubts, unique things. What we can do. And no, on GST it's only, I'm only agent now, sir. Again, coming back to the principal versus agent. Now, since you asked this question, I'll bring that principal versus agent. In terms of GST, I'm just collecting from this guy and paying to this guy. Okay, I'm collecting amount from customer, paying to government. Okay. Oh, okay, now I'll start with the principal versus agent concept. Okay, as a part of it, GST will also be covered over there. Okay, see, I'm not going in any order. Since whatever questions are there, I'll raise that concept. Okay, because you have, yes sir, yes sir. We could have, no, one second. What I thought was this, sir. No, I asked them. I asked them. It looks like they have some validatory function or something, so they don't want to. No, I asked them. That's why they said that maximum 5 minutes you can extend, not beyond that. They said, yes, sir. Sorry, sir. Sir is asking in 1 minute. Yes, sir.
On behalf of the customer, I am paying it to you. Where is the question of my calling back that money from you?
That's what I am saying, sir. That, see, if you see on a practical term, that's how the contracts, tripartite agreement is entered into. In a car, when we are buying a car, okay, I'll tell this example. Many times we are not paying the entire amount, okay. Bank is paying the amount to the car vendor on our behalf. I will pay monthly EMI to the bank, to the bank, sorry. Tomorrow if I stop paying the EMI, I don't pay the EMI, I dodge the bank, okay. Bank, in this case, how the contract is worded is, bank will not come and catch hold of me. Why you are not paying me EMI? Bank will not come to me. Bank will go to that car vendor and say, on your behalf only I paid the amount. Today that guy is not paying me. Give me back that money.
See, car is hypothecated.
No, example.
Car is hypothecated. They have got the right to seize the car. But in the normal circumstances.
Example, sir. It's example I said.
I have a doubt. How are the car manufacturers?
Yes, sir. No, I took an example. I just told you car was an example. I said, okay, car cannot be exactly applied since we are talking about a tripartite agreement where one guy is giving the amount on behalf of another guy under the condition, under the trust that he will pay me back. If not, what will be the consequences? For that, I took the example. The underlying concept that I am trying to say is there should be a certainty of collection in order to consider it as a contract and recognize revenue. That is the underlying fact that I am trying to draw. That's what.
Okay. I have a doubt since you told about this car, suddenly that Ola issue came into my mind. So let's say Maruti dispatching cars to dealers. Do they account it as a revenue after the car is registered? Will they account it as a revenue after once the car is dispatched to the dealer, or only after the car has been sold and registered?
We need to see how the contract is worded, sir, in this case. See, there can be three scenarios, okay. Maruti is selling to dealer is selling to the end customer, okay.
No, the first one, is it a sale or they don't sell it? Because the GST comes into play only when I buy it? Okay.
Okay, let me explain, sir. I'll explain the scenario. We are more or less going to the principal versus agent concept only. Sure, sir.
So basically, now if you see, this was a Maruti example. I'll just give another scenario in this. Mercedes-Benz earlier used to sell the cars to the dealers, and dealers would sell the cars to the customers. Now Mercedes-Benz have stopped doing that. Now the dealers get only the commission, right? Mercedes-Benz directly sells the cars to the respective customers. Now you can just highlight on.
Sure, sir. Fine, sir. This is fine. So now I'll take some 5 minutes to answer because this is a little bit of elaborate answer. Okay. The deciding point when to recognize revenue is that when does the control gets passed from the seller to the buyer. Okay. There can be three scenarios. I'll draw the first one, which is a X-Works model. Okay, the moment see Maruti is okay. Both. Now I'll divide these two into two later. First I'll say the concept. The moment the car moves out of Maruti's premises to either to the dealer's premises or end customer premises, risk goes out of Maruti. On the way damage happens, something happens, Maruti is not responsible. I will recognize the revenue the moment it moves out of my gate. Okay, whether I involve a dealer or don't involve a dealer is second question. Okay, and the second thing is could be an FOB contract, free on board contract. Not necessarily, sir. Not necessarily. X-Works by definition means that whether he comes and collect or I deliver the product. No, sir. No, that's what I'm trying to say. Okay. No, 1 minute. No. I am saying the moment. No, 1 minute. The moment I am saying the moment it moves 1 inch out of my gate premises, my sale is over. Whether he comes and collects or I go and deliver, that is either. The moment. Only when it moves out of my premises. And okay, when it is in my factory, something happens, I am still responsible. Okay, fine. This is the number one, sir. Number two, what I will tell is free on board. Okay, that is okay. This is in case of when shipping is involved. Okay, the moment these goods are uploaded into the ship, up to that port, until it reaches the port and it is uploaded into ship, still Maruti is also. I will not recognize my sale. The moment it is uploaded into ship, that moment I will recognize sale. On the way, damage, whatever happens, I am not bothered. Okay, I recognize the sale. Third is the final one, CAF. Okay, and whatever examples I am saying, irrespective of whether dealer is involved or not, I am saying CAF. The moment it goes and lands in the customer's port, that is he is shipping from Delhi to Chennai. The moment it comes and lands in Chennai's port, okay, I will recognize Maruti can recognize revenue. Last one is DAP, delivery at premises. The moment this is like our people like us, end customer. You do whatever you want. It comes to my house in proper condition. Only then I will pay you. Until that, I will not hold any responsibility. That time only Maruti can recognize sale. So, to answer your question, whether dealer is involved or not, when do I recognize revenue? Okay, these are depends on the contract. There is no direct answer to it. We need to see the contract. When does the control get transferred from my hand to other hand? But that is not this like how I told that easy. Okay, there can be unique cases. I can tell you some examples. Okay, it's a X-Works contract, plain X-Works contract. Okay, so the moment it moves out of my factory, but insurance still Maruti is taking. So on the way, any damage happens. Okay, only Maruti is responsible because Maruti can go to the insurance company and get the amount. Customer is not bothered. Okay, so in that case, you have to apply substance over form. Okay, so the moment, despite being an X-Works contract, I can recognize revenue only when it gets delivered in the customer's premises. This is a unique thing because the reason is dictionary meaning is X-Works. I am eligible to recognize the moment it goes out. But unfortunately, insurance I am taking. So tomorrow if anything happens, I will be the person. Continues. In the substance over form. Continues. Okay. So that way, I still recognize revenue only when goods are delivered at his premises. This first part to your answer. Now considering your GST, now I am come to principal versus agent consideration. Okay. How do I recognize revenue? My invoice value is 100 rupees. Freight amount is 10 rupees. My total base price is 100 rupees, freight is 10 rupees, total invoice value is 110 rupees. Okay. How it happens is freight I will collect from the customer, pay to the vendor. Maruti is not a freight company. Okay, customer can involve anybody to collect it. It's just an additional service that he is doing. So my question to you is, how much should Maruti recognize revenue? Is it 110 rupees top line and 10 rupees what Maruti is paying to freight vendor as other expenses? Knock off the 10 rupees. The 10 rupees I cannot call it as my revenue. It's after all I am getting from him and paying it to him. So knock off neither in revenue not in expense and just recognize 100 rupees as top line. What are your views? Then I will tell my answer. You understood my question here? Okay.
then 110 rupees should be the invoice value.
Okay, sir.
Therefore, they have to recognize 110.
Okay. Okay, I heard both the answers. Any further answers before I tell the, maybe this could be the final topic we are discussing. Actually, what we thought was, if we finish other sessions and all earlier, we will have solid time for this session. If we thought this session will consume the entire first half and second half, other sessions we won't have time. Now it became the other way around. That's the problem. Okay, any other answers? That's why what I thought, then it will go to 3-4 hours, then we will not have time for other sessions and all. That's why we kept it at the last. Like Dhoni come in the last and finish.
See, I think just one thing. I think recently Ola got into controversy because there was a mismatch between what the motor vehicle authority registration count and what the company showed as a sales, because that moves that's against what you have been telling. It's easy for them to prove that the goods have moved out of the respawn.
Okay.
Then even Maruti, I think, there is every month, there are newsmakers, who take data from the registration department and saying so many vehicles have been registered. So I feel there is an inconsistency. I have a doubt, it's only on registration, even because otherwise, they'll start dumping the goods onto the dealer. Maybe they want to restrict that practice, and that's why I think the practice could be slightly different.
Okay, common practice, as you say, it will vary, sir. Okay, as you said, registration is also
because this Maruti, that's widely tracked by the market analyst.
Fine, that's what, as I said, how the contract is worded. As you said, there can be cases upon registration also, upon RTO. I think that are not normal business practice. Okay, I am talking more from the point when the control is getting transferred. Okay, that is what I am saying. Now coming back to your. The earlier AS9 was a little bit simpler, that was talking more about risk and rewards. Okay, this is a little bit of an enlarged concept where we are talking about control, which is a little bit enlarged about this risk and reward. That's why all the subdivisions, sub branches are all coming into play. Okay, now coming to answer, I'll spell out my answer. Okay, again same thing, there is no direct answer. You have to see principal or agent. Okay. Principal or agent, there are a set of conditions to be, para B35 of IND AS 115, set of conditions to be satisfied. Okay. Now I am not going to each and every bookish conditions, I am just telling you on what conceptually what do you do. Okay. So what is the relationship between me and the freight vendor? Okay. See, is it like as a Maruti, I identify the price of freight vendor, I charge him I decide the rate with him, and everything, I have the control on the freight vendor. Okay, and he has to go and deliver at premises, and customer has got no voice in telling this should be the price, that should be. You give me the price. Okay, and it is like my freight cost is inbuilt inside my sale price. Okay, that does not mean 10 rupees if the freight vendor is increasing the amount. That does not mean sale of amount will also correspondingly go by 10 rupees. Okay. I have a separate control on freight vendor, then I am a principal. As sir said, we will recognize 110 rupees as revenue, 10 rupees as expense. Number one. Okay, where I have the ability to direct, I have the ability to control the vendor. Okay. Number two, there can be cases where customer will direct me. Customer will tell, see, I only should come and pick up. For my convenience, I will arrange one freight vendor who will come and collect. I will pay to you, you pay to him. Okay, rate and all I will decide, that is not your choice. Okay. That is a case where I don't have any control on freight vendor. My job is collecting from here and giving it here. Margin, nothing is there in that case. There it's a plain pure agent. I cannot call 10 rupees as my revenue. Okay.
So Maruti becomes the agent.
Agent in this kind of example. That's what I said. Maruti is not a freight company. Okay, they are a manufacturer. It's just because for a facility sake they are organizing this freight. That does not mean it's 10 rupees their income. They will take from him and give it to him. So there I have to net off. It will not come in my P&L expenses side also, it will not come, income side also it will not come.
Even though it's part of the invoice.
That's what, even though it's part of invoice, it has to be net off. More or less, that's what, invoice is being 100 rupees plus freight 10 rupees, total 110. I have to net off this 10 rupees. My top line will be 100 rupees. Despite the invoice reading as 110 rupees, my top line will be only 100 rupees. Okay, because technically what is right now? See, I am not a freight company. Okay. No. This is how the standard is written. It will be a reco item in your GST. Correct only. Yeah, that's what it's your reconciliation. Yeah. So why I brought. No, see, one invoice or two invoice on a practical purpose, what companies can take a call. Okay. Okay. Irrespective of one invoice or two invoice, what I am trying to say is the definition of whether I can gross up or net off will go. This is how it will be done. Okay. So now we'll go. Can continue or no one has come? Okay, continue. When madam is coming? Okay, until madam comes, we'll continue. Okay, when madam comes, maybe we'll take a halt. Like they. That and all in real scenario nobody happens. That and all doesn't happen. It only is written in the standard. Orally, I agree something. Oral is also. See, now I am coming to Indian contract binding. In real, I agree with you something orally. Okay, there is no record for that. That and all in real sense it doesn't happen, sir. That's what I am trying to say. Everything, at least in India, I will say everything is in a writing paper only. I talk to you orally. That oral will not get recorded anywhere. That's all. Okay. Auditor, you will be even more cautious, sir, because we cannot go by words, no. We need to go by substantive evidence. Tomorrow in the NFRA, some regulatory comes and asks, I cannot tell. I spoke to him, he told me, I cannot tell, no. That's what I said. The 5 conditions are to be satisfied for validity, collectability, certainty. That's 5 conditions. No? So that's what I said. Now I'll take some examples out of step 2. Okay, identifying performance obligations. Okay, this is more or less subsumed in the same example that I told us. When do you split the performance obligation? When do you split the performance obligation? There's a large contract, that is sale, freight, everything is there. Should I recognize sale and freight as one performance obligation, or divide it into sale as one and freight as another? Okay, again, since I took this because it's easy to explain, only I finished that one. How when does my responsibility go out of my hand? Okay, is it like, for example, like X works kind of a scenario where the moment I move it out of my factory, it's not necessarily I only should go and deliver it to anybody, he can involve anybody. Okay, that is a case where I split the performance obligation, sale of product, sale of service. Okay, but if my responsibility is a DAP Incoterm wherein it ends only it is delivered at his premises, that there I should bundle it as one performance obligation and I cannot split it. This is an easy example in case of service where I deliver it at his premises and installation, erection, everything should happen, only then he can use the product. Okay, or is it like, see, I am purchasing a TV at my house. Okay, if the TV supplier doesn't come and install, I will involve one local mechanic to install. Okay, it's not that guy only has to come, I can enjoy the product despite he not completing. There I can break it into 2 performance obligations. Okay, but if it is a manufacturing company specialized instrument where the supplier only can finish the installation, I can until he finishes installation, that is waste. I cannot use anything, that is only occupying my space. That kind of a scenario, it's one performance obligation. This easily I told, but if you see the example, it will be like, when does the customer enjoy the usage, when does the customer, all these will be deciding parameters to decide when I can recognize revenue, because this is more in terms of cutoff. Okay, in a product, in a company where AC, big AC installation and all, product might be delivered as on March 31, but installation might not have completed. So always the question remains, can I recognize revenue to the tune of product alone, or should I wait till the installation complete? Then I have to see customer's point of view. Just because you have delivered the product, okay, will he pay you the amount for the product and you will wait for and he'll wait until you complete installation, etc. Or for him it is usable only when the installation gets completed. So just because you have given him the product does not mean he will pay you the amount. Okay, when the surety of a collectability question is ticked off, all these we need to evaluate while deciding when the revenue can be recognized. Single performance obligation or multiple performance obligation. Okay, so this is on step 2. Okay.
In these big AC installations, you have the company which is directly dealing with you for the equipment, but they have certain authorized dealers who do the installation, right? So in this scenario, when the moment the company delivers, their obligation part is over, so it can be recognized.
Yeah, that's what, how the contract is worded.
But as far as customer is concerned, till our installation is not done, I cannot use the AC.
Exactly. That's what I am saying. When does the surety of collection happen? See, dealer may go and install. Okay, dealer may go and install. Then again coming to the tripartite, does me as a company, whose dealer is it? No, whose dealer? Okay, whose dealer? Customer's dealer? Who fixes the dealer?
The AC company, say Mitsubishi is there, and there's a dealer, authorized dealer, XYZ, and a customer is there. So, company will not deliver the machinery to me till I don't make payment. So, I will make payment to them, then they deliver. But till now, installation not yet happened. And now the dealer has to come do the installation, and then only it is usable for
If it is a single contract, where in my contract as a Mitsubishi with the end customer, if it is worded saying that I will deliver you this product, and either me or authorized dealer, whoever it is, we will ensure that the installation is complete. If it is worded, then as you are telling, I cannot recognize revenue until whoever installs, either me or Mitsubishi, because he is not going to pay me the amount just because I went and delivered. So I cannot recognize revenue even despite me delivering the products. Okay, or it's two separate contracts. One contract is only on sale of products. Other contract is only on the installation, either by me or dealer, irrespective of that. Then to the extent I deliver the product, he has to pay me. Okay, that contract is satisfied. Then I will recognize revenue to the sale of product. Sale of service, again I will go back to principal agent evaluation, who fixes the dealer, everything, then accordingly I will recognize the sale of service. Okay, fine. Now coming to step 3, transaction price, determination of, see, transaction price in the sense, it's very easy as it sounds. For example, how much is the sale price, how much the performance obligations, etc. To that extent I recognize revenue. But in real life, it is not that simple as how it sounds. Okay, you have the concept of variable consideration, significant financing component, consideration payable to customer, all these. Just to touch upon each of these with one example. Okay, variable consideration. For example, this will involve my discount, rebates, refund liabilities, etc. Like I can say one for refund liabilities, I can give you some examples. Like see, Ford as a when they were selling, not now, some 10 years back, or they were selling, there was some issue in their cars, and that went to the end customers. Itself. So everybody started suing. Getting the refund, etc. Okay, so originally when I sold, I recognized revenue. Okay, now till today I got some amount of claims which ideally I have to provide for that one. Okay. This refund liability concept is that I need to estimate. Okay, so far I made 100 rupees of sales. Out of 100 rupees, I got for the sales worth 80 rupees, I got 10 rupees of claims so far. So balance 20 rupees, it's only a matter of time. As on today's date, customers are not come back. I know very soon they are going to come back. So I need to estimate that refund liability and accordingly reduce it from my transaction price. Okay, that is the concept of refund liability. I need to estimate what could be the potential cash outflow from my side for the sales I have already made. It could be in the form of sales return or discount or rebate or anything, that could be a scenario. So all these will play a role in determination of transaction price. Now coming to consideration payable to customer, this is typically in case of volume discount, etc. That is, see, for example, I have a contract with the customer. If you get 100 products from me, I will give you 10% discount. 99 products also he will not get any discount. If he touches 100 products, I will give him 10% of discount. So in that case, if see, just because he has not came and claimed from me, I cannot recognize revenue for the full 100 products. I need to provide for the 10%, because it's only I know, because as per the contract I owe him this 10%. So that should play. No, if he has not reached the 100, it's okay, then I don't need to provide, because there is no surety that he will reach. Okay, when he reaches, I will provide. Okay, he has reached already, and as of the balance sheet date he has reached, but he has not come and claimed from me. I should estimate again. Now this amount, example what I told, will you net off against your revenue top line itself, or will you take it as an expense in your P&L? That is, example, 1000 rupees, 100 products value is 1000 rupees. The amount that I need to pay him back is 10 rupees, okay, 100 rupees, okay. So will I recognize revenue for 9900 rupees, other 1000 rupees minus 100 rupees is equal to 900 rupees, or I will recognize top line to the extent of 1000 rupees and keep 100 rupees as a provision and expense in my expenses side. What do you feel is the right approach? Okay. Okay, any other answer? Any other answer?
Make a provision, sir. You cannot touch the top line.
900 should be.
Okay, you are saying it should be grossed up. You are saying it should be netted off.
Top line we should not touch it because it is only an assumption that the claims may come.
No, but it is confirmed that we have given that 100 rupees offer already. That out of the you reach 1,000, then we'll give you 100.
Of course, but the sale of 1,000 is certain, isn't it? The sale of 1,000 is a
Giving that 100 is also a certain.
No, as what he says is, even though you cannot call sale of 1,000 is certain, 1,000 rupees I got, out of that 100 rupees I definitely need to pay him. I cannot call 1,000 as my money then.
Sir, if it falls in the next financial year, you cannot touch the top line of last year.
But I know, before the accounts are finalized, I know for the sale that happened before March 31st, this kind of a liability is there. Only thing he has not came and claimed from me as of the balance sheet date. I know that tomorrow sale has been already made. It's only a matter of time when he comes and claims from me. See, the answer is okay. Para D70 of IND AS 115. Distinct is the word it uses. Distinct. Okay. Is the volume discount that we are talking about distinct or not? Okay. Again, what is meant by distinct? There is a set of conditions for that. Okay. If I tell you a little bit on an overall basis, is it like bundled one? Like for example, both are we reading one and the same? Is it the contract worded like the moment you touch 1,000 rupees, I have 1,000 products, I definitely need to give a discount. You cannot separate both the things. Then in that case, you have to net it off, okay, because both are combined, bundled as one and the same, okay. Or if it is like conditional, put it right, okay. See, it's like advertisement companies. Tomorrow you may get or you may not get. There is no surety in what you are getting. It is an offer which may materialize or not, and it's a standalone. Okay, that kind of a scenario, I will gross it up. So the emphasis on the word distinct. The example I told you was a bit on a higher side, but if you go into the conditions, that is a little bit. It will go into a more deeper. How is it the contract worded? I definitely mandatorily I cannot refuse paying that 1,100 rupees back to him, and both are jointly to be read. In that case, it should be netted off, or both are two separable. Tomorrow it may change, the policy may change. Instead of 10% discount, it is a 12% discount. All these are only our wish list. Tomorrow we may or may not get this discount. That kind of a scenario, I have to show it as a other expense only. I don't need to net or touch my revenue. Okay. So why I brought this example was the step number 3. Transaction price, it is not as easy as it sounds, like a sale price. Like all these will play a role in determination of my transaction price. Okay, and if you see the bigger clients, whatever you are doing, all bigger Fortune 500 clients and all, these kind of things are quite common. These all unique complications will be there. And whatever I am saying, we have practically gone through in some of the larger clients.
So now, what do you do in case of AGO? You have purchased online product, say a shirt. But still the customer has that 15 days window for a return or something. So in that case, only at the expiry of that refundable period only.
No, that's again going back to refund liability concept. So on a trend, 15 days if he has got the right to return, in the past how much have been the percentage of my returns? In the past overall throughout the year I have made 1,000 rupees of sales, and on that only 100 rupees I got returns. So 10% I will estimate and I will provide for that one. That is where I need to play the trend. I have to play like warranty, like as good as warranty. Okay. So I have to, the entire concept of refund liability is an estimate only. How much has gone wrong so far, how much could go, and again if it is like a specific reason, just because in past this has gone wrong, that does not mean in future also it will go wrong. If it is on account of specific product default, Ford example, Ford one blunder they made, that does not mean every time they will make that blunder. If it is specific item means I don't need to carry out that proportion going forward. I have to read it as a standalone thing. So I have to estimate all these and I have to decide my refund liability.
So in this case, we will show we will make a provision for the returns and show the net figure as sales.
Yes.
And even the discount also I was slightly confused. There also the normal discount 10%, assume it's almost certain. We will show net of discount as sales.
No, that's what I said. The distinct will play a role in net or gross. For that, the distinct will play a role. If it is a joint contract, okay, the moment you touch 100, no arguments. The 10% should go out of me. Okay, that is a case where I will net it off.
So it's like a distinct offer.
Distinct. Yeah, para D70 will explain a very picture, and there are good examples also on this regard, because these are quite common scenarios in bigger companies. Okay. Okay. See, para 4 and 5 are little bit of easier ones. Okay.
Non-cash consideration which were below in the step 3. What is that?
Like some example rebates. See, for the same thing, discount may not be in the form of cash. Okay. If you touch 100 rupees, I will give you 10 rupee discount. That is not in the form of cash. That could be in extra free product. You buy 100 products from me, you get one product free. That is one example. So in that case, I need to estimate the cost of that one product also, because that is a loss for me, no, indirectly. That is what I am doing. Okay. So the step 4 and 5 are kind of an easier ones, because when we are clearing 1, 2, 3, all the concepts are covered. The step 4 is after we decide the transaction price, I am allocating the transaction price into various. Step 2 we decided what is the performance obligation. Step 3 we decided the transaction price. It is allocating this transaction price against the performance obligation. That is all is step 4. Okay. And step 5 is I recognize revenue, but it is at a point in time or over a period of time. How should I recognize? Okay. At a point in time is kind of straightforward. I make a sale, I recognize revenue. At the same, the deciding point is that customer will get will enjoy the benefit at the same point in time. He receives and enjoys. No timing difference. With a T&M contract, time and material contract. Okay. So in that case, it's a 11 months contract. Okay. Is it to the extent of work done, he has to pay me the amount. Example, if it is worded, I will incur 1000 hours to finish this one, but after I incur 50 hours, what is the proportion I will pay? That is an example of over a period of time. Even the example of freight that I told, sale and freight is there. Now when I take two performance obligation, sale is easy. The moment I make the sale, I recognize revenue. Freight, if it takes time, okay, sale will not, if it takes 2 months to get it landed in the customer premises, then that is also over a period of time. So when do I recognize revenue? At a point in time or over a period of time? That is something which will get covered in step number 5. The deciding factor is when does the customer enjoy the benefit? The moment he settles me, he can enjoy the benefit. That is simple at a point in time. It is not that kind of case. It will take, the obligation will take time in order to complete it. It is not that on the spot customer will be able to enjoy. That is over a period of time. So that also plays a role in when do I recognize revenue. Okay. So that is one thing. So now on an overall level we covered whatever. See, if you have come across any, see there are warranty, or warranty is also one example in IND AS 115. I can tell you an example of warranty. Okay. Like for example, it can be an assurance type warranty or an optional warranty. Assurance type is normal warranty where I make the provision as per IND AS 37. Like for example, you get 2 months warranty. Okay. So 2 months, how much is the, how much could be the potential cash flow I will make. There can be cases where optional warranty concept. That is, today I get a bike for 50,000 rupees. Bike's cost is 50,000 rupees, but you offer additional 2 years discount and you pay me 60,000 rupees.
Additional 2 years
Extended warranty, optional warranty, that's the word I used. In that case, then the likely revenue that could go, I cannot recognize revenue for that full 60,000 rupees. I need to slowly defer my revenue for the period of extended warranty. Okay. This is also one key concept in IND AS 115. So bearing, see, when we come across bigger, very larger listed clients, very huge Fortune 500 clients, invariably there will be one complication or other when it comes to revenue recognition. Similarly, if you have come across any unique thing, because now we are kind of winding up. Okay. So now we are neither here nor there. I cannot go slide by slide. Okay. So if you come across any unique in IND AS 115 or something, we can discuss upon that and we can share our thoughts. I am not aware of that. Can you tell me what is the challenge?
Sir, one purchase, one free. The bill will be for 2 or will bill be 1? You purchase one free they say, but the bill will be for 2 articles or 1 article?
One article only, because I am making the sale of
one article.
One.
Then how do I account for the another article what I have received?
Because
supposing it is a car, I purchased one car. He says 1 car is free. If he is billing only 1 car, what about the other car?
The other car I will not receive the amount. No, I have to offer it free of cost to him. So I will. Invoice is a practical scenario. From a GST perspective, I think we have. I am not clear on that. I am not sure on that, because that's more from a practical point of view.
They issued a circular for it itself. One free, one, the total cost,
Mm.
Both will be. Both has to be.
Quantity ஒன்று போடுவானா ரெண்டு போடுவானா நம்பர் 2 இருக்குமா குவாண்டிட்டி 2 இருக்கும்ன்றீங்களா
1 and 1 will be the total.
இல்ல குவாண்டிட்டி 2 இருக்கும்ன்றீங்களா
It has to come. It has to come.
Quantity also has to match.
Another one unique case I can say bill and hold sales. I think this is also quite common. I think you should be aware only. Okay, bill and hold in the sense, anything?
அப்ப சரி வராதுங்க சார் ஒன்னு தான் எனக்கு வித்தான் ஒன்னு வந்து எனக்கு ஃப்ரீ கொடுத்திருக்கான் அது எப்படி அவன் சேல்ல எடுக்க முடியும் அந்த ஒண்ணுலயே வந்து
சார் இது போல இந்த எக்ஸாம்பிள் நல்லா இருக்கு.
Bill and hold sales. Okay, in this case I bill the customer. Okay, here I am the vendor, I am the purchaser, I am the customer. Okay, so I agree with him, I accept the sale from him, but I request him, please don't move out of your factory, you keep inside your premises. When I tell you deliver it to me, but I agree this on the same date I agree itself, I take the responsibility is in my hands. It is physically in his premises, because that also I requested, you please keep it with yourself space. Yeah, in this case when do you recognize revenue?
The moment he does the billing.
Correct.
The moment it is kept.
Fine. Bill and hold. This okay. Okay. From your side, any other complication or any unique things if you have come across, we can discuss on this.
Package was for 2 or 3 years, but they were recognizing there was a controversy that they were recognizing one upfront. I don't know the details. I think one of the big four did the due diligence.
Not from Chennai, it will be from that.
But it was done.
Where are you from? From
Same. Yes, sir.
What has happened in Byju's, it is a tablet.
One second. Does this IND AS cover?
After sales service, revenue from after sales service.
What warranty kind of what do you mean by after sales? After sales service means if it was decided in the contract itself, warranty is also an after sales service, but warranty is inbuilt in my sale contract itself. Okay, that is something which will be covered over here. But something which is not included inside my sale contract, that is not getting into this purview. That is normal IND AS 37. That is provision, normal expense.
Normal AMC.
AMC also, if it is at the time of purchase sale itself, it is inside the contract. That is over a period of time.
No, so if you take Eureka Forbes, what happens? He will sell the equipment for 20,000 rupees. So he will give the warranty for 1 year. And what happened, he is providing after sales service so that you can take 2,000, you have to pay 2,000 rupees per annum, and he is giving against the 2,000 rupees. What happens, every quarter a person or agent from the Eureka Forbes will come, they will clean the complete stuff, they will change whatever that equipments are required. Okay, even so that is an after sales service.
That's what I am saying, sir. So those are two separate obligations. At the time of original sale, only that certain thing which you told original contract only included. Afterwards, I will come and do it on a monthly basis if required. All these different. Then that is separate.
That contract, according to that contract, it has to be recognized.
Separable. So I will recognize revenue at the time of initial sale only to the extent of what are the obligations in my original contract. I again go back to the example of optional warranty. Okay, when I purchase a bike, original 12 months warranty only I get. So it's an assurance. Tomorrow I am extending the warranty. Okay, then that is a separate example. Like that is closer to the example you told. I may opt for it or I may not opt for it. If I opt for it, that's a separate thing.
Even auto components, car, after the warranty, they will go for service.
Okay, that as and when the claim comes, I will pay him and I will expense. That is a separate thing.
Sir, and one more thing, how do we recognize revenue in case of build to ship to model?
Can you explain bill to ship to in the sense? Other you mean to say the invoice is reading, you please go and deliver at premises A, but the customer is at premises B. Again I will see the Incoterm only. You see in this case invoice is telling, see the customer is located in Mumbai, but he is telling me you please go and deliver it at my customer premises in Delhi, okay. So I will ship to Delhi, but my customer who is going to pay me is Mumbai. Again I will go back to the same, the entire Ind AS 101 revolving around that Incoterms example only, okay. When does the control go out of my hands? Is it Ex Works, okay. Then the moment it moves out of my factory, it gets destroyed also, it is up to Delhi and Mumbai to talk to themselves, that is not my problem. I will recognize revenue that it is moved out of my factory.
Even though I am going and delivering over there,
If it is Ex Works, or again as you said, if it is Ex Works and I take insurance, the risk is still in my head, okay. Then in that case, the moment I go and deliver at Delhi only, Mumbai will pay me the money, but I recognize revenue upon the point of delivery. That goes back to the Incoterms concept, okay. So time and material fixed, see talk time, even if you see telecommunication companies and if you see some annual reports of telecommunication companies, the revenue presentation disclosure is a bit enlarged, much enlarged when you compare to the earlier Indian GAAP. For example, they are also asking you to disclose how much is the out of total revenue, how much is at a point in time, how much is over a period of time, break it down into two. Similarly, out of the advance last year contract liability whatever was remaining, how much was the revenue recognized in the current year, that also has to come as a separate disclosure. And they are asking, and there is only one unique thing between IFRS 15 and Ind AS 115. Ind AS 115 has got only one thing which is not present in IFRS 15. Para 126AA, that is, it is asking to give you a reconciliation of your contract price with the sale price. Now coming to this point, step 3 itself has a reconciliation they are asking you to give. That is, my original sale price was 100 rupees. After discount, after all these variable consideration, my net amount is 90 rupees, which is taken to my P&L. That reconciliation is there in Ind AS but not in IFRS, but this is highly confidential. Many of the companies do not want to give this kind of a disclosure, but still some annual reports contain this disclosure. You can just see that specific disclosure to see the reconciliation. This cannot be found in IFRS accounts, only in Ind AS accounts.
So revenue recognition from here it will read the revenue recognition standard. From this one you have to compute the revenue recognition based on this. This is the standard, no?
Right. That's what I explained now.
Is it so? No, you told that Ind AS is asked us to give us the reconciliation. Okay, but many companies are not giving.
They don't want to give because it's confidential. Now, why should company voluntarily? I am giving so much discount to these guys. Competitors, everybody will see the annual reports.
It's a type of violation, no? In such a case, it's a type of violation, no?
Standard is worded like that. So broad level. Overall, 60,000 crores is my turnover. Out of that, I offer discount of 2 crores. That level, if they give enough.
Sir, in the case of membership fees, the company collects membership fees in Jan. It is for 12 months. So in March, shall I account example 1,000 per month, 12,000. I have to account 12,000 as revenue itself or 9,000 as unbilled revenue.
No, I recognize. For example, it's January to January. Okay. Okay, January to December. Okay, for the entire year, the membership revenue is 12,000 rupees. Per month is 12,000 into 3 by 12. Okay, whatever 12,000 into whatever, sir. So proportionately to the extent that much only I recognize my revenue. Balance will go and sit as unearned revenue. That is income received in advance. Unearned because I received an amount in advance. This can be seen mainly in case of service contracts, service companies. No, only 3 months revenue. Balance will sit as unearned revenue. Periodically, it will get amortized out of my unearned revenue into my top line. As of March, it will be 3,000 rupees, and 9,000 will be in liability, income received in advance.
In this case, I am not going to refund to that person. If he is not going to consume, I will recognize only. The user don't have right to get.
Whether he uses or not, he is not going to return the money.
Then it's not over a period of time at all. No,
there is a concept of period.
That's what I'm asking you. So
period convention is
okay. One second. If he surrenders the membership in the month of May, should I refund this balance amount to him? No. Then in that case, I can recognize the full amount.
That's what maybe Vaidus was also doing. If someone is paying 2 lakhs or 3 lakhs,
No, when do I become eligible for the whole revenue? Okay, the question is that it's Jan to December contract. Okay, so for the entire year it is. But I am never going to refund the amount. Okay.
No, the period concept will be deviated. See what happened in Byju's. What happened in Byju's? Okay, see they supplied one tablet. Okay, along with the software, and the entire contract is for 3 years. Okay, for suppose if it is 8th, 9th standard or 10th standard, it covers like that. Okay, 3 years. But they recognize the entire. It is non-refundable. But what happened? They recognized the entire amount in year 1 itself, and they shooted up the price, turnover. That was happened in Byju's.
But if it is never going to be refundable, then there can be an argument saying that I become eligible for the amount over a period of 3 years time.
Yes,
okay.
because what happened initially
again,
year 1, the auditors have approved the accounts.
No,
in the year 2 they deferred it.
That I don't know, sir. That why different years in car. But what I am trying to say is, I become eligible for this amount on day 1. Okay, that's why I asked. See, suppose in May month he decides to surrender his membership. Should I refund the balance amount to him? If the answer is yes, then I agree. Only periodically I need to recognize revenue. But this one, day 1, when I get the amount, no conditions attached. Then what is the mistake in me recognize the whole amount on day 1?
Matching is there. No, matching principle as far as the period concept. So even for that, even if you take for that his case, for the first 3 months, even in limited review, how it will covers.
So basically, what I understand, I'm just sharing. Suppose in this case, Byju's would have received the money, say 3 lakh rupees for a 3-year term, right? And so Byju's would have received 3 lakh rupees for a 3-year term, right? Even then, they should have recognized only for the year and prolonged that to, passed on to the next 2 years, even though it is non-refundable.
Yes.
Even though it is non-refundable. That could have been more appropriate.
That's because otherwise the valuation, that's how the valuation has been shoot up.
Otherwise today, year 1 itself, year 0 actually, I am recognizing entire 3 lakhs as revenue.
Subscription.
Not subscription, they have a technical term, I forgot it. So they are someone was presenting the financials, so I remember they have some specific, so I asked them specific liability. So if someone can go to the Netflix, there I think it's more.
Okay. Okay. And fine. There are differing views in this. Maybe I'll also check on that. But if you ask me individually, even though you are telling matching concept, I am saying I am eligible for the amount on day 1 and never I am going to pay him back. Okay. Then in that case, what is the harm in me recognizing it on day 1? What could go wrong?
No, sir, I agree with your point. Okay, I agree with. But please.
No, that's what. If there are other obligations involved, then I fully agree. That is why I asked, sir, tomorrow. See, for example, this guy, if he, okay, now I received in advance, but some other activities I need to fulfill, then fully I agree with you, I cannot recognize revenue in day 1. I cannot recognize revenue in day 1. I agree, that fully agree. But the example that you told was, on January 1, I received 12,000 rupees membership fee. And irrespective, even if the person dies during the year, I am not going to refund I don't have any obligation at all. I don't.
Whether in this example there is a performance obligation or not.
That's what. If whatever happens, I am not even going to pay 1 rupee out of it. I don't have any activities to fulfill for the rest 11 months. Then I will recognize.
So this will be an example of clubs fee or gyms. Clubs, they are taking in yearly subscription.
Okay. Okay, so any other example, any other unique things what you can, from your side, you have anything to say, Satish, Raghav, or anything?
What is the technical term? I remember one of the students received in advance. No, it's not so. There's another term they use. I forgot.
In that case, I think even if the why do we have this performance obligation stand? You can recognize revenue only when the performance obligation is complete. So in your case, I think the revenue should be recognized only for that 1 year.
1 year, that's what.
And then that will be.
Actually, initially the auditors agreed. First year They agreed for that.
That
one.
is
Then in
irrespect-
subsequent year they deferred it. No, it has to be 1 year only for that particular year. You have to.
Yeah, that is irrespective of whether the amount is
because of that, what
refundable or
happened? The
not.
valuation shoot up. All those things. All this. It's a valuation, sir. They want to come for IPO. That's what it's valuation purpose.
Based upon top line, they would need to get a.
So can you just throw some examples for the software companies, because that of course it's also a construction contract type of thing. Generally we used to talk only about the real estate or building the plant or constructing the plant. But if you just throw some examples for the software,
Okay,
revenue recognition has been happened.
Yeah, I'll talk about that. Before that, one concept, since you started, I once stuck my the significant financing component in step number 3. Okay, this is also some of the unique things. Okay, sometimes when I sell goods to the customer, this happens in case of when government is my customer. Today I sell the goods, government will take 3 years, 4 years to make payment for that. Okay, similarly between advance and setting of the advance, okay, it will be a matter of 3 years, 4 years. Then in that case, today if the amount of the sale is 100 rupees, it's not only 100 rupees. Okay, I need to discount it. The discounting time value of money will come into play. Okay, then that will also adjust my transaction price. This will be typically in the case of all long-term contracts that will play. Okay, now coming to software. Government bond rates, you can take government bond rates. Okay, that is a common thing we take for discounting, etc. Okay, and with regard to software companies, okay, generally how there are two things what normally happen: T&M, time and material contracts. Second is fixed bid contracts. Okay, how it happen? T&M material contracts is it will be agreed. See, this is the software that I need to deliver it to him. Okay, but I will work 1000 hours in order to deliver it. In order to finish this software, in order to complete the installation, etc. for software. T&M is a case where as and when I complete an hour, that is as on March 31, out of 1000 hours, I have worked for 200 hours. Okay, and the overall contract price is 10 lakh rupees. So 10 lakh into 200 by 1000, I am eligible to recognize my revenue. That is the flavor of this T&M. Work for that. Now he cannot, to the extent I worked, he has to pay me. Okay, work is done, he has to pay me. That kind of thing I do over a period of time and recognize the extent of work done. Okay. Second is fixed bid contracts. Okay, that is more like our old construction contracts. Okay, I will go by percentage of completion method. So cost, how much cost has been incurred till date, divided by how much total cost will be incurred to complete the full installation. That percentage I will apply on the overall contract price of 10 lakh, and I will recognize revenue to that extent. That is number 2. Number 3 is simple. Customer is not bothered about how much hours you work or how much and all. You deliver me, like us, people like us, you deliver me a good product, then I will pay. I am not cared about you work for 1 hour or 1000 hours. That case, it's very simple. I recognize revenue only when my final installation is completed. Yeah, because I cannot call I am eligible. No.
Okay, suppose assuming that for developing one software, it takes 2 years. Okay, so and it involves the 4 to 5 stages. So in the last example, what you told, unless I am completing that particular stage, the customer will not make any payment. In such a cases, I have to
defer. I have to wait only.
We have to wait for it, and then only we have to raise the testing.
But typically, if I see the software companies and all, they go by the T&M method or fixed bid method only. The final example is very remote, very rare. They will agree for this percentage of completion or hours worked. They will agree to that, and they will recognize revenue based on that. 99% of the companies' long-term contracts happen like this only. But, because, if I go to the third example, then the significant financing component will come into play. Okay, today the invoices, day 1 it is 10 lakh rupees. On day 3, it doesn't necessarily be 10 lakh rupees. The time value of money I need to factor in. But this is very remote scenario. Very rarely you find these kind of cases, unless it is a government party. Government will not, if you Defense India, Ministry of Defense and all, they will do like that. They only will not agree to this T&M and all. There only you can find the third example mostly. Okay. If anything from your side you can discuss, or you can wind up for the day.
Yeah. Luckily we got almost 40 minutes.
Yeah. And even though I was not able to run the slides, I hope at least you are able to discuss some interesting concepts, some good concepts.
This was very interesting.
Absolutely.
This was really very interesting and highly quite interactive.
Thank you, sir. So it's a blessing in disguise that we didn't get time. We are able to discuss more.
I rather than I would say that the day how we started, the same way we are ending it.
Thank you. Thank you. Thank you. Thank you, sir. Thanks, everyone.